That's a spike up. It rose 30 basis points. So the market looks for 93 basis points of cuts. Still looking for cuts, not the 175 basis points that it did about a month ago. June is now the first month where the market is priced for a cut. The folks at Bank of America say there will be 4 more CPI prints. Becky was asking about this in the 6 o'clock hour. 4 more CPI prints before the June decision, which leaves plenty of time to reestablish the disinflation narrative if, as we expect, the January inflation data proved to be, there it is, a blip rather than the start of a new trend. The report supports Fed Chair Jay Powell's decision to be patient before going crazy and starting the process of cutting rates. The trouble is that it introduces risk to the coveted soft landing scenario where the immaculate disinflation we had so far is not enough to get back to the 2% target, Joe. And I think you were expressing that shortly after the number came out yesterday.
Steve, if short rates are going to stay where they are for a while, with the Fed not doing anything, the only way to get out of this, or the only way to steepen the curve, is for long rates to go back up, unless we stay inverted, which is a signal that we've got more slowing in the economy to look forward to. Where do you, to not be inverted, we'd have to be back above 5%, well above. We'd have to go back up there, and we easily could. We made strides yesterday. How many basis points? You don't see that on the 10-year very often, do you?
No, it was quite a day. But, Joe, remember, the Fed sees itself as restrictive. We'll do the quick math on the Fed here, which is that they have this long-run neutral rate they think is 2.5%. They're at 5.38, so you can do that math and come up with a real rate of 3 and change. Or you can take off the inflation rate right now, which is, call it 3, I guess, and say they're at a 2% real, which is above their real rate of say, 0.5%. So however you calculate, the Fed sees itself as restrictive. I believe that the Fed's reaction to higher for longer inflation is going to be a higher for longer rate at the current rate. I also think they're going to look through this, but I also think that Powell is not going to be upset that the market reacted this way and the Fed didn't have to say anything. So the idea that the reaction function between the market and the Fed is reasonably well aligned here and is in a better place than it was, for example, after the December meeting, I think Powell might welcome that and then let the market adjust again if inflation, for example, in the PPI on Friday or the PCE on February 29th come in a better place.
Right, because if it is restrictive, we haven't seen it in the economic numbers yet, or across the board anyway. We might have seen it in certain pockets.
Right.
But if they really are restrictive, where the hell is it? In the labor, I mean, remember when we got that number, that jobs number? It's like, you gotta be kidding me. It was like 3 times what it was supposed to be.
Joe,
that's restrictive.
I know we want to get to, the great Roger Ferguson, who's coming up with lots of wisdom, but I will point out the current quarter growth is running in the 3% range. So we never got the slowdown in GDP in the fourth quarter.
Well, then why
You're
are we
right, we didn't get it
restrictive?
in the jobs.
And we're not restrictive.
Well, that's the question we asked. That's the question we asked, as to whether or not it really needs to go down from here. And you, Joe, are you now on the side of it needs to go up from here? Is that the territory you're staking out? Come on.
I am scared that we would never have a recession if we didn't bring one on ourselves. We're our own enemy, and I'm worried that's the way they happen. That's the way they happen, where we don't get it.
But is that what's needed? Is that what's needed from a policy
I thought we decided we didn't need to slow it. I thought that didn't work anymore, that inflation could come down and economic growth could stay strong. I was hoping that we didn't need it.
You are proving my points. You are proving my point, sir, which is that worst case scenario now has to be part of the investment thesis. That
I remember when it happened before.
In order to bring down inflation.
And there's no similarity to 21.5% prime rates, but I remember when we had to go that high to get things under control, and then the guy's now a hero. Let's bring in our next guest, former Fed Vice Chair Roger Ferguson, who served as President and CEO of TIAA. He's now a Vice Chairman of the Business Council and a CNBC contributor. Roger, thanks for joining us. Is your expectation for a recession gone up at all in the last couple of days from this, Roger, from stubbornly high inflation?
Well, Joe, you may recall that when all this started, I mentioned there was a risk of recession for just this reason, that the last little bit of getting inflation out of the way is going to be more complex than perhaps people had thought. The Fed may well have to hold rates higher, staying in restrictive territory the longer, and that by definition increases the risk of recession. So yes, my assessment is that the risk of recession has gone up moderately, not over 50%. So I wouldn't say it's the most likely outcome, but with every time we see a bad print, I don't know if there'll be more, that means the Fed has got to stay in tighter territory and therefore risking a recession.
Yeah, that you didn't like that number yesterday. I mean, that was. I mean, maybe it's a seasonal thing. Maybe people raise prices at the beginning of the year, but there's just no. That was not a great number for someone like you who worries about the economy being stronger than we thought.
I think that's a fair statement. I know the analysis that says it might have been a blip. I hope that's the case. But what we've seen is that goods disinflation is certainly well advanced. Unfortunately, in the service sector, that's not the case. And we see from yesterday that most of the surprise was in the service sector, even the service sector without housing, which is so-called the super core. So that does play into a concern that inflation dynamics are not going to be as easy on the service side as they were on the goods side. And so the immaculate disinflation that we've had may not be the story going forward. I'm not yet saying, making that call definitively, but you're right. I look at that less as a blip and more as a validation that the last bit of disinflation is going to be hard to come by.
Yeah, who knows? What the labor numbers, the unemployment, or the numbers that we've been getting on Friday were so out of against the conventional wisdom of where we were in the economy that, and then just historically, Roger, we're trying to normalize rates. We went up a lot and we went up fast. But on a historical basis, are we at would you call this a high level of interest rates?
Well, no, on a historical basis, this is not a high level of interest rates. Having said all of that, we have a couple of things working.
Right? If you go back far, like the early 20th century and stuff. But given what we saw from the 60s to the 70s to the current period, I think a 6, 7, 8% is not crazy for the long rates.
Oh, I think that's absolutely correct. We've been through an unusual period of very, very low rates. We're now normalizing. The other issue that is certainly very uncertain is the so-called neutral rate. So the Fed thinks it's probably in restrictive territory, but there's a debate that says, the data thus far suggests maybe, it's not as restrictive as they think, which explains why it is that we're seeing surprises, positive surprises in the labor market, positive surprises in GDP growth. We like all of those things, obviously, but it may suggest to the Fed that it may have to stay higher than others have expected for a longer period. That's not the worst, if that's what it calls for, but it does increase that risk of recession that you and I were talking about.
All right, Roger. So I asked Steve, so you would be absolutely shocked if there was another rate hike in the next year? You would be shy. Is that 0% chance, or it's not 0? It might be 1% chance?
Look, the chance of another rate hike is not 0. I would be very surprised. I think the more likely move is down, but later than the market had expected.
Okay.
Perhaps fewer cuts. That is now what I'm imagining as my baseline. But that does not exclude at all the possibility that the data will continue to be pretty hot and the Fed may feel obliged to do one more tightening. Seems unlikely, but I think you heard in the last press conference, Chair Powell musing on the possibility that, there might not be the kind of landing we hoped for. He put that as a risk out there, so it may well be in his mind as well to say, rate hike not definitively off the table, less likely, but not impossible.
Okay. Roger Ferguson, thanks. We'll see you soon, I have a feeling, but good to have you on this morning.
Thank you, Joe. Take care.
When we come back, Delta Airlines handing out $1.4 billion in profit-sharing checks to its employees. CEO Ed Bastian will join us with more on that, plus an update on travel demand. And check out Lyft shares this morning. The ride-sharing company reported better than expected reports and guidance. You see that huge jump there in the stock when it was up by more than 60% for a brief moment. That was because of a typo We'll talk more about that too. The stock still, though, up this morning. The CEO, David Risher, will join us at 7:40 a.m. Eastern Time. Squawk Box will be right back. Welcome back to Squawk Box, everybody. We want to get straight over to Phil LeBeau. He joins us with a special guest this morning. Phil, good morning.
Good morning, Becky. Let's bring in Ed Bastian, the CEO of Delta Airlines, joining us from the company's headquarters in Atlanta. Good morning, Ed. It's a sweet Valentine's Day for your employees as you announce profit sharing of $1.4 billion. What that works out to what? 10% of each employee's annual salary approximately?
Good morning, Phil. Great to be with you. And yes, it's a great day to be at Delta. We're celebrating our employees' hard work with their success and rewards with a $1.4 billion profit sharing payout. It's about 5 weeks of pay, a little over 10%. And I could not find a more deserving group of people. All the work, not just this past year, but getting through the pandemic. It's really, really a wonderful day. And it's a wonderful day to travel on Delta. Everyone's really happy today.
Is this one of those milestones, Ed, where you can say, look, we've been making progress since the pandemic, knocking down goalpost after goalpost in terms of, things that we want to do to accomplish, say, we're all the way back. Do you feel like this is one more example of saying second highest ever, best since the pandemic in terms of profit sharing, and we're almost all the way back from where we were and the depths of the pandemic?
Yeah, it's a great milestone for us. We're going to be hopefully surpassing this yet again on next year's Valentine's Day, but it's a really important marker for us because Profit sharing is something that Delta created within our industry. We've been doing it for close to 20 years. We've paid over $11 billion of profit sharing during that time. You think about all the challenges that the industry has faced during that 15-year, 20-year cycle. And it signals to our employees that they're doing a wonderful job, that we appreciate, we love them, and we also thank our customers because our customers make it all possible for us.
Speaking of your customers, what's your outlook on travel right now, what you're seeing?
Travel's doing really well. We just finished the last 5 weeks are the slowest point of our travel calendar, and we saw the demand was solid through that period of time. Tomorrow starts the long President's Day weekend travel period, and we see travel at this point in our business going right through Labor Day. It's a strong line. The bookings are solid. Every geography we look at, we see really great interest in continuing to experience the premium travel that Delta offers.
Ed, last time we got together in Atlanta, you talked about the steady progression of corporate travel bookings. Is that continuing, or are you noticing, as we've seen some of the layoffs in different companies around the country and in different markets, are you noticing any pullback at all in terms of corporate travel?
At the start of the year, we took another step up, and it stayed strong. It's up probably about 10% from fourth quarter to the first quarter of this new year. We're pretty much back to the overall volume that we had pre-pandemic of traditional corporate demand, and I don't see any slowdown at all. I see companies continuing to return to office. A couple of sectors that were the biggest laggards, such as tech, the consultancy, some of the financial service providers, are getting back. People know they need to be out with their customers. They need to be out developing their business models, and the best way to do it is in person.
Ed, I have to ask you about your competitors who are going to be called to testify on Capitol Hill about their co-branded credit card agreements. And I understand you're not part of the hearing that's going to be on Capitol Hill. I know your relationship with Amex is different than the relationship your competitors have with the credit cards that they offer. But are you concerned that Washington will look at the success of co-branded credit cards that the airlines have had and may want to try to get a little bit more hands-on in terms of regulation?
The success that credit card programs have had in our loyalty program with Amex is a direct reflection that consumers really want the rewards, they want the points, they want the miles that Delta provides together with American Express. And anytime you are providing great opportunity, great value to consumers, I don't see anything that should stand in that way.
One last question, Ed. I know you ordered the MAX 10s, and they're scheduled for delivery, at least when you ordered them in 2025, has yet to be certified. And as you know, their production at Boeing is capped right now when it comes to the MAX. Do you still expect to start receiving those in 25, or is it more realistic that's going to have to be pushed out a bit?
Realistically, it'll be pushed out. I don't know quite when we will receive that plane. We don't have any of the MAX flying on our platform currently. We'll wait to make certain we understand everything that we need to know, that the regulators and others are inspecting on that program. But no, realistically, I'm sure it's going to be well beyond 25.
A very quick question for you, Ed. We've heard from the CEOs of Expedia and from Airbnb in the last couple of days, and both of them have suggested that travel is slowing down, getting back to more normal levels. The revenge travel isn't really out there. Have you seen that in your bookings?
We haven't seen that in our bookings, Becky. What we see in our bookings is that premium travel demand is really high and continues to grow. Hard to make a statement. We've had the last 5 weeks, as I said earlier, was the slowest period traditionally in our calendar for travel. So I'm not sure I would use that period of time to make such an estimate. But no, everything we see, and particularly internationally, particularly business, corporate demand, all the premium experiences that we offer consumers is flying off the shelf.
Ed Bastian, CEO of Delta Airlines, joining us today from the company's headquarters. Ed, happy Valentine's Day to you and your employees. Becky, certainly a very happy one for Delta employees who are getting those profit-sharing checks. $1.4 billion is what they're awarding this year. Becky, back to you.
Thank you very much, Phil. We appreciate it.
Okay, coming up in just a moment, stocks to watch ahead of the open. And here's today's trivia question. According to Hallmark, how many Valentine's Day cards are exchanged on February 14th? Have you bought yours already? Well, we're going to have the answer, not for that second part, but the first part, right after this when Squawk Box returns. Welcome back to Squawk Box this morning. And now to today's trivia question. According to Hallmark, how many Valentine's Day cards are exchanged on February 14th? The answer, 145 million, making Valentine's Day the second biggest holiday for exchanging cards after Christmas.
How many did you buy?
3.
I bought 5.
How many did you buy?
One, and
You're dissing Scotty.
Kids?
we went together.
Oh, okay.
Did they
You
go?
went in on it together.
That's-
That's okay.
That works.
Okay. Let's go over to Frank Collins, see how many cards he bought.
You know, how about roses?
I didn't buy any.
I have some coming,
You do.
but now assuming my Valentine watches, which she doesn't,
I
she
try to-
would know.
I try to do her age.
Wow,
Yeah.
that's expensive.
30-something, yeah.
Yeah, 30. Oh,
29.
cheap.
29.
Frank Holland, a look at this morning's stocks to watch. How many cards did you buy, sir?
You know what? I'm just going to stick to the stocks, guys. I'm not buying roses. I'm not doing anything by age, but I am looking at Robinhood stock this morning. It's popping this morning on an unexpected Q4 profit, stronger than expected revenue, and lower costs, helping to boost profits and EPS as wealthier and more seasoned traders, they move to the platform. The brokerage highlighting strong momentum, including the most monthly deposits since all the way back in the pandemic, 2021. You can see shares are up almost 14% right now. All right, Airbnb, those shares are lower despite reporting better than expected earnings and guidance. Revenue also rising by 17% as the company hits what they call an inflection point for expansion beyond the core business. Airbnb also announcing approval to buy back up to $6 billion of its own Class A common stock. You see shares are falling just over 5%. We're also looking at shares of Upstart Holdings right now. You can see right here, they are deep in the red this morning. The AI-fueled lending platform posting better than expected quarterly results, but its first quarter outlook was much weaker than expected. The stock has more than doubled in the past year, thanks in large part to all the excitement around AI, but you can see right here the downward trend. Today's move will put it deeper into negative territory for 2024, already down more than 30% year to date. Upstart shares down more than 14% right now. Joe, back over to you.
All right, Frank, thanks. Coming up, New Jersey Congressman Josh Gottheimer's battle to expanding the SALT deductions. He's joining us after the break with an update. Squawk Box coming right back.
Or download the app.
Welcome back, everybody. Legislation to double the state and local tax deduction cap, which is also known as SALT, is expected to get a procedural vote later today in the House. Our next guest has been spearheading that battle to raise the cap to $20,000 for joint filers making under $500,000 a year. And joining us right now is Democratic Congressman representing New Jersey, Josh Gottheimer, who also co-chairs the SALT caucus and the Problem Solvers Caucus, too. Congressman, thank you very much for being with us this morning. From what I've heard,
Thanks,
this
Becky.
vote is...
Happy Valentine's Day.
Thank you. Happy Valentine's Day. From what I've heard, this vote is not expected to pass because there are congresspeople both on the Republican side and the Democratic side that oppose it.
Well, we're working around the clock right now to make sure the procedural motions get done, but more importantly, that we get to a vote on the actual bill. You know, you're battling red staters, the moocher states who initially gutted the state and local tax deduction in 2017, as you know, and capped it off at $10,000. This would double it to $20,000 for married couples. A down payment, of course, to the ultimate goal, which is in 22 months to get the full deduction back when the 2017 tax hike bill expires, and we can get the full SALT deduction back and bring tax cuts to a lot of middle-class families who need it.
The Tax Foundation, which is a nonpartisan organization, says that this proposed increase in the cap is not great. They say it would increase the budget deficit, create new tax cliffs, and they point out that it is regressive. Your response to that?
Well, we know that SALT, the reason we had SALT deduction in the first place is to avoid double taxation, getting taxed twice on the same income. And so I have, of course, always mentioned that to them. I'm totally against double taxation. And more importantly, helps middle-class families and supports states like mine that, frankly, pay far more into the federal kitty than others. You know, we know that these other states, I affectionately call moocher states, pay far less in, and they have, of course, lower property taxes, but they don't do as much for the people they represent. In Jersey, we've got great schools and roads and bridges and take care of people. And the bottom line is, I believe, for middle-class families, they deserve a tax break. They deserve to avoid double taxation. And, of course, delivering this deduction will do that.
The red states argument, or as you like to call them, the moocher states, has always been that, look, you all have the ability to lower your tax base, that you're doing it to provide benefits, as you mentioned, schools, bridges, and other things, but just because New Jersey is providing those things shouldn't mean that you get a payback from the federal government when it comes to it.
No, and my answer to always my friends over there is to say, listen, if you are Louisiana and you get half your state budget from the federal government, or you're Mississippi and you get $4.38 back for every dollar you pay to the federal government, why don't you just agree to not take more than $1 for what you pay in? In Jersey, we only get 67 cents back historically for every dollar we pay in. So if we even everything out, that's one argument, but they don't want that. They want to keep taking from Jersey taxpayers and take it to them. So my argument is just fine. Take no more than 1-to-1, and you know we'll have conversations. But until then, the least we can do is avoid double taxation, get lower taxes for families in Jersey, and get some relief back, given how much we pay to support their incomes in Mississippi and Alabama and Oklahoma and other places like that.
Well, when you talk about double taxation, there are a lot of people here in the tri-state area who are looking at the New York City congestion plan, which will charge $15 for people coming into Midtown in New York City, after they've already paid $15 to $20 to come across one of the bridges or tolls if you're coming from outside. Looks like that plan's going through anyway.
I haven't been shy about that. I mean, right? It's more than $15. They also, New York wants to charge a congestion tax of 15 plus a 25% more for days they consider on surge pricing, and they want to be able to raise the rates 10% in the first year and this year. They're trying to move ahead. We've got many lawsuits to try to stop them, bringing up the realities of more pollution, which the MTA admits this will cause more pollution. It will cause more congestion, and it hurts hardworking families, nurses, electricians, all these people who have to drive into the city every day. It's outrageous, Becky. And by the way, in the end, if they do go ahead, you know what it means for Jersey? More people are going to encourage them to stay in Jersey. We're going to take New York's jobs, bring them to Jersey, because people aren't going to be able to afford to do that commute.
Well, that's certainly been New York's response. Take it or leave it. Go away if you don't want it.
Yeah, but the New York businesses keep complaining about it. They're some of the biggest detractors of it because they want people from Jersey and other places to be able to afford to come into New York and shop there and bring their families in and support their economy. So they're the ones who are actually complaining the most and saying, please don't do this. At a time we're trying to get people back into New York to work in New York and support their economy, they're actually jacking taxes up on people in an unaffordable way. So you've got a lot of people who are standing up to the MTA, which is the mass transit system in New York, one of the worst run mass transit systems in the country, and they blew $700 million last year to people who didn't pay to ride. Right? They blew $1 billion recently on a subway station they built that was too big. It's such a mess. They need our money to fix their problems. They should take care of their own problems instead of blaming everybody else for their woeful mismanagement. That's what we keep saying to them. Like, listen, I know you've got problems. Fix your own problems instead of looking to other people to solve them for you.
Josh, back to the SALT vote. Odds that you think it will get passed. And then if it doesn't, what happens in 22 months? When it's set to expire, but there will probably be some movement to bring some sort of tax plan around.
Well, you would hope the Republican leadership wouldn't bring their own bill to the floor if they didn't think it could pass, right? So, but then again, you know, things are a bit of a little difficult on their side these days in getting things done. So you would hope they wouldn't do that. If it doesn't work out, and we can't double it from $10,000 to $20,000, which, Becky, is only, you know, 1 grain of salt. I want the whole salt shaker back. In 22 months, the tax bill expires, 2017 tax bill expires, the full deduction comes back unless new legislation is passed. Given how difficult it would be to pass that legislation, I'm very optimistic we'll get the full deduction back. Many of us have been fighting for this for years. We've passed it 4 times out of the House. It keeps running into the red state senators who refuse to pass it. But But in 22 months, the full deduction will come back. I'm very optimistic about that, and we'll finally get some tax cuts for families that deserve it, not just in Jersey, but in the tri-state area, and of course around the country.
Congressman Gottheimer, thank you for your time today.
Thanks, Becky. Good to see you.
Coming up, the shares of Lyft higher this morning after reporting strong results and guidance. There's a big turn, though, in the stock on what turned out to be a typo, an extra zero in the margin forecast. We're going to get to that and more with CEO David Risher. That's next. And check out the move in Bitcoin this morning, now above 51,000. And it's been just over a month since the SEC, what would you call it, grudgingly, I think, approved the spot Bitcoin ETF. We're going to talk to Chairman Gary Gensler at 8 a.m. Eastern Time, see whether he loaded up on any of the crypto. Squawk Box coming right back.
Welcome back to Squawk Box. Lyft reporting its first quarter results yesterday, and the stock jumped over 60% after hours. That was for a quick hot minute, an uptick in the rideshare's margin expansion. The release had that number at 500 basis points, but on the earnings call, the company's CFO, Aaron Brewer, corrected that number, said it wasn't 500, it was actually 50 basis points. The stock then pulled back its gains after the revision, but still up quite impressively. Joining us to discuss the rest of the results, David Risher. He's the CEO of the company. David, it's nice to see you. I want to get into the details of this last quarter. I want to get into maybe the Taylor Swift effect. I want to get into what's happening today here on Valentine's Day, because I know there's going to be some driver issues we should discuss. But I do want to start with, I don't know if it's a fat finger or what happened in terms of editing the press release, if you will, but how that extra zero got on there.
Yeah, I mean, look, it was a bad error, and that's on me. That's on me. But I don't want it to take an ounce of attention away from everyone at Lyft who busted their butts to deliver the best financial quarter in the company's history. That's really what I want to focus on.
I'm sure a lot of people do want to focus on it, and I know this is more of a short-term issue, but we are going to have Gary Gensler on the program literally in about 15 minutes. And one of the things that obviously the SEC looks at is when these things happen. and whether they are going to fine companies, what they should be doing to try to keep all of these things from happening. Can you just sort of walk for those other CEOs out there who watch the broadcast, who think to themselves, you know, through the grace of God go I, what is the lesson here for you? Was there something in how this happened that you think is preventable in the future?
I mean, absolutely. The lesson is, you know, measure twice, cut once. I mean, look, we had thousands of eyes. We've got a process on this that is nuts, and it is just it's a terrible thing. It is an extra zero that slipped into a press release, and you know, thank goodness we caught it pretty fast, and we issued an immediate correction. We got a new AK out there. Super frustrating for everyone on the team, and people are really taking it seriously, I can tell you that.
By the way, how did you figure it out? I mean, did somebody call you? Did you get a text? What was the...
You know, as you're doing these earnings calls, of course, you've got things coming in at you, you know, from 1,000 different directions. And someone on the team noticed pretty fast that we were getting a lot of interest in the margin, and she looked at the number, and you could just see her jaw drop. And you know, we luckily the only place the problem was one place. It just happened to be the press release. But as I say, we issued a correction in a second and moved on. Really, I mean, obviously we're focused on customers. It was and a great quarter. It was very frustrating and a real error. Again,
let's talk about the quarter. Barron's has a headline this morning that says, "Forget Lyft's error typo." So you'd be happy to know that. How Taylor Swift helped the ride-hailing stock pop. Do you owe her a commission this quarter?
I mean, I tell you what, look, a lot of things went well, not just in the quarter, but in the year. We had our best financial year ever. You know, 16 billion, or excuse me, 1.6, 13.8 billion. Now I'm thinking typo on Taylor Swift, but 13.8 billion in bookings, you know, fourth consecutive quarter of growth. And what I'm really proud of is the focus on our customers, on our riders and drivers. And that does include customers going to Taylor Swift concerts, who, by the way, and maybe we can talk about this later, tend to tip about 3 times more than other customers. So it was a great quarter, it was a great year across the board.
There's a lot of CEOs also who are focused on Taylor Swift. Do you think that's a repeatable situation over time? I mean, she's got her tour running, I think, through the end of the, she's going to come back, obviously, to the U.S., and that'll run through the end of 24. But, you know, people like to put a multiple on these things. And, you know, is this a one-time event or not?
You know what? Taylor Swift probably wasn't the reason for our great performance. That's all about the team and the focus on obsession, customer obsession. But, you know, in the end, you know, when events happen, you know, you get a lot of people going to the concert. You get a lot of people coming home from the concert. We've actually done a really good job making sure that people get picked up quickly, you know, at the end of the concert. And it has a real effect. It absolutely does. So, you know, Taylor Swift will do her thing. But there are events, you know, just about every day of the year right now. And we're
so what is it exactly that you think you're doing right now that's actually bringing customers aboard? And when you think about it, is it a market share issue, which is you're taking customers who otherwise wanted to use Uber and they're now using you instead? Are they folks who were going to drive on their own or take a taxi or walk or bike, or what's happening here?
Yeah, you know what? It's a little all of the above, but here's what I can say. We had more active customers, you know, than we've had, you know, ever in our company's history. We have more driver hours than we've had ever in our company's history. And so what that tells you is that our thesis, which is focusing on customers, obsessing on customers, can drive great financial results. And, you know, as you know, we've had free cash flow for the quarter and are predicting it for all of next year. It's really all about that customer focus. And I know it's something that a lot of CEOs say, but we're really, really obsessed over it. And you can see it, 25% of our customers were new, but 75% were returning, right? So that kind of tells you right there that you've got a pretty good balance of folks coming in because they like what they hear and folks coming back because they like what they experience.
What's the status of the membership, Lyft Pink? I know I think, are giving away some of that through one of the JP Morgan Chase cards. Are you seeing an uptick from that?
So I'll start with the end there. We've got a great partnership with Chase. And I will tell you, if you are a Chase card owner, particularly a Sapphire card owner, download the Lyft app, you get 10x points. And that's a big deal. But more broadly, you know, our loyalty kind of approach isn't so much on a single product like Pink, although that's a good product. It gives you free priority pickup. It's a great loyalty program. It's more about doing things great every single day. I'll give you an example. We will pick you up to go to the airport on a scheduled ride. And of all the rides we get, and by the way, if we're more than 10 minutes late, we'll give you up to $100 back, no questions asked, so you can take, you know, a different way to get to the airport. When we do that, we are less than 2%, you know, making errors on that. Basically, 98% of people get picked up within that 10-minute window, and it costs us like 0.01% of bookings to do the remediation. Point being, we're really confident of our operational excellence and our customer focus, and I think that's really what's driving our results.
Wanted to also ask you about what's happening today. There's going to be a bit of a rider, or I shouldn't say a rider, but rather a driver strike that's going to take place. These are not just your drivers, but Uber drivers as well, over pay. What can you say about that?
So it's a strike that's been in the works for weeks, maybe longer. What I can tell you is the big issues that drivers tell me, and I hear from drivers all the time, around pay transparency, around understanding what the cut is between what they get and what we get, around deactivations. These are issues that we've actually addressed really well. And I'll be very specific. Last week, we released a driver release that guarantees drivers will make at least 70% after external fees of what a customer pays. And if they don't make it, we'll actually make it up. We'll literally rebate them the money. But by the way, the average is 88%. The average is 88%. So this 70% is a floor. My point here is that drivers are very vocal with what it is they want, and we want drivers to succeed. And so I think this strike, which, as I say, has been in the works since prior to this, it highlights the same issues that we've known about. But I feel really good about how we've addressed them, and I'll be interested to hear drivers' feedback, which so far has been incredibly positive about this.
David, we do want to thank you for joining us on this day, especially given a little bit of the hiccup last night, and look forward to talking to you again very, very soon.
I tell you what, Andrew, have a great Valentine's Day. I hope you get out. If you get out, take a Lyft. I'm going to be driving tonight, actually. So I'm in San Francisco. I won't get to pick you up, but maybe someone out here I'll get to pick up.
Hopefully you get some good tips. Thanks.
Thanks.
Up next, Meta's CEO Mark Zuckerberg gives Apple's Vision Pro headset a try and gives his review. Guess what? He says that Quest 3 is better. Maybe not a shocker. We'll tell you the details, though, next. Right now, though, as we head to a break, take a look at this morning's pre-market winners and losers on the NASDAQ. We'll be right back.
Welcome back to Squawk Box. A lot of mixed reviews for Apple's new headset, the Vision Pro. Add to that one more mixed one, maybe this to be expected, from Mark Zuckerberg. Though kind of unusual to see something like this. In a video posted to his Instagram feed, the Meta CEO saying he finally got a chance to try Apple's new device. Zuckerberg had a friend shoot a review of his living room using Meta's Quest 3 headset. He says he came away from trying the Vision Pro convinced that Meta's device is not only the better value, it's the better product, he says, period.
There are a lot of people who just assumed that Vision Pro would be higher quality because it's Apple and it costs $3,000 more. But, you know, honestly, I'm pretty surprised that Quest is so much better for the vast majority of things that people use these headsets for with that price differential.
Aside from the Quest being about 7 times less expensive than the Vision Pro, Zuckerberg said he thinks the display in his company's product is more crisp and it's more comfortable. And I will say, having tried both, I think actually for right now, he's right.
There have been some people.
It
who
is the
have
better
returned
product, and I've
Apple
always
Visions because they say it's too heavy after you wear.
It's too heavy, and I've always
do things like search easily.
I've always thought that Meta could be a big winner from all the attention that the Vision Pro is going to bring to this whole game, and it very well may be that the technology in Vision Pro is better.
It costs 1/7. What does 7 times less expensive means? That's
it's
not
$500.
It costs 1/7.
Yeah, it's $500.
How that,
but it does a lot. Now it does, it doesn't do all the same things, but it does. In some cases, it does actually a lot more.
I think Zuckerberg looks much better with the new haircut.
Well, I thought it was.
Also bulked up from all the
I thought it was pretty brave of him to come out and, not brave in that you don't normally see that, and I thought he was right.
I like Squawk Box much better than those other business.
They're gonna roll right over our heads. We'll be back.
Don't you?
We've got a lot more coming up, including this. Gary Gensler coming up right after this.
Oh, God.
Good morning. Futures pointing to gains for the major averages, but there is a caveat. The Dow just suffered its worst day in almost a year. That's because of some of the hotter than expected inflation data. And Lyft shares shooting higher in the pre-market, up about 20%. That's after they were up about 60% after hours yesterday, but it turns out that's because someone added an extra zero to the earnings release. We're going to talk about that again And then Bitcoin gaining ground. It's been 1 month since that crop of Bitcoin ETFs was approved by the SEC. We're going to take stock of the sector with SEC Chair Gary Gensler, an interview you do not want to miss in person at the table. The final hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. U.S. equity futures at this hour showing a bit of a snapback this morning. You can see the Dow up just under 100 points. NASDAQ a little scary for a second there yesterday when it was down more than 300, getting back over 100 points this morning. And Treasuries, we haven't seen this on the 10-year for a little while. It's above 430 now, and it was just 405 like this week, wasn't it, or last week?
I mean, it's the highest a couple months.
Yeah.
It has now been just over a month since the SEC approved a slate of spot Bitcoin ETFs opening trading in the cryptocurrency markets to a wider group of investors. Bitcoin itself has jumped in recent days. This morning, you can take a look right now. It's over $50,000, sitting just at about $51,601. Join us right now on the set for the first time to talk about Bitcoin and a lot more is SEC Chair Gary Gensler. Good morning.
Good morning. Good to be with you.
So it's a month later, and I think we're all curious about how you think this is going, not just in terms of what's happened to the price, but in terms of what you think is happening inside this market and whether you think it's, quote unquote, working.
Well, look, we focus on investor protection, and of course the issuers raising money. So this product, we've had similar products in gold and silver, ETFs, you call them. They're technically exchange-traded products. We approved a group of about 11 at one time. This was not the first way you could buy or express a risk in Bitcoin. But as we like to say, we're merit neutral. This was not in any way like an approval of Bitcoin. That existed. It's just how to trade it in these exchange-traded products.
We've had both a futures-based Ether and Bitcoin ETF, before, and I'm curious sort of how you think that this is going to impact the price of these things, given that, by the way, interestingly, was it Pomp who was just on, Anthony Pompliano was just on earlier this weekend, was saying that so few Bitcoins are actually moving, and what we should think of that.
And merit neutral, I think it's a little less than neutral, Mr. Chairman. It almost was, we called it grudgingly when you finally got it. From the court case sort of forced in. Is it really just neutral, or wasn't there a little bit of a, we're not sure about this thing, and buyer beware?
Let me say it this way. We're merit neutral if somebody's complying with the laws. Okay. So if they're giving full, fair, and truthful disclosures to the American public, who gets to decide on their investments.
But you're so smart. You're at MIT, and people listen to your what you think about Bitcoin, and it is troublesome to me if I look at it and I see all the merits of it, and someone that taught about it and understands it seems to have an opinion that maybe it's, I don't know, pet rockish or something.
I get your words about pet rocks and so forth, but I think we also have an investor education responsibility at the SEC, particularly about those investments that are non-compliant with either the securities laws or commodities laws and so forth. So here we have an asset class, all of these 15, 20,000 crypto tokens. Many of which, without prejudging anyone, many of which are actually something called investment contracts or securities, and the platforms upon which you trade, the intermediaries. They're not like in this building, NASDAQ, that has protections and against fraud and manipulation and the like.
Just seeing people lose their shirt on with NASDAQ stocks.
You can lose because there's risk. There's risk in investments, but what we try to do as a society is take some of the fraud and manipulation risk out of the markets by regulation.
Is that the problem, though? It's not necessarily Bitcoin, the underlying asset, but more the froth and the potential for fraudsters to use it that has been
Well, this is a field, Becky, been rife with fraud and manipulation. And look at all the bankruptcies. And you've had on this set people talking about those various bankruptcies. And it's not just one entity, it's entity after entity after entity. And then investors are just lining up in the bankruptcy court.
What do you make of, this goes to the underlying piece of this, you've heard Jamie Dimon say that he would close it down, that basically Bitcoin you've seen the comments, right? It's not just that he closed down, that he would say it's used by drug dealers and used by folks who are doing all sorts of illicit and terrible things. There's very few things that trade today that people talk about like that. Now, there are obviously frauds and things that happen, but maybe not like this.
Like the dollar is like 100 times more.
Well, I know that's your perspective, but I'm just I'm curious how you think about that.
That's true, though. This is how much has been money laundered with Bitcoin. This is how much. This is Bitcoin. This is dollar.
Yes, Joe. But look, here's the Jamie Dimon quote. The only true use case for it is for criminals, drug traffickers, money laundering, and tax avoidance. I know, but we have a guest.
That's his opinion.
We have a guest, Joe. What is your opinion? And what is your opinion that we have something trading on the exchange for the public that has this type of use case, at least as described by the president of one of the largest financial institutions in the country?
It's the leading market share in ransomware, and that's publicly known. Right. It's the token of choice for ransomware. Joe, if I can say, the U.S. dollar, the euro, the yen, you have the whole society using it as a medium of exchange. We buy our cups of coffee, as I see here. Right. We get paid in dollars or yen or euro. And you have a whole central bank and support for one currency generally per economic region. That we don't have here. So there's a very real economic difference.
Which is part of the attraction, since it's decentralized, and you can't have a profligate central bank.
It's not that decentralized.
Well, I know you're saying because of the ETS, but really it is.
No, it's not that decentralized, because look how finance tends towards centralization since antiquity. Right. So what do we have? We have a handful of 3 to 6 core so-called crypto
I understand,
exchanges.
but the asset itself, the way that
that's how the
distributed
accounting ledger.
Right, that's how the ledger. And
now, how many times do you have people on this show that say, "I want to invest in something because how the books and records are kept"? I mean, Joe, really? It's just an accounting ledger.
It's a ledger that everyone has, and can't be double counted. It's almost immutable. That's why people think it has.
So you trust it more than an Oracle database, or you trust it more? I trust it more than a lot of.
The Bitcoin bulls say they trust it a lot more than the central bank that enables the fiscal authorities to spend money to the tune of $33 trillion.
That's everybody's investment choice, but
and then I think about how many things can be used in a deleterious way. Of course, but that has nothing to do with the underlying thing that you're using itself. I mean, I can go run a car into a parade and run over 40 people. That doesn't mean we shouldn't have cars, does it?
No. You should have cars.
I wasn't going to use guns because God, I don't want to trigger, so to speak, anyone on the set. But
when the use case of a particular thing that you're buying and selling as an investment is just speculative investment.
How many of the 90% of the people that own Bitcoin are using it for ransomware? There must be another use case that makes it so attractive to so many people.
Speculative investing.
Right, speculative investing. That's what. Okay, let me ask a separate question, which is just to pivot this, because I think the next sort of order event question is what happens to Ethereum. For those in the crypto world, they all want to know how you're thinking about that. And really, if Ethereum is a security, how does that analysis differ from how you would think about Bitcoin?
What we did in January was cabin to one set of filings. We have other filings, you're absolutely right, in front of us, but I'm not going to prejudge it for you or the audience. That's something that a 5-member commission discusses and reviews.
Let me ask you a different question, which has to do with indexing. So much of our market is focused on indexes. And you focus historically, or at least the SEC's historically focused on individual securities, right? Individual companies and the like. I'm curious, whether you think that the system as it is today actually is working in the right way, meaning a lot of the valuations today you could ascribe to the fact that certain securities are in certain indexes. It relates to what's happening to Bitcoin, by the way.
So it's a great innovation going back decades ago. Jack Bogle, and
right.
As you know, you probably interviewed him when he was still alive. Invented this idea that you could democratize finance, that rather than buying individual stocks, you can buy the basket. Why buy the needle when you can buy the haystack, he would say. And so it was very cost efficient, and it's a way the American public can really participate in the stock market at very low cost. It's also led to some concentration, some centralization in finance, because when you look at the large index providers, if you're in the index or not in the index, it can be very consequential.
And these days it's a handful, but the other piece of it is, these days it's a handful of stocks, which often represent a majority of the entire index.
The reason
That's
you're
also,
Gary,
that's
the
also
reason you're
related
looking
to individual value.
The reason you're looking for the needle in the haystack is to find the needle. Get rid of all the hay. I mean, who wants the haystack? That makes no sense.
Well, but actually, economists, Joe, I mean, you know this, have studied it.
But I thought about it. It's like
the safety.
No, but they've studied it that you get the benefit of diversification.
And Vanguard does not.
500 guesses.
Vanguard doesn't have a Bitcoin, right? They didn't.
Vanguard is not doing it yet.
They didn't. They're
the
not
only
doing
ones really, the only of the biggies that didn't do it. Correct?
Yeah, I don't think Vanguard. Actually
Well, they're not. They were not. They did not submit an application.
Right.
Do you expect, if we're all sitting here at this table together in a year from now, that this dozen or so approved ETFs, that there's only like 2 or 3 gets even more concentrated, or do you think that there's going to be, dozens of these things?
That's really up to the market to decide. But what you saw when this happened is fees came down dramatically. There was a bit of a investors benefited because there was a bit of a competition there. Investors also benefited from better disclosure, because they had to do things called registering with the Securities and Exchange Commission on those products. And investors got the benefit of any surveillance by the various stock exchanges. But again, these are highly speculative, risky assets in which to invest.
Let me pivot again to a big headline that happened actually last night. We just talked to the CEO of the company. I don't know if you were watching, CEO of Lyft, just moments ago. That stock popped in this remarkable way, in part because in the press release, they had an extra zero on their margin for the quarter. What does the SEC think about something like that? Is that something where you'd fine a company for that kind of mistake? Is that something where you say that's part of the business? Obviously, investors who bought on that, it might have been algorithmic trading. I want to actually talk to you about the impact of that as well.
Okay, I think it's a responsibility of companies to ensure that they put out information to the public that's accurate. And I can't speak to that one matter. I don't even, you're telling me something I learned about a half an hour ago. But in general, companies are supposed to put out accurate information to the public.
But when they don't,
If it's an accident.
let's say it's an accident. Let's say a correction happens immediately. We can take Lyft out of this. I'll say that the Sorkin, Quick, Kernan and Co. We accidentally put out a press release.
Especially.
Kernan especially. We put out a press release accidentally with some misinformation. We corrected it within 10 minutes. It was clearly not intentional on our behalf or on our part. Is somebody from the SEC calling us today and saying, "Hey guys, we got a problem. We're gonna have to send you a fine"? Like, how does the SEC think about these things?
Let me see if I can just generalize and pivot to artificial intelligence. I gave a talk yesterday up at Yale about this. And so it's sort of like, what is the liability or responsibility of somebody using an AI model, and the AI model might hallucinate.
Right.
And look, we really don't want our advisors hallucinating on mushrooms, and you don't really want your advisors to hallucinate with AI. There's still a responsibility to ensure that you have accurate information that you're putting out. And with the use of AI, that you have certain guardrails in place especially if you knowingly know that it might
What
hallucinate
if it
or
was just a
know that
human
it
error,
might
though?
front run in a market.
I mean, that's an interesting idea. This morning I was looking at it, and it was algorithmic trading that bought into this. Most humans didn't react fastly enough, or quickly, wouldn't have reacted quickly enough. If you had a human eye checking it over, you might not have thought it was rational to have a 500 basis point increase in your projections for your margins.
And Becky, I think, and again, stepping aside from that one event last night, I really just learned about it. But whether it's a mistake or whether it's intentional, because also you could have people trying to defraud the market by putting out fake news releases.
Right.
Sure.
And you know, so bad actors have a new tool to try to defraud the market, and that it's to protect the public from that.
How much empathy do you have or sympathy do you have for algorithmic trading, though? I mean, if it's...
Well, it's a tool. It's existed, algorithmic trading has existed for decades. It's getting faster, less latency, and it's also getting more sophisticated. The math is getting more sophisticated. And so if you're deploying a model, you want to make sure that the model has certain guardrails, really to protect your bottom line and to protect the market.
Let me ask you about another big topic that we've been talking about for the past week and a half now, which is the ruling in the Tesla case around governance and the compensation that Elon Musk was paid. And I'm curious about it because part of the ruling goes at the idea that the board of Tesla was quote unquote not independent, even though that these quote unquote independent directors were supposedly independent, that they weren't, and that they therefore did not negotiate in good faith, and that when they then endorsed this compensation agreement, the shareholders effectively, I think the judge would say, I don't know if she would use this word, were effectively defrauded and therefore voted with misinformation. What say you? Because I think part of it is all of these companies are trying to comply with the rules around independent directors, et cetera, and where's the SEC play in this?
So the matters you talked about, I'm not going to speak about, but generally, those matters are a matter of state law and state corporate governance. The SEC has some role with regard to corporate governance about the disclosures around executive compensation, the disclosures about the controls of the company and the like. But those matters that you're speaking about really are generally a matter of state law.
But to a large degree, that case was about defrauding investors, shareholders, that I would assume come under the purview of the SEC, and whether they're being provided with the right information, because underneath this entire case is this idea that these directors are telling the public that they're independent, but in fact that they're not. And is the SEC supposed to step in those roles and say, you know, here's a problem here?
Again, I hope the viewing public understands that as the chair of a law enforcement agency, I'm not going to speak about any one circumstance, one company, and certainly other people's cases in state courts. But yes, you're right, the Securities and Exchange Commission is a disclosure-based regulatory agency, and it's about ensuring that the information is accurate, material information. There's not omissions, and that we protect the public against fraud, manipulation, whether it's in these securities or it's in, yes, Joe, crypto securities.
Okay, I got a more complicated one for you, and I don't know the truth of the matter, but there have been lots of reports, mostly in the Wall Street Journal, suggesting that Elon Musk is taking illicit drugs. I don't know if this is right or wrong or otherwise. The question I have, though, is the SEC supposed to look at this? Is somebody supposed to look at this? Is someone not supposed to look at this? Is the board supposed to look at this? How would you think about it? No, I'm serious. You run this governing body over investors, and I think there are some investors who are trying to understand what they're supposed to think of these articles.
Look, again, I understand you have a role to play as a very talented on-air financial journalist. I've got a role to play. It's also chairing a law enforcement agency. With respect, I'm not going to be pulled into that, but we are disclosure-based. That companies discuss their material risks, that investors get to decide based on those material risks whether they want to invest in that company or sell the stock.
should companies that have CEOs that use illicit drugs include this in some kind of warning? No, I'm just asking the question.
Privacy issue.
I don't know.
You know how many drunk CEOs there are that get up first thing in the morning?
I'm not here I'm not sure the stories are even.
All of Silicon Valley is experimenting with hallucinogens.
They may be.
You should have maybe at some point.
I probably should have.
I'm not kidding. You get to know yourself.
It might help my ability to do this show.
Introspection. Yeah.
You mentioned hallucination. I'm going to come back to artificial intelligence. It makes it easier. But like, if a company is using artificial intelligence in a material way, it's really about the bottom line, their prospects and the like, and that program has a tendency to hallucinate. They have to consider those risks and whether it's a material risk to invest.
Can I just say, the last time I heard you kind of come back to an issue that you were very centrally focused on was crypto. So this sounds to me like you are issuing a message. The reason you're here today to talk about this is you want to issue a message to any company that is going to engage with artificial intelligence that they will be held responsible for any problems with that AI.
Well, in two ways, Becky. It's in, if you're an investment advisor giving advice to the public, or you're a broker dealer using it, to remember you still have a responsibility to put your investors ahead of the advisor or the broker dealer. So that's a conflict issue. But also, if you're using it, that you still have responsibilities not to defraud the public. And so that's about sort of having some guardrails to make sure you don't front run, meaning take an investor's choice to buy or sell a stock and try to get ahead of them, put your interest ahead of them and so forth. So yes, I do think that that's important because regardless of the tool you use, whether you use a hammer, whether you use just a little bit of algebra, or you use artificial intelligence.
But it's not okay to blame a dumb AI program that did something we weren't anticipating.
That's right. You don't blame a dumb hammer if you're using that to defraud somebody. I'm just trying to say AI is a tool, but when you use that tool to do bad things.
Oh my God! Now the AIs, it's okay for AI, but not Bitcoin.
Well, how do you see them?
No, I'm just saying. You'd say it's a tool, but if you use it to do nefarious things, then then you're saying it's not AI's fault. Well, it's the same case. You just made the same case for Bitcoin.
With Bitcoin's a non-security, but if
now you're splitting hairs again.
No, I'm not, Joe.
And for every Jamie Dimon, I can raise you one Paul Tudor Jones, one Larry Fink, one Stan Druckenmiller, one. I mean, I'll raise you all. Peter Thiel, Mark Andreessen.
They don't run the SEC.
I think we've established that Joe is not merit neutral.
Chair Gensler, they're playing the music, but I do have to ask you one other question, which has to do with ESG. There's been a remarkable backlash on it. Even a backlash around disclosures around climate and some of these other metrics that you've been talking about. And I'm curious how you think about that, because you're seeing it from different states and investors, pension funds and the like, and it's become political.
Andrew, if you look at the top 1,000 companies, sort of the Russell 1000, about 90% of them are already talking about climate risk somewhere in their annual filings. A little over half are already disclosing something around their emissions, greenhouse gas emissions. I think therein lies a role for the SEC to help bring consistency, comparability in that decision usefulness. But we are not a climate regulator. We are not a climate risk regulator. We're a securities regulator.
Right, but there are some companies now that are scared to disclose some of their pledges or other things, because if they do, which you would say they should.
No, I do not. We just
then they're saying that certain states, Texas, Florida, and others are going to say, you can't do business in our state, or we're not going to invest in you, or what have you.
Andrew, there are many companies already making those disclosures, and if they're material, you have to make sure that they're accurate and they're not misleading. That's the same role as whether it's about the executives, and it's the same thing about these risks if they're material.
Okay. This has been fabulous. Come on back to the table again. It's great to see you in person.
Good to be with you,
Thank you very much.
Becky.
Chair Gensler, thank you. Squawk Box, coming right back.
Well, this Valentine's Day, if you're looking for love, you might find some help through the use of artificial intelligence. Julia Boorstin joins us right now with her latest installment of AI Impact, which looks at how the cutting-edge technology is driving change when it comes to dating. Julia, happy Valentine's Day.
Happy Valentine's Day to you too, Becky. So the global online dating market is expected to grow by more than 2.5 times to hit nearly $24 billion by 2032. And some new AI tools are a key part of that growth. A startup called Nino is an AI chatbot that offers customized relationship advice with funding from Sequoia. The CEO, who previously ran Tinder, says that this is a new category of relationship tool helping users figure out how to express their feelings or set boundaries. Take a listen.
Nino is nothing like the movie Her. It's not a fake girlfriend. It's not trying to be a therapist even. It's more like the Remy in Ratatouille, which is, instead of helping you make incredible soup, it's teaching you all about having great relationships.
Another chatbot called Blush from a Khosla Ventures-backed AI company called Replica. It looks like a fake girlfriend or boyfriend. It invites users to interact on a Tinder-like platform with virtual characters, which it says aims to teach people how to practice flirting and communication. Now, this is not just about startups investing in AI. The public dating giants Match and Bumble are also using AI to bolster their businesses and also to protect their users. Match tells us it's using AI to upgrade its ability to make matches, to improve users' experience, setting up their profile and picking photos, and also for post-match prompts that suggest specific date ideas based on you and your match's interests. Meanwhile, Bumble uses AI in its deception detector to identify spam, scam, and fake profiles, and they say they've reduced reports of them by 45% with these AI tools. They offer users as well AI-powered icebreakers, which are customized based on their profiles. So Becky, these AI dating tools aren't about curing loneliness with a virtual significant other, but rather about deploying all the learnings from data to get people to go meet up in person a little faster.
Yeah, I was just trying to think, this is almost like the Cyrano de Bergerac, right? Like whispering in your ear what you should be saying or thinking or typing to maybe make a better impression if it's an icebreaker.
Yeah, I mean, I think the whole idea is that, we've all thought about going to our friends and asking for advice on how to manage a situation, relationship advice. But here, you don't have to go to a friend. You could go to the chatbot. They get smarter. These chatbots are designed to get smarter, to understand who you are, what you like, and then to give you sort of customized advice based on that. But they all say that the goal is really to get people to do better when it comes to digital dating, so then they can go meet up in person. And they're trying to get you to meet up in person faster rather than having conversations on these apps for a while.
Yeah, it's making us all a little better, I suppose. Julia, thank you.
All right, coming up, tech stocks dipped after yesterday's hot inflation data. We're going to dig into that move with Gene Munster. That's coming up next.
Welcome back to Squawk. Yesterday's hot January inflation data prompting a sharp drop in tech stocks. Joining us right now with more on the sector is Gene Munster, managing partner at Deepwater Asset Management. Has the calculation or valuation issue changed given what we're seeing in terms of CPI? And then obviously what I think folks think Jay Powell is actually no longer going to be doing anytime soon.
Andrew, I think it does. I think it pushes back what that inflection point is. I'm a believer that we're going to get to a 3 to 5 year bull market here powered by AI, but investors need to get on the right side in terms of when we're going to see these rates start to go down. Expectations now, I think, are for June, and my sense is it's probably going to be later than that. I think this is just the most sticky part, and I think is a good reminder to inflation does matter in the near term with tech stocks. And Andrew, just to emphasize this point, it may seem subtle to push back a window by 2, 3, 4 months, but if we look back at 2021, different environment, rates were going up at that time, but the Mag 7 was down 32% in the 6 months from October of 21 when those rates started to peak. And then if you look at the emerging tech within the NASDAQ, that was down 70%. And so rates do matter. I think investors are still off sides when it comes to when to expect some of these cuts. It does dampen some of my enthusiasm because, as I mentioned, I'm very bulled up about where this ultimately is going to go. But investors need to right size when these rate cuts are going to happen.
Given what you just suggested, then, what do? You want to own none of this? You just want to wait? What do you? And when would you be in?
So I think that it is wise to be mostly in now because, again, I think we're going to this 3 to 5 year bull market. We talked about the negative lever related to inflation, but there is a massive positive lever related to AI. And investors have struggled about how to kind of capture and guess what the impact is going to be. And my sense is that you need to put this on a spectrum of AI and its impact and other paradigm shifts. And I would put the PC at a 20, mobile 25, the internet 50, electricity at 100, a scale 1 to 100. Electricity is at 100. AI is 99. It would be 100 if it not for you need electricity to power AI. So when you have that perspective, when I have that perspective, and I think about what's going on with these interest rates and inflation and where investors are in the near term, I think you can get kind of misled into worrying about what's going to happen over the next 3 to 6 months. And ultimately, if this is as big of a paradigm shift as I think it is, even if it's half as big, I think we could see the NASDAQ move up considerably, 2x in the next 2 to 3 years.
Okay, different question. We were talking earlier about the Instagram post and Facebook post that Zuck put out about the Meta Quest 3 versus Vision Pro. I said I think for right now I agree with him. I think it's I think for the use case they may be the winner, and for most people who can't really afford $3,500, it's a pretty great product at $500. What do you think?
I think at this point it's a good product at $500. I don't think it's mainstream. They've sold, call it 8 million units before. The last 6 years leading up to Quest 3, they've probably done another 1 million units since that's come out. And so I think it's good, but I still don't think it's still such a big gap between what Vision Pro is. And of course, there's a big price gap. It's a 7x price gap there too. I would just sum it up that I don't think it's mainstream yet. I don't think Quest 3 is mainstream. It will be the alternative to Vision Pro. And I will put another stake in the ground here, is that over the next 5 to 10 years, spatial computing, whether you call it spatial computing or the metaverse, is going to be something. Meta's got a lot of work to do to catch up to even get close to where Apple is. I think that they will help close that gap, and I think they will be the spatial computing metaverse device for 80% of the world, and Apple's going to own the 20%.
Wow. Okay, so that means but that would be like being a winner. I mean, a lot of people are sort of writing off Meta, and I think I've been saying the whole time is you may think that the Vision Pro device is better, and technically in so many ways it is, but when you add the weight and the cost and all these other things, and then you look at this other product, you say to yourself, okay, maybe, at least for now, and it could be like an Android.
I think that's the right analogy. That's exactly how I think about it. This is Apple versus Android. In this case, Meta's going to have control of the 80%. Google, really, Samsung, they're nowhere to be found here. And it is just surprising to me how how slow that they have been to move here. So I think that this is an advantage to Meta. As Meta shareholders, I wish they wouldn't be spending $15 billion a year on Reality Labs. I think that they could accomplish what they're doing for half that much. But they are, I think, this is a force of will of Zuckerberg. When Zuckerberg puts his mind to something, so he's going to have a device that's going to be good enough to capture that 80%. And once app developers, of course, start to make progress, I think you're going to see more of this adoption curve. It's going to take years to get there, but it's going to be Apple and Meta when it comes to spatial computing.
Gene, very quickly, I just want to make sure I heard you correctly. What were you saying? You think AI is going to push the NASDAQ to 2 to 3 times the level in the next 2 to 3 years? Or did I mishear that? Because you're thinking NASDAQ 30,000 to 45,000 in the next 2 to 3 years?
I believe we're going into a 3 to 5 year bull market that is going to end with a bubble. The bubble will burst, but I think we're in the front end of that 3 to 5 year bull market. If you look at what the Qs are trading at now, NASDAQ's trading about 28 times. It peaked at 100 times back in 2000. Now, because of the weightings of the mega caps, we're not going to see, a 3x return here. But if I'm right that this is, in fact, much bigger than what the internet is, you can build a case that there will be capital rushing in to enable this AI, and you will see a bubble emerging. And so whether it's a 2x or a 3x, I don't know what it is, but I do know that AI is going to be transformative and power the market higher.
Yeah, you will be able to track that. Gene, thank you. Always great to see you.
Thank you.
When we come back, we're going to speak with one of the key voices in real estate, Richard Lafrac. You don't want to miss that interview. It is next when Squawk Box returns.
Crash courses.
Fed Chair Jay Powell says issues in commercial real estate are manageable, while Treasury Secretary Janet Yellen recently said she doesn't expect commercial real estate to cause systemic risk to the banking system. Joining us now with his take, Richard Lefrak, CEO of real estate giant, the Lefrak organization. I don't use that term loosely. Not many people have a city named after him, Richard. You know, like Lefrak City.
Well, it's very kind, Joe, to be so generous with your appraisal of my value.
Well, you've got. I mean, if I absolutely need an apartment, I think I could probably come to you, and I could find one in. One in New York City.
It's true. By the way, you know, before we start, I want to just say one thing, if that's okay. That I was listening to your guests about, you know, the inflation stuff, and maybe this is a headline before it hits the paper, but I've noticed in the last 3 weeks that apartment rents are starting to firm up again.
Really? So that's we can talk residential or we can talk commercial, but you know both, obviously. And how do you account for that? If
everybody's working.
Everybody's working. And then why is everybody working when they've gone up 500 basis points? It's all a very hard thing to sort of figure out, isn't it?
And we have a real estate crisis in the midst of an economic boom. Doesn't make any sense.
Very straight. History only rhymes. So tell me about commercial real estate. That's what we want to talk about, though. Tell me all about New York City commercial real estate and where we are.
Well, you know, of course, everybody knows we've had this sea change in terms of occupancy. You know, work from home, all the pandemic derivative problems have come home to roost. And in addition, this abrupt increase in interest rates, which is really unprecedented other than 1981, 82, when Volcker was fighting inflation, just turned the whole industry on its ear. And right now, we're in a kind of unvirtuous cycle because nobody knows what anything is worth. And because they don't know what it's worth, it's hard to get any kind of financing, which is really the oxygen of the business. You know, commercial real estate lives on debt. And, you know, if debt is unavailable, it's just a complete, you know, guess as to what these buildings are worth and what the value is.
Is it a long-term sea change post-pandemic, Richard?
Well, you have had many visitors who come on the show and talked about, you know, work from home and how long it's going to take to kind of sort out who's coming to the office and when they're coming. There's definitely been an improvement in attendance in office, you know, in office attendance by employees and everything. But now AI is on the scene, and, you know, then you hear numbers such as 20-30% of the white collar jobs are going to be eliminated. And so when you get all finished with it, it's just a big, vague bunch of facts. And the only real fact that's hard today is that there's no money available, really. There's no liquidity in the business, and that there's going to be severe losses suffered by equity owners and also some financial institutions.
We've talked about, you mentioned that you're seeing it firsthand that, you know, the last point to 2% for the Fed might be difficult given what you're describing right now. Were there a lot of, what's that expression, pretend and, you know, and extend and all those things? There's a lot of that we know goes on, and if anybody was waiting for rate relief near term, they might have to put that off a little. Why have we avoided even more trouble in commercial real estate, and are we going to be able to avoid it if rates start climbing again?
Joe, well, first of all, there was something called, I would call a crack in the real estate business, which was low interest rates. And, you know, that a lot of those loans are starting to roll off now. And so people got by because they were borrowing money at 3-4%. That same money is going to cost 7 or 8% today, or even more. And so the reality of the problem is going to kind of be more obvious. And I think that part of that is, you know, you saw Janet Yellen, you saw the head of the Federal Reserve, both speak to commercial real estate problems in in the last week or two.
Right. So at this point, what's looming ahead? Are we looking at like just the tip of an iceberg? I've got a lot of metaphors here, Richard, but is that how you see it, or will time take care of it?
I was going to actually start this whole discussion with the GoFundMe page that I need for my business. No, I mean, yes, we're going to see more and more problems emerge in the next 12 to 24 months. And if you look back in history at the financial crisis, which was the last big mess in real estate, it took 3 to 5 years to kind of work through all the problems. So I don't think there's a magic bullet. I don't think that lowering interest rates 50 or 75 basis points is going to make that much of a difference. You know, I think this has to work its way through the system, and there's going to be winners. It's going to be losers.
Richard, I think one of the questions that people have is this like a slow rolling situation that hurts but doesn't kill? Or is it the kind of thing that could be both slow rolling but reach some kind of terrible inflection point where confidence, completely and utterly rushes out of the system for some period of time that really is painful?
Well, I think it's both right now. I think you described perfectly the two dynamics that are happening. People have lost confidence, and that's why there's no liquidity and no transactions occurring. Even the distress funds have not been that active yet because they don't know what anything is worth. But at the same time, this is not going to be a moment in time where everything blows up. It's just going to be kind of dull pain that continues in the system until it sorts its way out. And you're going to be talking about this in a year or 2 years too. It's not going to change. Unless magic interest rates return to 3% and everybody comes back to work 5 days a week.
Have you been surprised, Richard, at there's a lot of narratives on why we got so much inflation and what happened, whether it's supply chain or 33 trillion in debt or the fiscal, whatever you want to attribute it to. But and I don't know where you stand on we got an upcoming election and there are different policies. There's pro-growth policies and then there's Keynesian policies. Were you surprised? What kind of economy do we have right now? Is this real?
We have a good economy, but we have some inflation embedded in the economy, and it's it's become a hot, the topic du jour for the last year and a half, and people are sensitive to it because the average person is going to get hurt by it, so that's politically not viable. And I understand their thinking, but there will be a lot of derivative problems in the banks. There's going to be a lot of losses in the real estate business. I mean, I've seen estimates as high as $1 trillion. Now, how people get to these numbers, I don't know, because they must have some system of evaluating things that I'm not aware of, because it is a local business and every market is different. I'm sitting here in Florida now. Florida is kind of semi-booming, and there are other places, some of the blue cities in the Northeast and the West that are really suffering more.
Well, I don't think you're ever not prepared to act on something that's very compelling. And will there come a time where you have the will and the financial wherewithal to really go into commercial real estate?
I'm going to have some fun. My entry in the Florida market, which was about 10 or 12 years ago, was all based on the financial crisis and trouble, and it was an opportunity for me and my company to come down and start investing heavily down here. And yes, the market will overreact. There'll be great opportunities. I mean, there is allegedly hundreds of billions of dollars in these rescue funds or distress funds, and they'll start acting, and there'll be some basis of value that is established.
Have you been over to Mar-a-Lago?
I was only once. I was there for Mrs. Trump's mother's, unfortunately, her funeral. So
yeah, okay. Just figured I'd throw away.
I live in Miami, so Palm Beach is a long way from here.
it's a long way, you know, and getting all those commercial flights from these places from one to another, it's very difficult. I know, Richard. Good to have you. Good to have you on.
It's great to be back, and looking forward to seeing you all again soon.
In studio when you come up.
You call me out of a cave when things are bad, you know.
Exactly. Final frack to talk about this. No, it's good to have you on, and it's been too long. We'll see you again soon. Thanks. Squawk Box will be right back.
.com.
A little more than half an hour till the opening bell on Wall Street. Joining us now on the markets is Stephanie Link, Chief Investment Strategist, Portfolio Management at Hightower Advisors, and a CNBC contributor. Stephanie, I don't know whether your point of view on the market changes, but just looking at the reaction to the 10-year yesterday, it's something definitely, the whole mindset did change with that number that we saw yesterday. Did it change your view or your approach?
No, not really, Joe. We were kind of due for a little bit of a pullback, and we could probably just be more volatile and trade in a range for the next couple of weeks as we digest everything. But at the end of the day, we are making progress on inflation. We went from 9.1% at the peak to 3.1. Okay, so it wasn't 2.9, which is what we wanted and what we were expecting, but we are making progress. And I think when you step back and you ask yourself, why are we seeing inflation and why is it so sticky? It's because growth is better than expected. GDP is running at 3.4%, and that's much higher than what people had expected. And that's good for earnings, and that's good for the bottom line, this better growth. And so I think we just have to kind of step back. We have had a nice run. The last 13 months, we've seen 26%, 29% in terms of the S&P 500 growth. And so, okay, well, maybe we just trade around for a little bit.
What if the Fed decides that it has more work to do in terms of cooling off the economy, and not just that's what it needs to do to make more progress on that last mile of inflation?
Well, I mean, I think that's what the market was trying to figure out yesterday. I think that the 6 cuts was absurd to think about. Is it 3 cuts? I've been out visiting with advisors. Some people think there's no cuts this year. So I think at the end of the day, we have to wait and see. We're going to be data dependent, but but I think earnings are still going to run the shop, if you will, and be important. And that's the most important thing for equities at this point.
Yeah, if the Fed, in fact, and there are certain indicators that say they are restrictive, but I've had someone arguing with me today that they're not in restrictive territory yet, and it's clear from what's happening with a lot of risk assets and everything else that they're just not. They might think they were, so maybe we don't get any cuts. Steph, we got about 10, 15 seconds is all for you to respond.
If we don't get cuts, I think we have more downside and more volatility, but I think it's a buying opportunity.
Okay. We will check back and get some individual names and sectors because we'll get a chance to do that again. Stephanie, thank you. Happy Valentine's Day. Is that red? Steph's in red. Final check on the markets. A quick look. You can see that we're still in rebound mode, at least a little bit. 108 points now on the NASDAQ. I don't know if we have a chance to look at the 10-year. That's something to keep an eye on again. We were above 430 earlier. There is the 10-year. Bitcoin above 50, above 51. Make sure you happy Valentine's Day.
Thank you, sir.
I already have
Valentine's Day to you.
We already have some, but we can be sort of junior Valentines with each other. Make sure
you got flowers coming?
Nothing coming.
Good Wednesday morning. Welcome to School Up in the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. How much can the bulls get back after the worst day for the Dow in almost a year? Worst for the Russell in almost 2. Yields are lower today. 10-year still above 4.3 though in Cisco earnings tonight. Our roadmap begins with stocks seeking a rebound after that drop. Investors now pushing back rate cut expectations until June.
Plus, shares of Uber and Lyft are both rallying ahead of the open. Lyft says it expects to post positive free cash flow for the first time this year. Uber authorizes a $7 billion stock purchase. As I said, both are up. Airbnb shares also on the move. CEO Brian Chesky saying the company plans to expand beyond its core service with the help of AI.
Let's begin with the markets. As we said, the Dow coming off the worst day since last March. S&P not as much going back to January, but obviously, Jim, some call it, in fact, it was the former president of the Boston Fed today, said it was an overreaction.
Well, I don't know if it's an overreaction. We've been up just nonstop since the beginning of November, and I think a lot of people just said, well, wait a second, we've got things like ARM, which are just too crazy, where you've got a short squeeze. It's too much like GameStop. ARM became GameStop, and one company is a growth stock and one is kaput. I find that there is a level of enthusiasm that went too far. And I'm not saying everything's going to be Tesla, but Tesla's tended to be like what can happen, which is you get too far and then the future's just okay. We'll see what happens with Airbnb. Do you really buy Uber for a buyback? I mean, don't you buy Uber for growth? Yes, you can add a 0 to Lyft and suddenly have a huge number, but then it comes back down. But it's kind of indicative of what I see. I had Harley Finkelstein on last night, Shopify, one of the great growth stories of all time, and the stock gets hammered. Datadog, there's mixed, the terrific quarter mixed. So what I'm leading up to is the idea that, look, things are good, but can we just keep paying higher in an environment where interest rates are not going to, where the Fed's not going to cut? And the answer is that it's a little more problematic to keep paying higher for the same earnings and the same sales when, David, what happens is we don't get a cut.
Right. Although the same earnings and the same sales, I mean, people are willing to pay more still for growing significantly higher earnings and sales.
But more, it has to be more than expected.
Right. Which it has been for many of the companies that we cover closely, and certainly the biggest.
48 hours.
I mean, mixed picture for the Mag 7, but at least a few of them have been.
Right. Well, I'm just saying, the last 48 hours, you've had a bunch of companies that everybody loves, and they did the number, and they didn't raise. I mean, you know, look at Cadence, upgraded today. Cadence, by the way, is maybe the most dovetail partner to NVIDIA, and they did not raise. You have a second dovetailer in the data center in Arista, and they did not raise.
Was that expected that they would raise guidance?
Absolutely.
So there was an expectation they would raise guidance. Neither of those companies did. Haven't seen
Correct.
their
And some
what
people-
they're going to be, what their opens
A
look
lot
like.
of people
this
feel
morning.
that they've slowed and that there's this air pocket. And I've got to tell you that both Cadence and, geez, Arista did say, be aware that there might be this kind of overhang where a lot of stuff was bought.
Look at that chart.
Well, that's what I'm getting at. Do you want to come in now and just say, you know what, I am so early to Arista Networks, I got to pull the trigger? Does that look like early? That does not look like early.
No, may not be. I would have no idea.
Ooh, no, you would.
Wow, look at that. Even 3 years. Pretty nice.
Well, this is what the fourth best performer since the S&P went from 4,000 to 5,000. So you've got these stocks that are priced for beat and raise, and instead you get beaten kind of, well, let's wait for a raise.
So
That's not good enough.
are you eyeing the NVIDIA quarter with caution?
Oh, geez, there was a note today. Now, guys, been not that great. But we did have a note saying, listen, NVIDIA could just do the number plus only $1 billion. And so I hear that and I say, oh, Jensen Huang, does he really have to do $2 billion to consider? Well, then I think that NVIDIA is going to have a very big long-term run. I just think that it's possible that you could have an NVIDIA that it was like the July to December NVIDIA of last year, when we forget, where I would get stopped on the street and said, thanks for nothing, NVIDIA.
Right.
Like, why did you name your dog NVIDIA? I said, well, I named my dog NVIDIA when the stock was 50. I mean, like, you know, he answered NVIDIA in the end when I told him when he had a piece of steak in my hands. That thing just jumped when I said NVIDIA.
So is it your sense that expectations just continue to ratchet up for NVIDIA, making it very difficult for it to hit a high enough bar to send the stock even higher from here?
I think that when you look at what Mark Zuckerberg's doing, he's buying all the NVIDIA he can get. Everyone's buying all the NVIDIA he can get, but here's an issue. Maybe you can't make as many H200s as you want to. And if you can't, then maybe they can't sell them. I don't know. I think that...
Really? You don't think they can sell them? Come on.
No, I'm saying you can't sell something you don't have.
Right.
I mean, maybe these are, you consider it and say, well, look, we can come out and say our order book is filled. But maybe you get a dynamic which is led by, say, a Frank Slootman, right, who is saying at Snowflake, we have a lot of people who are really questioning why they should pay so much for these when we don't really know the why they need them. And then you had an amazing call last night. The stock will be down. I don't think it should be. Brian Chesky on Airbnb, basically just throwing cold water on what people think is AI. You know, saying it's basically a modified Google search.
Well, this ties in with the journal piece about Copilot yesterday.
Yeah.
This piece in the Information, Jim, with the CEO of Databricks, suggesting that the price of GPUs will plummet in the next year because, like internet broadband constraints in the early 2000s, they loosened up in a hurry.
Well, I just don't know how that can be true, because when you talk to the people in the bowels of NVIDIA, or with Lisa Su and the AMD people, the demand from whole countries is too high. I mean, you know, Jensen did this tour. All sorts
Right,
of
well,
countries.
we made the point yesterday that there is potentially going to be significant demand from sovereigns,
Right,
from
so
countries,
how do you decide
because
that
they
there's-
want to develop their own AI strategy, so to speak. And he was, again, as we pointed out, in the UAE and touring the
Do
region.
you think he was in sell mode, or do you think he was in explain mode?
Well, I
Why
think you can be in both, maybe, right?
Well, Jensen is a master salesperson
First I'll
without
explain,
realizing
and
he's
then
saying
you'll
it.
want. And so there is the possibility, and we talked to Stacy Raxon yesterday from Bernstein, who's PAX and sort of the chips and a lot of them, saying, yeah, it's very possible there will be more demand from sovereigns. That's not built into a lot of models.
Well, I look at what Jayshree Ullal and the amazing Arista quarter is talking about the M&Ms.
Delicious.
Not at Microsoft. But it is Valentine's Day candy. I did not buy my wife a bag of M&Ms for Valentine's Day.
How about a Baconator? You're going to buy her that, maybe?
I hadn't thought about that.
You might
That's
want
something
it.
that shows love.
It does.
Yes, right? Tonnage of love. I just find that the number of companies that want NVIDIA and accounting NVIDIA would mean it so that that's just sensational. That's self-motivated. You want it to plunge. Why would you let it play? You can go on Google. You see how much these things cost.
By the way,
what?
Look at the bottom there. Look what's moving again.
Oh, well, we know David, that's an ARM. That's a shortage caused by people selling calls. Hey, thank you, Redburn, for explaining why
yes,
it's a
Redburn
squeeze.
did a nice job.
Wasn't that a nice piece?
They did a nice job of explaining the short squeeze
Yes,
that
they
we
did.
said it was.
Redburn being
We
a
were little late
research
on that.
firm.
Yes. And pointing out 104% for trading days. And by the way, just think about the estimates in terms of where the stock is now based on its valuation. 64 times enterprise value over EBIT.
Right.
That is an 80% premium to Cadence.
Which is the, it's very funny because Cadence is, well, Cadence is one of the best performers the last 10 and 15 years. I do find, Carl, that everyone wants to find the next NVIDIA. I would say wait till next week and you're going to get NVIDIA all you want. There's your chance.
There is a nice little upgrade of HP today, Jim, basically rhyming exactly with your thesis the last few months that the refresh cycle from things we might have bought during COVID in the way of PCs, then the new generation of AI-capable PCs is going to drive what is the second biggest PC seller.
You're going to see AI for consumers. By the way, I think that before we trash suddenly Copa, that's going to be AI for the consumers. Now, if Chesky's right from Airbnb, all it is like, hey, tell me what hotel I should stay at, which he's saying that's not sophisticated enough, and that would show you that AI is not what we think. I don't know.
Do you use it regularly yet in your daily?
I have used it for summations.
But you don't use it do you use it every day?
Do I use it every day? No, I don't.
Yeah,
I use it when I'm stumped, and I use it for guests, where I just say, oh, shoot, I got this guest on. I got to find out whether I'm missing something. I use it to double check. I don't use it to create. I use it to say, all right, am I off base? Now, fortunately, we don't have to interview politicians, but anytime I've interviewed someone where there's a political angle, I go right to it and say, I need 5 questions about the politics and the CEO of X. Because I want neutral questions, and so far I think that AI does not really have a bias.
Still, it's something you wouldn't have done a year ago.
Oh no, not at all. I would have said, oh my God, I gotta go look at I gotta Google 5 articles and 10 this, and no, I just go and I say, okay, what does Jim Farley think about, I don't know, what's going to happen in the future with the Cybertruck?
Yeah.
And then overlay that with the credits. The credits going to continue, and then overlay that with China tariff, and give me what people are saying. That kind of thing. Is that all right? I mean,
yeah, that's fine. I'm just curious as to how you're using it during your day.
Well, I say, how bad is
our own work habits are going to change over time. For me, it's not until it's really readily, easily accessible.
Right.
As you say, via my PC, perhaps, where I just speak to it and it tells me what I want.
All right, I'll go for a step further. Until my daughters tell me how to use it better. My daughter uses this Adobe.
It's usually how it works.
She's got the subscription Adobe. There isn't anything that she doesn't send to me.
It used to be about setting the clock on your VCR. Now it's
yes, yeah. How do you program my VCR? But when I go to my daughter for what she's doing with Adobe, I think it looks like Broadway show, what they used to do with the marquee.
Yes.
I don't know. David, what does Jonathan say? Oh, I'm not allowed to mention his name.
No.
I'm sorry. What does Robert say?
What's his name?
That's Kevin saying. I don't know.
That's fine. Making a quick internet search, most likely they'll probably have a social security number in 5 seconds.
When we come back, we will hit the rally in the ride-sharing companies, but that major earnings release with Lyft last night sent those shares on a wild ride. Hanging on to gains, though. We'll take a look. Take a look at the futures as well. Not a lot of data today, but Goolsby in about 15 minutes, and then Barr after the bell. Back in a moment.
AstonWill.com.
It's a terrible thing. It is an extra zero that slipped into a press release. And, you know, thank goodness we caught it pretty fast and we issued an immediate correction.
That's Lyft CEO David Risher on Squawk this morning talking about that company's earnings release error last night. Initially said the stock soaring more than 60% in after-hours trading, Jim. It was about margin growth, 50 basis points this year, not 500.
Yeah, I think that this will be SEC investigation. We're trying to figure out whether there was anybody who may have been involved in some sort of chicanery, which I don't think is the case. And then you'll take a look at all the people who bought it during that period. They got a decent lawsuit, even though it was after hours. All that said, it's a shame. It was a real good quarter.
Bookings up,
real good.
Yeah, bookings up 17, not as much as Uber's, but still revenue up, positive free cash flow this year.
Yeah, Risher came on Mad Money. He's a delight, by the way, and just, you know, he's taught more people to read than anybody. He spent years after Amazon just working on literacy in Africa. I mention that only because sometimes there's a little bit of context you got to put for a guy. But he did a Connect Women initiative, which worked. And he's doing an airport initiative for On Time, which has been terrific. David, I think that the ultimate takeaway is when you look at Lyft and you look at the buyback you know, from Uber, what you can say is this is still one of the great growth for us.
Overall growth.
Ride share.
Ride shares. Yeah, I mean, Lyft, better than expected take rates in the fourth quarter, marketplace efficiencies. I'm reading here from an upgrade to neutral at Moffett-Nathanson, which got it wrong. They got it wrong.
Yeah, but they said in the first sentence they got it wrong.
Yeah, they did. High margin revenue stream in the fourth quarter, exceeded revenue for the entirety of 22, and demonstrated better than expected cost discipline. Speaking of cost discipline, of course, Uber has been sort of buying into that whole year of efficiency.
Uber's terrific.
We told you about the $7 billion buyback. They had an investor day ongoing today. A lot of different metrics introduced, but you know, a lot of the main ones are, as you might have anticipated, in terms of free cash flow conversions, staying right or perhaps being as high as some would, the bulls would say 90% of adjusted EBITDA growth, 30 to 40%. And the stock also reacting quite positively, in part to that buyback, first ever, from the company at this point, and you know, continued growth, continued focus on cost, and not to mention what generative AI is going to mean for them at some point down the road.
Oh, sure. By the way, let's go back to the Airbnb. Same thing, a gigantic buyback. You know, Carl, we never bought these stocks for buybacks. We bought them for growth. I wonder whether there won't be a cohort which just says, do you mean to say that the best thing you could do is buy back stock? Aren't you visionaries?
Well, it's being framed as you get back to operating profit, a positive upper net, positive free cash flow, then you start capital returns.
Yeah, that's
Isn't that how
true,
it's supposed to work?
and that's what Meta's doing, big buyback. And by the way, Nvidia's got a buyback. I just think that when I look at what Airbnb wants to do with its platform, I would think it costs more than they're saying. They can become the ultimate destination platform. When I think at Lyft, I would like Lyft to be doing more than just doing ride share. Now they're going to be cash flow positive. And then, of course, with when you talk about Uber, I mean, I want Uber to become, you know, to wipe out Instacart. David. Wipe out Instacart.
Uber is the giant. I mean,
they are.
I mean, come on, Lyft, and you can't even compare the two, really.
No, but
in any way, when you're talking about a company, again, the bulls would say could do as much as $9 billion of free cash flow by 2026.
So therefore, it's worth it because they do have an asset-light.
They have an
asset-light model. They have an asset-light model.
But you throw a multiple on $9 billion in free cash flow 2 years from now, discount that back, you still get to a pretty decent price.
No, you're right. I'm just saying the old days is what we know. The year of efficiency changed everything.
Yeah.
When Zuckerberg, okay, let's just put our cards on the table. Zuckerberg is cool.
By the way,
is it the hair?
We'll talk about the whole
Vision
Pro product review.
You want to be his pal now. You're going to go down there and do one of those Musk interviews next year. Are you working on a Musk interview with Zuckerberg right now?
Zuckerberg.
Just tell me.
What?
Are you working on a Musk interview or Zuckerberg, a Princess Bride interview?
Oh, I've got them all going. All very close. I'm a text away from nailing both of them down.
I knew
In fact, together.
Carl, I knew it.
Together.
He works, you know when he's not, you know, that 11 o'clock that you do?
Yeah, the best show of the day?
Of course, he's a booking magician.
When we come back, we'll get Kramer's Mad Dash, countdown to the opening bell. A lot to get to. Kraft Heinz, Hood, got some news on Disney, Walmart calls on Ulta and Citi. In a minute,
NBC.
We have 7 minutes before we get to the opening bell here at the New York Stock Exchange on what Jim and I still like to call Hump Day. Time for a mad dash. Robinhood we hadn't gotten to.
Hey, listen, Friar Tuck. This was actually a pretty good quarter. And I'll tell you a couple reasons why. One, they actually have a trading group of people. Now, David, if you're a trading group person, then you're not going to earn that much on your account. So you're not getting that 4 to 5% that some of these other brokers have to give, and that even Schwab, which is doing much better than people realize. But these guys have trading balances that they make a lot of money off their customers. At the same time, crypto is 20% and options is 60%. That is, in the new world, what young people do. So they've got a young bias. They have a couple new products that work. They've got a gold subscription that people like that is gives you a little more things for your money. David, I like the quarter.
Yeah.
And I like the fact that there are younger people coming in and not just buying ETFs, which just say, listen, you don't know how the hell to pick stocks, so why don't you let us pick stocks? We have an ETF that is good for shovels.
But is it any different, what the young people are doing than what they're doing on FanDuel? Or any of the other betting platforms?
No, it's more like DraftKings.
Okay.
Where it's daily fantasy for stocks.
Right.
And if you play Kelsey, you make no money at all. But if you play Hardman, that's like a call on arm. You're so right. I may have to do that piece. Which is better, putting the money on Hardman? He's the guy who won, by the way. Or do you put the money on options on, I don't know, let's say Tesla?
Right.
So the answer is yes, you're dead right.
All right, well, maybe they'll, who knows?
By the way, Jason Robbins runs a darn good brokerage. And how much does he make on that money that you've got in your account?
That's a good point as well. All right, we got 5 minutes till the opening bell, and don't forget, you can always catch us anytime and anywhere. Listen to and follow this Walk on the Street Opening Bell podcast.
All right, guys. So I finally tried Apple's Vision Pro. And, you know, I have to say that before this, I expected that Quest would be the better value for most people since it's really good and it's like 7 times less expensive. But after using it, I don't just think that Quest is the better value. I think that Quest is the better product, period.
That's Zuckerberg reviewing the Vision Pro, Jim. It's all fair game to do your review, even if you have a competing product.
He actually had some things that were good to say. He didn't trash it. I think he was ironic about it. I think that David, he was kind of playful. But his most important thing that he said was he buried the lead. You can't get the Ray-Bans. Sure.
Right. There's also the Ray-Bans. He was being filmed, not with the Ray-Bans, but with by a colleague who was wearing the full set, which is lighter. And if you watch the entire video, he obviously says that he thinks it outperforms the Vision Pro in many different areas. I did find Zuckerberg here so much more natural than I'm accustomed to.
Well, that's what I'm saying. Maybe put a few plans behind him and we really got it there.
But, you know, he has this robotic way oftentimes of speaking, but not now.
He's been freed.
Yeah.
It's incredible.
Like a normal person.
That is Zuckerberg. That's not his digital twin, right? That's him.
I think it was effective. People were watching, and it was interesting to listen to.
I mean, dare I say, Carl, that there was enough, I'd say, sardonic, but not cynical attitude that made it fun to watch.
Do you agree that the Vision Pro is not as good?
I happen to love the Vision Pro. Yeah. I think that the Meta Quest is very good. Here's what I look at. I would say that, you know, my kids work, and, you know, my kids aren't rolling in it, that it's a Toyota, and I think that the Vision Pro is maybe a Lamborghini, not necessarily a Lexus.
Yes.
You lower the price so it's not a Lamborghini, and I think you get more buyers. Although I had a hard time trying to get an appointment this weekend to try the Vision Pro.
When are you getting yours? Sorry.
Now I have to delay it because I have to find time. I'll probably get it on Friday.
And what about the Meta?
Have it.
You have it?
Yeah.
What do you have?
The Meta, the 3.
You do?
What's 3? Yeah.
Okay.
My kids like it, you know.
And good. Okay, so you'll be able to give us your own product review.
Yeah, well, look, I mean, remember that my one daughter has the glasses, one daughter has the 3, and they're, you know, I got gamer, you know, the gamer daughter has the 3. I mean, games are interesting and exercise. She does yoga, and, you know, that's, you know, her kind of, that's her milieu. And my other daughter is a baker. But she loves Instagram, Carl, and she just says, look, it's a great dovetail with Instagram. It really is.
We'll keep an eye on it. Obviously, exciting times in hardware. By the way, at the opening bell, here at the big board, it's New York Cares. At the NASDAQ, it's Fibrobiologics, celebrating a recent direct listing. Back within 15 points, Jim, of S&P 5K. Today, Wells comes out and says, you know, the interesting thing about yesterday was the pop in the VIX, and that history would suggest, given that expected, in their view, first half volatility kick, maybe you're due for an overall 5% slide.
Well, I think that what happened yesterday, you had everything go down, and now we're going to start looking at things that are attractive. Interest rates are behaving today. What I don't want to see is that the money gravitate toward oil and gas, because that's been creeping up, and there's some very good stories there. So I would hope that the rally does not just concentrate there. I want to see the financials. Financials were really tagged yesterday. And so I'm a little worried about that group. Less than tech's had a big run. Financials were really kind of nascent, positive.
We are on the lookout for a lot of post-CPI Fed speak. We mentioned Goolsbee out a few moments ago. Let's get to Steve Leisman. Hey, Steve.
Hey, Chicago Fed President Austin Goolsbee, in remarks being given right now, is saying that the Fed should not wait until inflation is at 2% over a one-year period in order to cut rates. He says you have to have confidence, but he can have that confidence without the one-year annualized rate being at 2%. Higher inflation, he says, for a few months is still, he says, consistent with being on the path back to a 2% target. Again, Goolsbee being the first Fed official to comment since that hotter than expected CPI yesterday. And he says the decline in housing inflation, remember it went up yesterday, is, quote, not as fast as expected. but the CPI housing data is at odds with the market data, which we've been talking about, and he says he's watching that difference there. He says it's important not to judge a trend from a single 1 month's number, and the CPI and the PCE, which is the one the Fed follows most closely, can sometimes differ significantly. Just a couple more comments here. He says the current policy stance is quite restrictive, and that real rates, or the inflation-adjusted rate, is, quote, as high as it has been in decades. If you're not getting the point here, Goolsbee seems to suggest the Fed ought to be moving soon. He says maintaining the current funds rate will create concern about the employment side of the mandate. Two more things. He says productivity has rebounded and could have profound implications for the economy, and he also sees inflation expectations as anchored. Carl?
Steve, thanks for that. And we're not done, by the way, for Fed Speak for the week, Jim. Waller tomorrow is going to be interesting because he was in some ways the tip of the spear for rate cuts.
Right. Look, I think that I heard for the first time today someone on air say, look, if anything, you need a rate hike. And we need some clarification from people just saying, yes, we're still on the course which says we're watching more for a slowdown. I don't think any of these numbers, I asterisk the renters by talking about the migrants and the government's being able to rent all over the country. Governments are renting because of the huge influx, 8 million people. But I care about unemployment. And if unemployment were to go to 4, if we see some big bankruptcies, there are a couple of retailers that I want to mention that are indeed teetering and have liquidity problems, you'll start reading about those layoffs. Without layoffs, I think that we're just on hold, and I don't care what these guys say.
Are you willing to, at this point, to guess if we retest 4.5, let's say?
Only if we have just a gigantic failed auction. We got our guy Josh Frost in there.
Yep, who you've been a fan of.
Oh yeah, that guy's fantastic. I mean, he's a hero of mine because he actually he speaks to 100 bankers and he realizes where the demand is, as opposed to just saying, all right, here we go, let's do some 30 billion of the 10-year. David, we have pros in Treasury who are trying to make this so that interest rates don't spike, and they have more to do with it than the rent figure in the CPI.
Well, it's not an unimportant position that gentleman has.
Yes.
Because we have been very focused on those auctions for obvious reasons, and they can be dislocating for the market.
I once asked Bob Rubin about the auctions when he was running Treasury.
Yeah.
And his answer was very interesting. He said, it's not anything we should ever gain.
Ever
gain.
Yeah.
You want to say, look, this is how we do it. We're going to look and see how much we can make the most money for Treasury, and we're going to do that. We're not out there trying to figure out how to not hurt, being meretricious and rapacious as opposed to being prudent.
Understood. Did you see that story yesterday? Walmart maybe buying this.
Oh, I'm so glad you brought that up, because to me it said that if I were people running Roku right today, I'd be running scared.
Well, Roku did react to it yesterday.
Yeah.
Today, Roku shares, at least a moment ago when I looked, they were up a bit.
Oh, yeah, that's great.
Take a look at Walmart.
No problem.
I mean, one read on it from Morgan Stanley's analyst who covers it is that it's all about advertising. Walmart's the largest retailer, of course, in the U.S. We know that. But it has purchase data on what they say is roughly 90% of households, at least to some extent.
Yeah.
And so ownership of a distribution platform, remember these are all connected TVs these days, of course, could help it grow its advertising business. And they're talking about $3.5 billion in revenue this year, or excuse me, last year, could be as much as $6 billion by 2025. Now, for a company like Walmart, that's still an incredibly low number in terms of revenues, but those are high margin revenues, as we know from Amazon when it comes to advertising.
Yes.
And, that can help drive some earnings growth potentially.
Yeah, but you would turn it on and you would be able to see Walmart.
You'd get Walmart Plus, and you'd probably be right connected in there, not to mention, obviously, they get to see your behavior in other ways and share that data with their advertisers.
Right. Well, I don't know about your Walmart, David, but my 2 Walmarts, when you walked in before the Super Bowl, the deals on big screen TVs reminded you of, it's like buying a 25-inch Sony from Best Buy right now. I mean, it's a 65-inch. Walmart offers such incredible value on TVs that I would be shaking if they walked this in. I mean, they're like $240 for a 760-inch
To the extent
screen
that
TV.
it's really about leveraging their advertising business.
It's going to be very
so
powerful.
it becomes like a razor. I mean, they'll sell you
Exactly.
the razor for nothing.
Well, like right now, I turn my TV on, Carl, and I go to it sends me to Samsung. I've never clicked on that thing ever, and never will.
Mine comes up every time.
Samsung?
Samsung TV comes up,
that's
and it's
what I
all
want.
these procedurals with all these actors, you know, but I never watch them.
They need money, the actors.
I can't figure out how to get rid of it.
I know, but you start. I can't either, and it drives me crazy. It's like I say to my kids, first it sends me to a piece of art. I'd like a painting. Sends me to a painting, which I really don't want. Right now, I got a painting of the Adirondacks. I think it's Rocky Peak Ridge.
It's like forensic experts. They're always
And then I go to Samsung and I say, well, this is worse than. This is like a fire cop show.
Where do these
I mean,
things-
what is it?
Who's paying for those? Samsung? I gotta understand the economic model behind Samsung TV
You know what they
shows.
probably do? I'll tell you what they do with Samsung today. They're probably saying, what's the economic model? Like the top brass. Anybody know what the economic model is?
Listen, I'm
yes,
glad
we
it's
see, we made America know who we are.
It's employing actors, so that's good.
Interesting, Jim. Speaking of Walmart, Evercore today, tactical underperform.
For Target!
We see potential near-term downside due to what we believe is likely to be conservative guide tone on the consumer.
What heresy?
On February 20th.
Look, I think that they're loath to be able to say the consumer's not doing well. 3% yield, 17 times earnings.
Really? Even after McDonald's or others say
Well,
North
that's a very
America?
good point, but you know, I think that people are turning against. They don't regard healthy food at any value, and I say that because when you talk to Jack Hartung at Chipotle or Brian Nickel at Chipotle, they'll say, "Listen, the $40,000 a year customer is buying the same thing as the $150,000 a year customer." At McDonald's, I don't know how much. You know, Burger King, by the way, had really good numbers. They really good. Patrick Doyle was on last night. They had the best growth in burgers. David, Burger King's back.
Burger King is back.
Yes,
Really? I
because
didn't-
they did this refuel the flame.
Didn't know they'd gone anywhere.
I said that to Patrick Doyle too.
Did you?
I said, are you telling me this is like when you first took over Domino's? I had breakfast with him before the campaign. He goes, you know, Jim, I'm thinking about doing this campaign which says that Domino's tastes like shirt cardboard. I said, geez, I don't know how well that'll go over. He said, why don't you watch it? It was the most brilliant campaign ever, right? So listen, you know, we were losing the shirt cardboard, and corrugated tastes better than our banana peppers, you know? And then boom, best performing stock of the generation.
Well, as we think about the consumer health, this piece in the Journal, Jim, about auto insurance and how transitions to delinquencies on auto insurance annualized is the highest in 13 years. We saw this in the CPI yesterday.
Why stop with auto insurance? I mean, every kind of insurance is so high. And by the way, I don't know if you've seen, if you try to get a healthcare policy and you're an individual, a self-proprietor, I mean, your entire profit goes to it, and you've got like a $500,000 deductible.
And now you got the tax refunds are coming in late. Fewer refunds, lower refunds, fewer filings year on year so far. It's only a couple weeks in.
Biden better send us a $1,000 check before this election.
Excuse me?
Biden better send each person a $1,000 check for the election. And someone else did that. It's novel.
It's an idea.
It's an idea.
Or you could just own NVIDIA.
Thank you.
That's a wealth creator as well.
Thank you.
NVIDIA, our usual check on it, up 1.5%.
Versus what? The company that Bezos sells $2 billion every night?
Well, I would make the point it continues to move up the market capitalization.
It's because Jensen's not selling $2 billion every
It
night.
is now 1.8 trillion. It has passed, as we pointed out, Amazon, in part because Amazon shares have not moved up as much of late. And it is approaching Alphabet's market value. It's only about 20 billion away. You can make that up in a matter of minutes. So, yeah, NVIDIA.
What has Alphabet done for me
quickly
lately?
moving into the top, let's call it 3, right?
Well, what's Alphabet done? How was that last quarter?
Alphabet is up 4.4% for the year.
Oh, Waymo.
Yeah.
Go Waymo.
It
Go
doesn't-
Waymo yourself, David.
Is Alphabet going to surprise us with its cost discipline at some point, or
What,
is it going to truly lose its
the year
grip
of
on
in-
search? Which way is it going to
I know
go
they're
here?
doing a year of inefficiency, apparently.
Year of inefficiency.
A year of living safely and fat. Neil Gibson, Linda Hunt.
Yeah, Linda Hunt.
Fear of living
Fear of living
dangerously.
dangerously.
I mean, look,
Is that Linda Hunt?
Linda Hunt.
Linda Hunt.
I
Yeah,
think
Linda
just
Hunt.
not recognized as one of the great
She
movies.
Oscar nom for her.
And
Fantastic.
Yeah, and Mel Gibson.
Well, they were not living. Google is not living dangerously. They're living safe and happy.
I'd say
Cloud had a
just the
brilliant
opposite.
number.
They are living dangerously.
Well, they
They're
are
like,
in terms of their stock.
let's
Google
do
Cloud
this.
had a great number, and everything else was so convoluted. You didn't even notice that they had a great number. Well, David, Toyota Motors down. That's the first time that's happened in ages. There's the stock.
Oh, that's
Toyota
just
Motors.
Jim, by the way, looking at the tape, which is what he does nonstop.
Well, it's kind
you
of
go
like-
see Jim up in his office.
I like to look.
He's
at
just
the
looking
tape.
past you at the tape.
What I love is waking up at 5 and seeing a tweet from him an hour before.
Yeah.
Well, I was late that day. I was
looks at
late
the
this
tape.
morning. The other day I had one at 3:15. That was much better.
Toyota's had a great run, though, in part because,
It
as
has.
we've said many times, on the strength of hybrids. Did you guys read the journal story? I
What,
mean,
the chart-
encapsulating much of what we've
How
discussed
quickly they charge?
in terms of the changing demand for EVs and what's gone on there. I mean, your friend Jim Farley, in terms of reacting to it.
Look at you first.
Don't hear
Jim
you talking
Farley,
about
my
the
friend.
F-150 Lightning as much as you once did.
Well, because you see, it's not doing as well. What do you want me to say?
Yes, that's exactly what I want you to
Because there's a lot
say.
of inventory.
That's what- thank you.
But yeah, and I can blow up my friendship anytime I want. Okay.
There's actually some global EV data today. Month on month, Jim, January down 26.
Well,
and that's a lot of subsidy cuts in Germany,
Yes,
France.
yes.
Not to mention Chinese New Year, China weakness.
Right, and BYD can. How many can Mexico buy? 33% of Mexico is EV from China. Here's what I think is going to happen.
It's gonna be
If you
even more.
if you
It's gonna be even more.
It'd be well because I mean there's a 55,000 person Pueblo VW factory.
Sorry, I interrupted you. Tell us, what do you think is going to happen? You were just
Okay.
going to say.
Thank you.
You're welcome.
Okay, so let's say you get a gigantic, tectonic, critical election where the Democrats win. There will be a governor who says, okay, we're not having any hydrocarbons in our cars by 2029. And then
Who's
that's
gonna do
it.
that? California's already. Come on. California's, where are they? Anybody know? 2035?
Yeah, but I'm saying they got to do
20, I don't know.
No, I'm saying they'll do some radical thing, and then that'll be in. That's it. Then that's it. Everyone's going to have to go EV. I'm saying this is a tectonic shift election. If that happens, then I think that there's going to be states that say, look, you got to go buy a new car.
Really? If you don't have a charging infrastructure and you're basically subjugating everybody to like not having enough power for their cars.
Have you seen the taxes in California? Do you think that they're not afraid to do something radical? And
They've
nobody
already
leaves.
done
Nobody
something
leaves.
somewhat radical.
Nobody
They've
leaves.
Well, they do leave.
Where? Where do they go?
They go
They
to
stop.
Texas.
They stop.
go to-
Oh, well,
and
yeah.
They do.
Okay.
They leave.
You look at Eaton. That's a subsidy for Eaton.
I mean,
one of my favorite
California's
stuff.
amazing. It's like got 40 billion people. It's still what the world's.
It's the fifth largest
fifth
economy in the
largest
world.
economy in the
I'm
world.
just look. I'm positing that if you have a green election in our country, that there could be some states that make it so that they're the ones who decide.
Do you think New York 3 last night suggests that's in the offing?
Well, that was interesting. No, I don't
By
know.
the way, Morgan Stanley Jonas note today, just back from easily the most bearish of our Tesla Bull Bear lunches.
Didn't you love that?
Some doubt sales grow at all this year. Most see consensus falling and AI, quote, off the table for now.
I love
Doesn't
that
sound
piece.
good at all, does it?
Tesla
Although he
versus
reiterates
Magnificent
overweight.
Six.
Right. Well, that's just clients basically
Yeah.
showing up who are all negative or talking, you know. And
Have you noticed the stock of
and as
Tesla
we all
stock
know,
going down?
most hedge fund managers and they know
Stock,
nothing.
Tesla's not going down anymore.
No,
Stock's
Tesla's
stabilizing.
not going to stabilize.
I think that I'm not. I think the fanboys are going to buy the Cybertruck, but I think that Tesla's next generation is going to be coming. It's going to be huge. It's going to be huge. I think the last thing we had was Steve Scherr talking about how it didn't work for Hertz. But the next generation could be huge. We need to. If we can get 10-minute charging stations,
is it going to be able to compete effectively with BYD in markets other than the
I
U.S.?
think
Because
BYD.
obviously that will
I
not
think
be allowed here,
BYD is
most
scary.
likely.
I think BYD is scary how inexpensive it is. But then again, the PRC is trying to put people to work.
Well, it's not just the inexpensive. Apparently, it's a fairly high level.
It's a good car.
Of automobile.
Yeah, that's what I keep hearing.
That's
over and
Buffett,
over.
right? Buffett's.
Yeah.
It was, right?
Was,
What's-
yeah.
Oh, I'm hearing great things about it, but we're not going to let it. Neither president. Look, we have a union president, right? The guy who walked the picket line against Ford. He's not going to let China come in. And then we have Trump basically saying, listen, we have a $500 billion business with China. That goes to zero. Zero, because the 60% tariff would go to zero.
Yeah, we'll keep an eye. Obviously, as Jim has pointed out, the election's getting folded into markets by the day. Dow up 63 here, back to 49.80. Watch bonds, as we said, pretty much a data-free day. But these Goolsby headlines a moment ago are interesting, and we'll wait for Barr this afternoon, Waller tomorrow. We're back in a minute.
I'm a member.
Keep an eye on Kraft Heinz today. Beats by a penny. Revenue misses, though, as does adjusted EBITDA. Organic up only 7/10. Street was looking for 1.3. More signs of disinflation as North America pricing up 2 versus a 5 handle in the prior quarter. We're going to talk to the CEO later on this morning, and we'll get Stop Trading with Jim in a minute.
Oh boy.
Asset.com.
Let's get to Jim and stop trading.
Okay, so one of the things that's been quietly happening is GE just keeps going higher. Mostly it's been because of engines for aircraft, but today GE's Vernova, which is about to be spun off, which is the energy business, there's a lot of green energy. They just got approved. GE's nuclear fuel business receives regulatory approval to manufacture higher enrichment fuel. People just love anything involving, small reactors, anything involving any way to be able to make nuclear fuel work in the nuclear industry work.
Okay, watch this is green.
My hat is really off to Larry Culp. I mean, he did, my chapter's on since GE Healthcare. It's been a rocket lately. And
Looks like we're having a hard time breaking
I
resistance.
just think he really has the zeitgeist, and it's not just for show.
I wonder what you think it said.
GE being talked about. Good morning. They're all flagging out. SPX flagging out. We got the SPY getting ready to flag out. 1, 2, 3B. QQQ. SPY kind of broke out a little bit into an ascending triangle. Damn, that's kind of big. 5. Okay, QQQ just broke out. We got a double top coming up. Then we're going to see what happens here. Could have been a good flush out yesterday because it was so big and so fast. SPX double top. Broke out, maybe. $49.83.17 for that one. SPY's got to build resistance above $4.97. IWM, the Russell 2000, just now hit support for the third time. We've got PLTR, volume high. I'm liking PLTR a lot, especially when it comes back and hits support like that. Tesla, double bottom on Tesla at support, 183.82. NVIDIA at 740. AMD back to support, back to resistance. And where's SMCI? God. Those people are nuts. I shorted this yesterday. Now we're up a new high. Meta. Yeah, yesterday's numbers didn't hurt the market none. Netflix, and then we had KO earnings. Netflix new high. Get pins on here.
That's one of them, you know, but it's different methodologies. But at that owner's equivalent rent and the shelter component of CPI is so big, it's like a third of the price. And that's why the Fed, I think, pays more attention to PCE. It's why it's been trending lower as well. There's also this political report you were watching about Powell.
Yeah, yesterday Powell apparently did have a meeting, closed-door meeting with Democrats on the House Financial Services Committee. That's not unusual. He goes up to the Hill a lot, Powell.
It's not unusual?
Both sides. But what
are you serious?
Some people are focused on is the fact that whatever it may be he said, and we have at least some quotes from one rep who was in the meeting, you know, that they're going to be waiting for PCE to give them more intel, but didn't get particularly excited about the hot CPI number. And the market yesterday, while it did end down sharply, rebounded right around the time that meeting ended. We all know that House members do like to trade stocks. So just interesting going around that story. At least we do know the meeting took place, but we obviously don't.
Just another reason they shouldn't be able to trade stocks,
don't
perhaps.
know what was said or anything. But when you do look at a minute by minute of yesterday's S&P, you will see sort of right around 3 o'clock, 3 or so, a rebound.
And that goes with the narrative that the Fed always knew it was going to be bumpy, getting from 3% to 2%. It wasn't going to happen in a straight line. They weren't expecting it to happen in the straight line. They want to continue to see progress and not go the other way. But this is one data point isn't necessarily enough. While we're on the topic of inflation, and because it's Valentine's Day, I made this crazy chart of cocoa prices. I don't know if you guys have seen what's been going on here. The price of cocoa, the commodity, has basically gone parabolic. There's the 5-year. It's doubled in the last year. It's at an all-time high, well, 47-year high if you want to go back to the 70s here. There's been extreme weather in West Africa, and that has damaged a lot of the cocoa crop. It's where cocoa comes from. Ivory Coast, for instance, has been a huge problem. At one point, the dealers weren't even putting it for sale. I mean, and a lot of people think it could go higher. I pointed out to just show you that we still have, you know, thanks to weather and other issues, these kind of inflation anomalies. This is something the Fed cannot do anything about, by the way. This is purely the weather.
Yeah, they are.
That's why you're going to continue
They
to
tell
pay
the
higher
government to
prices.
stop spending.
I talked to Hershey CEO this quarter about it, Michelle Buck, to Mondelez CEO. They make Toblerone and other chocolate.
Man,
goodies.
Amazon would have been a good catch
It's
this
one
morning.
reason why Hershey's earnings are supposed to be flat this year, and why Mondelez is still talking about price hikes in an environment where most
It would have been a tough
consumer
one.
goods companies are going lower. So
See, that would have probably scared you, that
Valentine's Day
candle.
chart for you there.
Both of them.
Well, you know,
But these two wouldn't have. This one,
Yeah.
they're all
Chocolate?
kind of bearish.
Right. But it also has health benefits,
It does, but
especially dark, which is my favorite.
Yeah, it is my favorite too.
You know, also because it's Valentine's Day and there's so much love in the air between Travis Kelce and Taylor Swift.
Oh, God.
Another company.
I love you, Sarah.
I said that Taylor was the new buzzword of the earnings season. Another company mentions Taylor Swift in an earnings release. Forget the strong dollar.
I love
forget
your
the
nose.
Weather, forget. Last
No,
year,
yeah.
Lyft says fans flocked to stadiums with these rides growing by more than 35% year over year, driven by high attendance stadium events, including Taylor Swift and Beyonce concerts, the U.S. Open, and football games. Just added to the
She
list
definitely doesn't have a
of
boxer
Ralph
nose.
Lauren, Disney, a number of companies mentioning Taylor Swift. Here's my favorite, NBHC, National Bank Holdings. It's a small
I was just thinking right
Colorado-based
now.
bank. Very unlikely mention of Taylor Swift as well. They had particular.
You know, I'm sitting here thinking, okay, I come to the market late. Usually I get here right about open, a little bit before it. So what do? How do I trade the market coming in a little bit late? So I got to go back and think. You know, I got to wait for the pattern to show up. Wait for the market to tell me when to trade. Something will show up. See, maybe like this is an ascending triangle, or it could be an upward wedge out of a snake, which means we could come back down and double bottom or create a shoulder line and bounce off this support. So I'm going to put an alert right there. It hit that number, so I'm going to get a little bit above it. Oh, no. Hurts. Oh, come on. What the? Yeah, I'm acting real slow here. No, that's not. Thought that was brighter.
Rates are back to normal. 4% is where the bond yield should be, in my humble opinion, given what the economy is doing with low inflation.
I mean, there were also some pop-ups of
watch Apple.
inflation in medical insurance and transportation services. And I mean, I get it that shelter was the big thing there. Food ticked up. The Fed does not want to see those go in the higher direction at this point of the tightening cycle. I guess the fear is if they continue to get evidence that they need to see more evidence to cut rates, if they push it out and push it out and push it out, does that start to have a more restrictive and more harmful impact on the economy and the market?
Yeah, I don't necessarily think so. And by the way, I think we can get kind of lost in the details when it comes to the CPI report. I mean, certainly you could pick out that auto insurance increased, I think, 20% year over year. It was just a high flyer. But I think that when you look at inflation from a monetary policy perspective, you really look at the overall number, and that would be even including shelter. But at least you would recognize that shelter is a bit of a bizarre component that takes a while to come down. But I don't view that the current level of interest rates is going to kind of create a lagged effect, a long and variable lagged depressing effect on the economy. You know, what really in the past has caused recessions has been monetary policy causing a financial crisis, something to break, causing a credit crunch, which is then what causes recessions. This time around, the Fed did in fact create a little crisis there in March of last year, but within 2 days they came up with a liquidity facility, and so we haven't had a credit crunch and we haven't had a recession. I think the economy's doing fine.
I see it right here.
Yeah, as you wrote the other day, almost as good as it gets. Ed, we'll keep track of it with your help, of course, during the course of the year. Great to check in with you. Thank you.
Thank you.
Before we head to break, some big name guests to let you know about in the next hour. The CEO of Kraft Heinz, which is currently the worst performing stock on the S&P 500, post results. The company reporting its third straight quarterly sales miss. We're going to talk to him. Plus, Trian Partners founder Nelson Peltz with us on Money Movers to discuss the ongoing proxy battle with Disney and his reaction to the Disney results and slew of announcements that came last week. As we head to break here, here's our roadmap for the rest of the hour on Squawk on the Street. After overtaking Amazon, NVIDIA's market cap now getting closer to Alphabet. Our next guest says the Mag 7 should be named the Fab 4.
In fact, I think it just passed Alphabet. We'll also take a closer look at the other rate-sensitive stocks, talking about REITs, for example. Are there some opportunities?
And shares of Robinhood soaring, making aggressive moves to get some market share from the rival brokerage giants. What the street is saying about that stock is we're back within 0.5% of 5K. Don't go anywhere.
Jim says no.
Will.com.
Got a news alert. Elon Musk is seeking to pause a ruling on his pay package, according to a new court filing. Musk and the Tesla shareholder who won a verdict last month voiding the CEO's $56 billion pay package are proposing a stay of the pay ruling until an appeal is resolved. We'll keep an eye on that.
Tesla, one of the mega cap tech names our next guest is shorting. Says instead of the Mag 7, it should be the Fantastic Four. NVIDIA is one of the names he's long. And just moments ago, NVIDIA's market cap did top Alphabet, making it the third biggest company. Dan Niles, Satori Fund founder and portfolio manager, joins us now. So Dan, let me get it straight. You're long 4 of the Mag 7 and short the other 3. What's the strategy?
Right. Well, I think if you look at the last couple of years, earnings haven't really mattered. You go back 2 years ago, 2022, they all went down pretty hard. The Magnificent Seven were down 46% in 2022. You look at 2023, earnings didn't matter again there, where as a group they were up 111%, despite the fact that Tesla's earnings for the December quarter came down about 50% over the course of the year. The stock doubled. You look at Apple, similar situation, where earnings for the fourth quarter came down about 10% over the course of last year, and the stock was up 46% or so. So that it didn't make much of a difference. You look at this earnings season so far, and the earnings have actually started to match. Apple's numbers came down on the top line for the 5th quarter in a row, and the stock actually went down. Tesla, similar situation, where that's down over 20%. Google, it's more mixed in the sense that their most important businesses, search, YouTube, owned and operated, all 3 of them missed in advertising. And you put that in sharp contrast to a Meta, where they crushed their advertising numbers. And so that's why you combine that with, Amazon did great, beat operating profits by 20%. You talked about NVIDIA, everybody knows the numbers are going up a lot there. And Microsoft did well in Azure, and so that's why we have the Fantastic Four on the long side, and we're short the other 3.
I mean, the 4 that you're long are very consensus, and they've done very well. You had a great call on Meta last year, ran up more than 100%. So now it's up another 32% year to date. NVIDIA's up another 49%. Does it make you nervous that we're sitting on top of these gains?
SPX.
Trades that everybody likes?
Not really, because you have to look at valuation, which is something that, very few people want to talk about. They just want to say, oh, I love this because of, big subscriber numbers or whatever. But if you look at a Meta, you're right. The stock tripled last year almost, and it's up again strongly, but it's being driven by earnings. Unlike an Apple or Tesla, Meta's December quarter EPS over the course of last year went up about 90%. So there's a reason the stock tripled, almost tripled. And if you look at this year, it's still trading at a 24 PE. You compare that to the S&P at 21 times, you're not paying much for it. You look at an NVIDIA, the revenues this year are expected to grow by 70%. I think it's going to be a big beat and a raise yet again. But you're paying 38 times for it. So it's really hard to say you're in an overvaluation for some of these names. And with Amazon, I think you're going to see the GAAP EPS double from 2023 to 2025. So again, driven by earnings. And then Microsoft, obviously, with Copilot and their investment in OpenAI, which produces ChatGPT, seeing a lot of benefits from that. So I think you have to marry the valuation against this, and Apple's the one I always like to bring up because you've had no growth. You can look at what they guided to for the March quarter. It's the same number that they had.
You've been negative on Apple for a long time, Dan, haven't you? I mean, you haven't been a big fan of Apple's for quite some time.
Whoa,
on that same thesis, hasn't it been that they have no growth, which is true, but it hasn't stopped the stock from going up.
Yeah, and that'll happen. And so that's why I brought up earlier, David, that, you have last year, earnings didn't matter. The year before that, it didn't matter. But if you look at this year, the stocks have pretty much dispersed based on how the earnings are turning out. So, you know, we all...
Burn. So we're looking at SPX. I got... Wow, it's another $7. Look at different time frame. 20-day, 1 hour. That's better. 4988.92. Get my coffee. Man. $4,993 $65. Huh.
Yep, definitely a risk. Although, wow, what a move today, up more than 11% on the first ever buyback.
A lot of confidence. That's what he's doing. He's instilling a lot of confidence, saying that cash flow number is going to jump.
Absolutely. Deirdre, thank you. Deirdre Bosa. Still to come. While yesterday's hotter than expected inflation data,
Sometimes I should just listen to him.
Scenario for the Fed. We're going to lay out what could be ahead. Former Dallas Fed President Robert Kaplan also joins us to weigh in next.
Uber pop. Unbelievable. Sometimes you just need to run with them. That was a mess. Yeah, they were right about this one. It's a pretty good spike.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News update. NATO Secretary General Jens Stoltenberg announced today that European members would invest a combined $380 billion on defense this year, taking spending to the goal of 2% of GDP. The announcement coming days after former President Trump suggested if he were president again, the U.S. might not protect allies that did not spend enough. The razor-thin GOP majority in the House just got thinner. NBC News projects former Democratic Congressman Tom Suozzi is headed back to Congress after he won a special election in New York's 3rd District to replace George Santos, who was expelled. And apparently Valentine's Day and procrastination go hand in hand. Numerator, a market research firm, says nearly half of spending on flowers, candy, and cards happened between February 11th and 14th over the past 2 years. Walmart, which sells nearly 40 million red roses for the holiday, says about 75% of its Valentine's sales occur on the 13th and 14th. But to be fair, that's not procrastination. That's being practical. You don't want to buy roses too soon. They would die too soon. And unlike a box of jewelry, you can't hide that in your sock drawer.
That's well said, Bertha. I tend not to wait too long. You can never be too careful. Bertha Coombs, thanks. Meantime, yesterday's inflation data sparking fears the Fed will have to keep rates higher for longer. What's the worst case scenario for the central bank? Our senior economics reporter, Steve Leisman, has some thoughts on that. Steve?
Yeah, two opposing scenarios are out there, Carl, and they dominate the debate over yesterday's hotter than expected inflation report. The one held by a majority of economists who I'm reading is that it was mostly a blip and that inflation will resume its downward trend. Here's this outlook here. The one-time January price increase is taking effect, for example, things like motor vehicle insurance. Housing pushed up inflation, but will eventually decline. The PCE will be somewhat cooler when it comes out February 29th, in part because it has a lower weighting for housing. Austin Goolsbee, the Chicago Fed president, talking about that this morning, saying that higher inflation for a few months is still consistent with the path back to a 2% inflation target, and that one shouldn't judge the trend from 1 month's numbers. He also pointed to that difference between housing inflation and the CPI and market indicators showing rents falling. But there is a more worrisome scenario, the easiest disinflation being behind us. Sarah talked about that yesterday. The result of supply chain shortages easing, and the last mile from 3 to 2 being a tougher one that could require a hard landing or more economic weakening, as Roger Ferguson, the former vice chair, told us this morning, to get the last bits of inflation out.
The Fed may well have to hold rates higher, staying in restricted territory the longer, and that by definition increases the risk of recession. So yes, my assessment is that the risk of recession has gone up moderately.
Moderate.
So markets reacted to yesterday's inflation report by betting on both later and fewer cuts. That change holds this morning. The year-end funds rate contract rose 30 basis points. Market looking for around 100 basis points of cuts this year, not the 175 it did about a month ago. So that is 3 cuts now have been baked out. For now, the inflation report introduces risk to the coveted soft landing scenario that is not
Uber boing.
Economists, but you can only counter it with better inflation.
People are loving this train. A lot of volume.
The good news is, even the worst case scenario,
New high.
Steve, doesn't really contemplate a rate hike at this point if inflation picks back up. Seems like they're pretty keen on staying pat.
I'm going to double check you on that. You are correct. There is no bid at the moment in all of the contracts for rate hikes. I do see that the lowest thing I have is only the 9% chance of a rate cut in March. That obviously is way down, 40% in May, and it looks like June is it. But one more bad inflation report, Sarah? I don't know. Maybe they get to that bid in.
Thank you, Steve. Steve Leisman.
Sorry.
Really laid out on the scenarios coming out of yesterday's report. Our next guest says a June rate cut is still possible, but no one should prejudge. The Fed is still in pause mode. Former Dallas Fed President Robert Kaplan joins us now. So how would you, if you were still inside the Fed, look at a report like yesterday's?
My first reaction would be not to overreact to 1 month. However, I would be on guard and vigilant that we need to see continued improvement in inflation. I don't want to see a resurgence, and I'd want to see at least 2 or 3 more months of inflation data. And one of the reasons, as you and I have talked before, that I'm particularly on guard is fiscal spending is very stimulative. Inflation Reduction Act projects, Infrastructure Act projects, unspent ARPA money. So I'd be very focused on service sector inflation. I want to see that improve, and some evidence it's going to get sustainably better, and I'd need to see more information to see that.
You have been more vocal on this point than anyone I know, and it's interesting that the Fed, I mean, I get they don't want to talk about fiscal policy, but has been pretty dismissive of the idea that the fiscal impulse is still boosting the economy and potentially boosting inflation. How does it work? Where do you see it show up in the data?
So there are goods and there are services. One of the things that is helping us on goods disinflation is China being so weak. China's got lots of overcapacity. Their economy has been well publicized, is very weak. That helps with goods disinflation globally. The part on services that's trickier is if you've got billions and tens, hundreds of billions of dollars being spent on new battery plants, infrastructure projects. You still got the unspent ARPA money. That's being spent all through the United States, and it creates a bid for not just goods and services, but particularly workers. And so it means in the service sector, they're still struggling in all my conversations to keep workers. They're having to pay workers more. These projects create a bid away for workers. The other thing you saw yesterday is the housing market, and it's got its own dynamics in that there's a supply issue in many cities of housing. The labor challenges are part of that, and also for new home buyers, rates are high, affordability is an issue, so they've got to rent, and so there's a lot more rent pressure.
So should they not be thinking about or talking about rate cuts at this point, with the economy doing so well and inflation not back down to 2%?
Well, I think they're now probably in the right spot. I'd say in December, after the meeting, there was too much optimism. They've walked it back. You got to remember.
Okay, we might have found a support right here.
SEP, Summary of Economic Projections, said 3. That might still not be a bad estimate. I just think because of the fiscal stimulus, the starting point.
Blah, 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 blah. Watch SPX right here for support level. If it doesn't hold, we could drop easily back down to the shoulder line. So, where are we? The 5,000 strike. Real close. It's trying to make up its mind right here. The 5,000 calls are up $25, 205 I think. I could have got in at 190 actually, but now they're at 240. Yep, that would have been a good one. On that engulfing candle. That'd have been a pretty good one.
Does it matter if the Fed cuts in June or July if we've already seen a pretty
Okay, we're
pronounced move down
retesting
in
right
market
now
rates?
on the SPX.
Well, as long
Bullish
as
retest.
the view is the interest rates are not going to go up. If it's going to come down, whether or not it's
The 5,000
this year
strike
or
at
delayed till the
220.
end of the year or next year, I think that's fine. We just need to see some stabilization in interest rates.
But to be clear, when it comes to commercial, particularly office, I mean, we haven't put the bottom in yet, have we?
I would say it's definitely
What
a
time is
bifurcated
it?
market. I would say asset values could still go down. We might
Slow
start to
part
realize
of the
that
day.
now that some of the activity is going to pick up and some of these debt maturities will be addressed. So I don't think we're quite the bottom for commodity assets and maybe for the average. But for top-end premium assets, I think we've already passed the bottom.
All right, John, always good to get your take on the sector. Thank you.
Thank you very much.
John King.
Up next, shares of Robinhood soaring after reporting a surprise profit. The company going all out to grab market share from rival brokerage giants. We're going to take a deeper dive into Robinhood's
so
growth
did the
strategy
SPX.
next. Plus,
Surprised
Tom
me.
is the CEO of Kraft Heinz. Next hour on Money Movers, discussing results in his first broadcast interview since taking the helm, and pretty ugly share price reaction, down 5.6%.
Okay, get ready. We're hitting
We'll
the
be right
shoulder
back.
line.
There's
5,000
always the
strike.
sense that you are not complete and your journey is not complete.
Yeah. belch. Right about, there it is, triggered. Boom, right here. Let's see what 1.60. 155. SPX strike 5,000 at 160. Be careful. We're at 150 right now. Okay. Could be a problem. He's a little bit too far out of the money. He's got to work or get out here and get a different one. That would be a good idea. Could get worse. Yep.
First-time trader, but it's now getting a lot more aggressive in courting more experienced, wealthier clients from traditional brokers like Schwab and Fidelity, for example. Robinhood saw $4.6 billion in net deposits in that quarter. $3 billion of that came from transfers in from other firms. That continued in January. The company already topping that fourth quarter total for its highest monthly inflows since 2021, the height of the GameStop era when Robinhood saw a lot of growth. They've now got more than $100 billion in assets at this point. The average transfer balance, this is key, was over $100,000. Key reason though, cash bonuses for moving accounts. So Robinhood is offering a 1% match on transfers and then a 3% match for some IRA contributions as well. Bears have argued for a long time, really since the company's IPO, that Robinhood wouldn't be able to serve clients beyond sort of the first time or active trader that it's been known for. But as Bank of America put it in a note this morning, the momentum is signaling that it's not suffering from what it calls graduation risk and that it's winning larger accounts. They talk about things like retirement accounts as a positive step towards making their revenue and some of the revenue streams less sensitive to overall macro volatility. And you got JP Morgan this morning really waiting to see how sustainable these flows are as some of the promotions expire. Others on the street touting cost discipline. You can see that in the share price this morning, helping shares. The average price target, guys, rose about 13% on the back of earnings. We're going to ask Vlad Tenev, the CEO of Robinhood, about all of this. We've got an exclusive interview with him at One Market coming up at 1 p.m. Eastern, guys.
It's definitely a backup plan. Right now it's not working. I should have probably got out there at 160 and redid it. Oh, there it goes. More drama.
At about a 0.6% climb thus far. Many of the names you might expect, including NVIDIA, powering that index higher. Next hour, don't miss activist investor Nelson Peltz. Live market coverage continues after this.
Whoop. Not too good. And the 4970's really shot up nice. The puts. They got to come out to the green on this one. Gonna get interesting. We just went down in the gap. It can get a lot worse, I think. I think this is ready to reverse. I'm gonna buy 10. It's still too far out of the money. Could move it up. God, 40 are 12. Oh my. $600 on the put. The 49.70 went to 12.34. Oh yeah, that'd have been a real good profit. Wow, that would have been real nice.
Good Tuesday morning and welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live for you as always from Post 9 of the New York Stock Exchange. Nelson Peltz is with us just moments away with his latest on the activist fight with Disney following the company's earnings.
CEO of Kraft Heinz as well on earnings and the state of the consumer as sales slip.
Later, CME Group CEO Terry Duffy on record revenue this quarter thanks to higher interest rates and what is ahead for the markets.
Meantime, trying to claw back some of yesterday's losses, though the Dow has just gone red here to the tune of about 5 points. Still within, say, 40 points or so of S&P 5K. Got some relief in yields, and we're obviously on watch for Fed speak, reflecting on CPI, Goolsbee and Barr today, and importantly, Waller tomorrow.
Seems to be the message so far has been don't make too much of 1 month reading on hotter inflation. Let's see where the trend is going. But we do have two new sectors going red just now, energy and consumer discretionary joining staples. Let's talk Disney.
Three black crows.
Nearly 11% since its latest earnings report. The company announcing a stake in Epic Games, plans to launch an ESPN streaming service in 2025, a deal with Taylor Swift to stream an exclusive version of her Eras Tour movie. Despite all the news, Nelson Peltz is not backing down in his battle with Disney, and the company is set to vote on his bid for 2 board seats at its annual shareholder meeting on April 3rd. Joining us now in an exclusive interview,
75 gig
founder Nelson Peltz. Welcome. Nice to have you, Nelson.
Nelson.
Good morning, Sarah. Nice to be here.
Good morning. So, Nelson, the street seemed to love Disney's earnings report and all of its announcements. Why didn't you?
Well, before we get started, I want to say happy Valentine's Day to my beautiful wife, to my family, and all the Disney shareholders. Vote blue.
And Washboardjim.
Now, what's your question?
My question is the earnings reaction, and happy Valentine's Day to you. But the earnings reaction, the market seemed to like it. Nelson, I mean, the stock is up double digits since the report. It's up more than 20% year to date. So what were you not satisfied with there?
Well, it's not that I'm not satisfied. You know, this company sells at a multiple of their pronouncements, you know, a very high multiple. They made these announcements like this management team just came into office about a week and a half ago. They have been here for 20 years. All of a sudden, they've awakened and they want to start making all these announcements. By the way, there's very little meat on the bones on their announcements.
Oh, yeah?
The game's not $1.5 billion. What's the return? What are we getting as shareholders? Nice announcement, I hope. They don't have a long history in video games that's very positive. So, and Taylor Swift, I think that's great. I'm a fan. Okay? A real fan. I love her. That's right. You can't argue with that.
What about that? You mentioned the
increased hold it.
Oh, okay.
The increased buyback. Okay, the increased buyback, the increased dividend. As a shareholder, I love it, but can we really afford it? This company has spent over $200 billion, $200 billion since 2018. Okay, we're cash flow negative, earnings are down, the balance sheet has been really injured as a result of a terrible deal.
Terrible.
Lost the dividend.
Just
for 20
terrible.
years. And we just got it back, and we got it back, I think, because we're present. So, you know, these just are announcements. This reminds me of a politician making election day announcements versus State of the Union speeches. State of the Union is what I want to hear about, not election day promises.
On the point about dividends and buybacks, Hugh Johnston, the new CFO, you know him well, I know him well from PepsiCo. Don't you
Sir,
think
where do you know him
that
from?
He wouldn't put those two announcements in place without the confidence in the free cash flow guidance? Do you not believe the $8 billion guidance?
You know, Sarah, I'm glad you brought that up.
Oh.
Hugh, when he was questioned after Iger's speech, could not give any detail about the $1.5 billion for Epic Games. Couldn't do it. Couldn't tell us anything. They made an announcement on a new ESPN joint venture with Warner and Fox, And the NFL didn't even know about it. They were caught by surprise. And how is that JV going to work if Warner's NBA contract, which is coming up for renewal very soon, and it's going to be quite expensive, my guess, what's going to happen if they lose that? What does Warner have to add to this? So, you know, these are just a lot of empty promises. These are election day comments, okay? And Bob is talking like he just got into office a week ago. This is a management team that's been there for 20 years. And for 20 years, TSR for 1 year, 3 years, 5 years, 10 years, now going to close to 20 years, has been down versus the S&P. That's a real issue. And yet the guy has become a billionaire. He's got, and I'm thrilled if the CEOs of the companies we invest in make a ton of money. We want them to be the highest paid executives in their industry. But only if we, the shareholders, the great unwashed, are making money.
Okay, I've heard enough of you. SPX Lotto strike 5,000 at 160 and 75 cents is now at 105. You can make a business decision as now we approach the second crow for landing. The second crow for landing. We could hit number 3, and that'll bring this stock up to me. Right now at $1, I don't think that's too much of a suck. Yep, I'm a poet and don't know it. The crowd's going wild here. Wonder where that spy come. So we do have a snake. Been notified on the prehistoric lost list. So we're going to get down. First trend line. Second, we're still inside of the snake. We're still inside of the snake. Plenty of time here. Boom. As Jim notified the exit idea from the triple bottom on the 3 black crows. Let's see if we can just have a little pullback here to resistance, which is now support. Where's it at, Jimmy? It's right smacked right there to the penny. 495.53. No lower than that. Maybe 50, but it's on the SPY. That was interesting. Yep. We could have a continuation run here. The SPX. Put the chart up, Jim. Put the snake on there. The SPX is at 115 now. As we approach the 1, 2, 3, we could go ahead and move on out and break out. And that would be so nice. Or you could get it now, make a business decision. I'm not a financial advisor. I'm just an educator. I'm teaching the strategy of the 1, 2, 3. If you can count to 4, you might just get a little bit more.
Count to 3 and trade with me, but count to 4 to make much more.
Much more. Okay, I'm about ready to go into the kitchen, make a business decision. Where's my... Right now we're at $1. The crowd's going wild here. Come on, guys, buy it. It'd be nice if this breaks this resistance. I'm gonna say I might get out at 150 on this $5,000 strike, lotto. So I'm waiting for 4, maybe. Not very smart, Jimmy. I'll be right back.
Reality is.
You're, as we speak, releasing a new fight letter, and on top is a new cartoon that is not the most flattering picture of the board. I think we have a graphic of the cartoon. It's at the board table, and they're throwing spaghetti at the wall, which I think makes pretty clear, Nelson, how you feel about the latest quarter.
Well, they are throwing spaghetti. That's what Bob said.
Okay, we pull him back. It's retest time. Now we need to, it's got to tell us if it's going to break out, and we don't want to see a double bottom on the SPX. I get out about even here. it was 85. There's 80. Breakout. This is, we waited for 4, so we're asking for much more. But we counted to 3. We could have left this baby. Interesting, James. How'd you do that? I'll be right back. Look. Break it. If this doesn't break, I'm getting out. Nah, 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 nah. It might not. Squeeze is coming up. Belch. Anybody hear that? That was very professional.
These deals. He could not. He couldn't tell you the returns on Epic. He couldn't tell you the timing. This is the CFO. This is not some analyst. This is the guy inside, the number 2 guy in this company, according to the board, who's recommending these things to the board. He couldn't give you that information.
He couldn't.
I find that pretty stunning.
Well, Nelson, we will continue to follow the saga and the fight. Do you know when you're going to release the white paper?
I do know when we're going to release the white paper. It'll probably be in a couple of weeks.
Okay.
Everybody better sit down with a nice warm glass of milk, get comfortable, because you're going to see chapter and verse on Disney.
Whoa.
Sarah,
Okay.
thanks for having me
Looking
this
forward to that
morning, really.
analysis. Yeah, no, thank you for coming on and stating the
Okay.
case and responding to earnings and the stock
Vote
price, which
blue.
is lower.
Vote
Made your
blue.
business
That blue
decision and
card.
took a
Go,
small
Go,
win.
guys. Thank
All
you.
right, thank you, Nelson.
I'm gonna take a big one.
Carl, there is a similarity, many similarities, as we talked about, between this and the P&G fight, which I was intimately
I'm gonna make a business
involved with and
decision
covering.
to take a big one.
And that is, there's a good chunk of shareholder investors. So he has track record there with P&G, squeaked by in that election, and that's the strategy here as well. Mom and pop own Disney.
Yeah, interesting, because as you were talking, we got casting for Fantastic Four out of Marvel, so the efforts at studio continues. Meantime, the CEO of Kraft Heinz is with us after the break. His first earnings interview since assuming the role on January 1st. Some of these price hikes not enough to offset the revenue miss for the quarter. Stay with us.
Okay, ladies and gentlemen, we are now getting to break out of the squeeze. We had a 1, 2, 3 at the bottom, and we've had a 1, 2, 3 at the top. If it does it here, it's a clean break to the new double top high out of the snake. Where's that double high? Well, I'll show you right here. Take and put it on your price line. Come on. Come on. Price line. The body of that candle. Oh, we're there. This could be an exit idea. Decision making time. Decision making time. Decision making time. 120. Uh-oh. Uh-oh. Mike. Decision making time. 3 white soldiers. 3 black crows. 130. Johnny, did you get educated there? Say yes. Squeeze, baby, squeeze.
Affirmative.
140. Uh-oh. Okay. Is this for real or am I seeing things? Jimmy loves it when he has it his way.
Take a look at Kraft Heinz. Top line miss in Q4 does weigh on the shares a bit today, despite this earnings beat and predicting an easing of pressures on the consumer moving forward. Joining us in a CNBC exclusive this morning is Kraft Heinz CEO Carlos Abrams-Rivera. First interview since taking over the role in January, and it's great to have you with us. Thanks for the time. You know that you're printing on a busy week where we're thinking about sort of disinflation and the consumer and a lot of eyes.
We really
on your North
appreciate you,
American
but I've got to
pricing.
talk about
Can
this
you sort of
trade here,
place it
okay?
in a trajectory?
So take your little gossip. When you want to start talking about stocks, get back with me. But I got to talk about this pattern here before I get too upset there. So what was that? The SPX? Whoa. So we had this 1, 2, 3. And I've said if we wait for 4, we might get a little bit more. So we got number 4. So as it started to form its pattern, which we recognized as a symmetrical flag or a wedge, we started to see the squeeze. Right at the end of the squeeze, we had a hammer. And that could almost be it could be a dragonfly if it had a little bit higher stem up here. So as that started, the higher lows and the lower highs started to connect. Boom! And then within 3 minutes, out of the trade. 1, 2, 3. 1, 2, 3, 4. The reason why I count to 3, if you haven't figured it out by now, because the more you count, like if you get to number 5, you have a less chance of breaking out of a momentum breakout. It starts to get a little bit weaker. The buyers start to leave and look for something a little bit more yummy. The volume starts to slow down. But when you get that 3, the highest momentum's when that 3 happens. If it doesn't happen on a 3, you had 1, 2, 3, 4. 1, 2, 3. And if it wouldn't have broke out on that 4th, I would have definitely got out of the trade no matter what. But the fact that we broke out of it, now it can gain momentum and run even higher. Yes, I said it. Washboardjim said it. Break out, baby. Right now we're at 130. You could make a business decision if you wanted to. Yep, that's what I said. Has anybody else made a business decision? We're still way too far out of the money. I'd make it and maybe run it up closer to the money. We're too far out. The 5,000, just like a little momentum. Okay, I'm going to go into the kitchen and prepare lunch. It's a long lunch break.
Welcome back to Money Movers. I'm Bertha Coombs with your CNBC News update. The Israeli Air Force began what it is calling an extensive wave of attacks in Lebanon today. The strikes follow an earlier rocket attack, which Israeli forces say originated from Lebanese territory. The Federal Trade Commission and the Department of Health and Human Services are launching an inquiry into recent shortages of chemotherapies and other drugs. The agencies are asking for information examining whether the companies that broker drug purchases for hospitals have misused their market power and in so doing contributed to shortages. And the man credited with inventing the iconic breakfast treat, the Pop-Tart, has died. William Bill Post was 96.
You have to tell us that.
Developed the Pop-Tart, which debuted with 4 flavors back in 1964. But 3 billion were sold in 2022, according to the company.
I didn't really want to hear that.
When I was a kid.
Oh, yeah. Changed breakfast for a lot of kids. Bertha, thanks. Meantime, stocks trying to bounce back today after the sell-off yesterday. Take a look at Uber. Best to open, at least, since May of last year. One of Morgan Stanley's top portfolio managers will tell us how to play this pullback, and as we keep an eye on the Dow at 42.
Do. I'd be careful. And use the top of that crow for support. There.
Make new highs, no, but if it does, that's a 20 current level. So it does have something to reverse. The story with IWM, the Russell, are rates. They've been anticipating those 6 rate cuts where I still don't know where we got that number. I think 3 is realistic. And once you get that cut, maybe that'll be the catalyst to finally get the small caps to rally because they're affected by higher rates for longer than the big caps are.
Maybe you're not surprised to hear this. NVIDIA now becomes the 3rd largest U.S. company, passing Alphabet, Google's parent, Alphabet. So it shows you just how huge it is. Recently hit highs of 746. What do you think about a name like NVIDIA? I feel like I have to circle back for folks because they've watched it run up.
You cannot talk about the stock market and what's been going on if you do not mention
Do you
NVIDIA.
like it?
I love it over the long term. This has been one heck of a run. If you were lucky enough to be in it, you may
And I
want
could
to
go
take
ahead
some
and sell
profits
my
because it's gonna be the
SPX.
largest part of your portfolio, given the
Right.
run it's been on. 3rd largest company, it makes sense. It is the AI play of all AI plays. I talked to a man like Dan Ives, a guest on your show, who says we're in the early innings here. I agree with that thesis. I agree that this is just playing out, but all roads through AI lead through NVIDIA. And to me, this is going to be the most anticipated earnings for next week, for the year, if I say. It's the Super Bowl of earnings, and what can they do to take another leg higher? It's going to be very interesting to see what Jensen Huang says on his conference call.
I don't want to leave out Bitcoin. We saw Bitcoin when it got to 50,000 this past week.
The video is just now at the 63 on the 1 minute.
Over 2 years now.
Oh, there we go.
1,000.
I got my
What do you
breakout.
think about Bitcoin? A name like Coinbase.
Let's move it.
Are still out. Noting the risk.
I'd love to get 150, maybe 2.
Things, but how about something like Coinbase? Is that something you like?
It is. Their earnings are out tomorrow after the bell. We've seen crypto-related stocks do well this quarter. Coinbase had
See the spread on these here.
Had a nice run. It pulled back. It held that key 50-day moving average around 145. It's about 150 today. I think
Pretty good
we're
spread.
going to have good numbers. And given that Bitcoin finally has that stamp of approval from the SEC, the spot Bitcoin ETFs, it is a legitimate asset class that is here to stay. And I think seeing the people that now, because it has that seal of approval, they're getting in. They're putting a portion of their portfolio into crypto assets, and Coinbase could be the biggest recipient of that because they want to do it directly.
Very
There's
good.
no better place to go than Coinbase.
Right. All right. Thank you so much. It's great to see you. Really appreciate it. Jay Wood, thank you for being with us. Coming up next, our disruptor, Shopify, is getting price target hikes and cuts from all over the street. So George Stills will iron this out for us and give us an example trade as well. We'll be right back.
Getting ready to drop below my support. Okay.
I was born on the south side of Chicago.
Uh-oh.
It's been a long road, but now I'm working for Schwab.
How'd you get that job? I want it. Jimmy might get stopped out at 75. Well, that didn't work. Could have been out with a good profit. Can drop a little bit more. Yuck. It has to hold here. This is the spot. Actually, we went below it. We went below it.
In terms of range expectations for price targets, the median target for the
Shopify.
year is $80. So it's sitting, right around those levels right now, with a high of around 100 and a low of 60. And I think it has to do with the fact that despite the
Breakout.
increases year
I'll be
over
right
year,
back.
also projections for sales, which are in the low 20% range, as well as some positive elements to the full year of 2023, which included positive free cash flow for the full year and double-digit free cash flow margins. The company's still expending quite a bit of money. And if you look at the guidance they provided, they're expanding not only, of course, the merchant solutions business, which is their primary core web creation, marketing, and of course their e-commerce platform solutions, but they're also offering up point-of-sale solutions to merchants. So with that said, they're spending quite a bit of money this coming year for capital expenditures. And I think that also put some pressure on the forward earnings guidance that the company provided, and that's why we saw the sell-off as a result.
Thank you so much, George Stills. Wonderful to see you. Appreciate that summary on Shopify today. Coming up next, a look at Kraft Heinz. It's consumer staples name, the space overall. We will break down the report, and when you think of Kraft Heinz, you can think of Maxwell House, Jell-O, Oscar Mayer, Capri Sun, of course the ketchup, right? And more. We'll be right back.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom.
It's probably hard to deal with. Okay, we've got our 1, 2, 3 now. Down here at the bottom. Now we just need a 1, 2 breakout. Sloppy megaphone pattern, but we'll see. 49.78 would be nice. How's your mom doing, sir?
Network app and join in on the latest market trends.
Today's red on the watch list is VZIO. That had that news yesterday. Walmart, Apple, whoa, don't buy. For some reason, almost about 100 shares of Vizio. How? Boy, Apple looks cheap. SPX, come on, baby. Coke.
And what they talked about on the fourth quarter call is that's what they underestimated, is how weak that consumer would be. And as a result, the North American sales are down 3%. Their Grow platform was down -2%. They have plans to try to address that in 2024, But I too believe the company's made a lot of positive change. But at the end of the day, the portfolio is disadvantaged.
Oh.
I see. Part of that is, as you said, a lot of the lower income consumers that are feeling that pressure. Erin, when you look at the portfolio here, Maxwell House, Jell-O, Capri Sun, Great Value, Kool-Aid, Philadelphia cream cheese, I mean Jell-O, and of course ketchup. Is all this sort of right for the company? Is the mixture right for the company? Because often when I have guests on who talk about staples, they always seem to pick Mondelez.
Yeah, I mean, obviously, Mondelez plays in confectionery and snacking, low levels of private label penetration in their categories, as well as, a very expansive geographic footprint around the world for Mondelez. Kraft Heinz is more focused on the domestic market. That's about 75% of their sales, and most of their categories are more center of the store, and at risk, to Rob's point, in terms of trade down or trade out from a constrained consumer. That said, Kraft Heinz has selectively made pivots within their portfolio, divesting natural cheese and Planters most recently as a means by which to free up resources and focus their attention on their highest returning brands. Could they continue to do that? Absolutely. But we do think that there are still opportunities as it relates to their condiments business and some of the center store categories that they play in, and that investments to align their portfolio with consumer trends and incorporating more in the way of data and analytics to do so is advantageous and should support even modest growth going forward from a top line perspective.
Yeah, you noted that the company has been paying down debt. In addition to that, Rob announcing declaring that 40 cents quarterly dividend. Your thoughts is if you have Kraft Heinz at the price target of $37, is there something they should be doing differently? And what would you consider a buy when it comes to other foods that you watch?
Well, I agree with Erin that I think that, to create really long-term value, Kraft Heinz would probably have to consider more divestitures down the road. There's some brands that I think are a real drag on their sales growth. In terms of my outperform, I think if you're going to invest in a low valuation multiple food stock, I would prefer Smucker. Their multiple's been beaten down quite a bit, but it has a better growth profile because they have leadership positions in attractive categories like coffee, like pet food, and like Uncrustables, which is a double-digit grower, and more recently Hostess. And their growth rate has been relatively better than peers, and I think there's a lot of earnings growth to come from synergies from the Hostess deal.
So the long-term value of Kraft Heinz, you both seem to be on the same page that divestitures could be in order. Rob, is there something when you think about the list, get rid of that? I mean, that should be the easy one to get rid of. If you were advising the company, what would you say?
I think Maxwell House would be top of the list. It is not a brand where they're putting a lot of resources into. There's a lot of consumer trial of more premium brands, and I just think Maxwell House is having trouble keeping up with trends.
Yeah, and Erin, what would you say they should get rid of?
I mean, coffee is, to Rob's point, is circulated quite often in terms of the Maxwell House brands, and obviously Jell-O is another.
Doesn't look like it wants to
brand,
work. That's number 4.
To reignite time and again. That has some
Up to 200.
And so that's another area that hasn't gotten
Last chance.
the boost that some of the other businesses and brands have from some of the reinvestments that they've made.
Yeah, and just to circle back on the Mondelez call, was that a name that you had a buy on, Erin, or anything else that you can mention a quick buy? We only have about 10 seconds left.
Yeah, we think Campbell's Soup looks cheap here on the food side as well.
Yeah, okay, CPB, I'm writing that one down too. Erin Lash, Rob Moscow, thank you both very much for being with us. Erin Lash of Morningstar and Rob Moscow of TD Cowen, thank you very much. Good to see you both. That's it for me. I'm Nicole Petalides for Trading 360. I will see you at 2 p.m. Eastern Time for the watch list. Join me then. In the meantime, keep it right here. Fast Market is next.
Important we hold right here. Oh, that didn't look good. The 200 was my first support. Second's this shoulder line. And then you got a double bottom head.
Buys for free. Schwab Network.
Apple pulling back to double bottom. Lyft, Mara, and Uber. Oh, there we go more. Damn. Not good there. Huh. Didn't drop much. That time it did. GDP event.
earnings after the bell today or before the open tomorrow. So a really good lineup of earnings plays going into tomorrow. Now, before we do that, before we bring in Jenny Horn,
49.70s would have been a good payday today.
Let's check the 4 major indices and see where they sit. At 11 o'clock Chicago, 12 o'clock Eastern. The S&P 500 up just under 0.2%, 8.5 points to 49.61. The Dow Jones Industrial Average now down 0.8%, 43 points to 38,229. The Nasdaq 100 up 0.25%, 44 points, let's call it, to 17,644. And the Russell 2000 up 1.25 points after that big sell-off yesterday, 24.5.
More drama.
1988 and some change. Now, let's bring in the Managing Director of Financial Risk Management at Charles Schwab, Mr. Nick Theodorakis, to the show. Nick, interesting day after a pretty good-sized sell-off yesterday. Kind of consolidating here. We tried to rally. Looks like we're kind of in the process of a softening of that rally. I don't want to say it's negative, but the markets are certainly off their highs. We had some data yesterday that kind of shook the markets off their foundation a little bit. We've got retail sales tomorrow. We've got PPI on Friday. What are you looking at here?
Yeah, I think both those numbers matter more now than
what are you looking at here?
Prior to yesterday's sell-off. And it was kind of like, well, PPI is not usually that big of a mover. We know that feeds directly into the PCE number. So, you know, when you get a big move, you're kind of looking for the next thing, what's going to offset that. So I think those numbers matter incrementally more. Retail sales are kind of interesting. It will be kind of interesting to see how that looks relative to where the weakness and
God, man, 49.70 puts. $3 to $1,500.
Soft. So where is retail really? Right, services were elevated, goods and kind of hard goods were down. Some of those categories were in deflationary terms. It's kind of like you got to really look carefully here at where the game of whack-a-mole is trending. But you know, the services sector, which is call it 70% sometimes of the economy, is still really hot. I think that's interesting. So retail sales will give us some more insight, I think, into the nuance that was CPI yesterday. It wasn't just like a massive hot number, right? It was interesting, but to see that reaction, it's reminiscent of when we had that massive rally in November on CPI coming down. So, you know, a little bit of an offset there, I think, is not unexpected. But it does push off interest rate talk, I think, you know, pretty significantly.
Right.
And that's the question now. Like, how many cuts can we get this year still?
Right now, the retail sales number are supposed to be down 0.1% from up 0.6 a month ago. The other numbers that are in it, the X vehicles from up 0.4 to up 0.2, X vehicles and gas from up 0.6 to up 0.3. So it's supposed to be softer across the board in retail sales. But then again, we thought that core CPI was going to, or headline CPI was going to go to a 2 handle, and we thought the core CPI year over year was going to come down. Neither happened.
No, you know, but autos is an interesting one. So you gotta like dive in. So
autos
used
are
cars
volatile.
Are volatile, but they were down more than expected. Used cars were down more than expected. So what's that going to mean when we see retail sales? Who knows, right?
Yeah.
These numbers are still coming off a really strong holiday season. How they sort of normalize.
That was $100 right there.
Interesting. Real estate. You know, we talk about this like every time. Real estate. You know, using rents as the equivalent for everything is tough. It doesn't really talk about home prices exactly in any of these numbers.
And it's certainly not high frequency.
It's not high frequency, and it's not accounting for any of the commercial real estate stuff that we're seeing. And interestingly, financials are the second strongest sector today with rates up, which is kind of interesting. You've been looking for a bit of a rate pullback and curve normalization, but you're seeing financials pretty strong. So there's just tons of nuance here. But like, we haven't had very many days in the last year where we've had a nearly 1,000-point Dow sell-off.
Yeah,
right?
this has been quite a rally.
It has been quite a rally, and I think that the biggest reason for that move, like macro reason, is that rates are getting
a rally you've probably never seen in your lifetime.
It's always right point in time, but the market is moving towards what the Fed is telling us, that higher for longer. And I think the fear in that is
the 49.70s went from 11 to 1,800 just now.
Like, that's when you got to kind of start worrying about a recession, right? When you least expect it.
On the put.
If they leave them high for too long, when is that tipping point? I think that's the real question to ask.
We had earnings come out overnight in Lyft, and some news from from Uber overnight. Some big news. For more on that, let's bring in Jenny Horn coming to us live from the Schwab News Desk. Jenny, these people have one job, right? And your goal when you release your earnings,
and they were close to yesterday's close,
to a sitcom. And that's unfortunately, even though Uber had, or Lyft, I'm sorry, had good news, it turned into a sitcom, Jenny.
It really did, Kevin, and I really have a hard time criticizing the CFO because, as we know, we say a lot of numbers on a daily basis. I'm sure I've made some pretty aggressive mistakes, but I'd say this one, when you're the CFO, you kind of have a responsibility. But what we saw is that their CFO did say they misstated their margin expansion, calling for 500 basis points instead of 50, which is a pretty big deal. I mean, shares surged as much as 67% in reaction to that news, and then fell all the way down to up 16%, which still was a nice rally. So then we opened here up over 30%, and actually we've held, amazingly enough, at these levels. I mean, it's just been a wild ride ever since that earnings call. But I think that this misstep from management overshadowed what was a really strong report from Lyft objectively. I mean, we did see overall earnings per share below past forecasts. Revenue was in line, but it was up 4% year over year. They did also say that now they're planning for lower CapEx for 2024 relative to 2023. And as a result, they think that Lyft will be able to generate positive free cash flow for the full year for its very first time. The number of rides increased 26% from a year earlier to around 191 million in the fourth quarter, and active riders rose 10%. Gross bookings were also up 14%, while bookings for the quarter for the year, rose 14%. Well, for the quarter, they rose 17%. And I can't believe I'm going to mention this for the second time today. I'm going to talk about Taylor Swift because she was mentioned on the Lyft earnings call. They said that rides they saw in terms of stadiums and some of these large arenas were up 35%, due largely to the Taylor Swift and Beyonce concerts, as well as the US Open and football games. So even Taylor Swift got a nod in the Lyft earnings call. I mean, it seems like they had something truly for everyone as far as excitement and drama. But then there's also this news today that we are going to see a lot of these gig economy workers strike, and what is expected to be actually one of the largest strikes as far as these classified independent contractors. This is over these unfair conditions, and it affects various cities, but Chicago is one of them, as well as Austin, Hartford, Miami, Newark, Orlando, Philadelphia, Pittsburgh, Rhode Island, and Tampa. However, it's expected to occur from now until 1 p.m., specifically targeting airports. And I checked, and as of right now, you can take from where we are currently sitting an Uber or a Lyft to O'Hare without any trouble. So what I'm seeing is the strike is still on, but I haven't yet seen it disrupt as far as our ride-hailing services go.
Jenny, it's a really interesting thing, but there's a playlist of words. AI, Taylor Swift.
Since when did Taylor Swift become the new AI?
Live sports, NFL. It's fascinating, and my 5-year-old has this thing where he says, "Dad, how much does this candy bar cost? 50, 100 million?" And I'm like, "Yeah, that's about the right number." So I feel like the CFO kind of did that. Joking aside, they had an incredible quarter, and they're eating into, it's kind of been this Uber has been the haves and Lyft has been the have-nots. They haven't been able to really monetize this. It's pretty fascinating to see those numbers, the real numbers, turn a bit. I mean, it seems like the margins are actually up significantly. Anything stand out to you in what you've seen on how they've driven those changes so quickly? Because it's a pretty big shift in terms of their kind of bottom line march to profitability.
Yeah, I mean, absolutely. And I would say, jokes aside, if we did see adjusted profit margins as a percentage of their overall bookings, that will be up over 2% from around 1.5% just a year ago, to speak to some of that improvement. So I do think that's notable. And again, I do think the story here was objectively, fundamentally very strong, just unfortunately overshadowed by all of the drama. But when comparing it to Uber, I mean, Uber has really ran away with it. Uber had a banner 2023 and all of the earnings reports to match the nice move to the upside. I mean, we saw this company was consistently profitable. They also did join the S&P 500, that being Uber. And as a result, today they did authorize their first ever share buyback plan, which I just think signals the revival story and the sizable role we could see in the reduction of the dilution that's caused by the stock-based compensation. I mean, Uber's story continues to get better, and Lyft as well, but Uber has really stolen the spotlight here, and they command 75%, I saw this interesting statistic, 75% of right now the ride-hailing market share. So then Lyft has the other 25%, splitting that with taxis. I mean, just to speak to now Uber's dominance, and that doesn't even include Uber Eats, which is another massive segment of their business that Lyft frankly doesn't have. So it's difficult to compare the two. I will give Lyft credit where credit is due, but Uber's news today also fairly impressive.
Jenny, this is a good story. That this is why the old statement says kill the messenger, because clearly the messenger in this case didn't do his job right. And traders, it's always interesting because traders, we check things and we recheck them and we check more than once and twice. And so for them to get a 0 wrong, and by the way, stop calling it basis points, world. Just call it percentage. What are you doing with the basis point thing? Jenny Horn, have a great day. Thanks for coming on as always. All right, Nick, let's get back to our macro discussion here, because in the good news in the CPI data yesterday was energy. Energy down 0.9, gasoline down 3.3%. Well, Nick, if you look in the last 20 days on your Thinkorswim platform, crude oil was 70.5.
Yep.
It's now 78 and change. So what I look at, it's not, 77. It sold off so Friday, but it was over 78 today.
Yep.
That part of that CPI data may go away on the next measurement.
It's fascinating because earnings, have stayed so strong. We see these sort of headline tech layoffs. I know we're not talking jobs numbers exactly, but there's been, pockets of this, 1,000 people here, 1,000 people. But when you look at the job openings in construction and in services, they're still really robust. And the wage growth isn't what it was, but wages are strong. That is fundamentally driving this, and it's going to be awfully tough for any of this stuff to fall off a cliff. Tom's not here today, so we can both sort of talk positively about the Fed, right?
It's okay.
It's okay to say it's okay to be nice. It's hard to see a scenario where everything remains as is, and these numbers just fall off the cliff, and the Fed says, "Oh, we waited too long." I think we have to see changes in real earnings and at least a real flattening of the earnings, and they're still going up. I mean, there's more people participating in the labor market now than there was pre-pandemic. So it's tight and it's tight and it's tight, and it just doesn't yield this big sell-off in sort of goods prices. And I think until you see at least a flatlining, you're not going to see that happen.
We had jolts back over 9 million.
Right.
We had wages up 2 months in a row, and we had ISM prices paid.
If the labor
higher.
market was
These
really
numbers aren't going down like we want
if
them
the labor market was really pulling back, you wouldn't have 2 month over month wage growth.
Wage increases.
It's
Right.
just, it's hard. I mean, it's hard to
And
see.
here's another problem
It's
for
hard
the
to
Fed.
see the Fed's wrong right now. I mean, I was way out. We were all out in front of the last. They need to be raising. The money supply is crazy, and they're still running off. Excuse me. They're still running off the balance sheet.
It's starting to show up. How about the 2-year yield? Over 4.5%. It's getting to a real interesting place on the chart here, where any more strong data, that's going against the narrative of the Fed, right? The 10-year yield at 4.3, the last time I looked, is it still 4.3?
That's what I just pulled up.
That's
4.27.
going against the narrative of the Fed. The dollar, looking like it wants to break 105 as the euro on the downside breaks 107. That's going against a dovish Fed. There's a lot of red flags out there that everyone at least bare minimum should be paying attention to.
Oh yeah.
The yield curve, and in particular the yield curve inversion, goes right in the face of what I'm saying. It is the strongest signal, and it's rarely wrong over the last 100 years in terms of predicting a recession. But
It's a breakout.
the question is always when, right?
Right.
As traders, right, you can always look back and say I was right, but the timing is everything on this stuff, and when you predict
When
that.
and from what level are the two biggest
Exactly
questions.
right. I mean, you look at what would it take to have a 20% correction in the market. We look at that a lot in risk. That's sort of the benchmark from 1987. If we corrected it 20% in a lot of these names,
Get my coffee and I'll be right back.
call it 6 months, or let's make it even shorter over the next month. You'd be at levels not seen since 2 months ago, right?
Yeah.
There's
Oh,
been
really?
such a rally that it's just hard to think that some correction isn't sort of due based on these interest rate levels and inversion levels of the yield curve.
Let's take our first break and come back with our first trade of the day. It's going to be Deere & Company. It's such a cool company. I can't wait to cover it. Stay here on the
Cool.
Schwab Network Fast Market. We'll be
I'm
right
with you. John Deere. Boom, boom, yeah.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power.
We don't play commercials in here.
And you've known this from trading it for
Yes.
100 years. I think what's really interesting, I was looking back at last quarter's report, and I just remembered that they were showing some weakness and or had talked about some weakness, and they're expecting 10 to 15% decline in large equipment sales, and that does go as grain prices go.
Sure.
But there is some expectation now, because the economy has remained so strong, that just kind of what we were just talking about, that they may lift those numbers a bit during this conference call. So I think the numbers are obviously important. We're gonna get stock reaction on that. They don't tend to be as volatile as Lyft, right? Assuming they state their numbers correctly. But I think we got to be really careful on the conference call here. If they revise that sort of cautious guidance that they gave it all, I think you could see a little bit upside. The 200-day moving average here is right around 390. They traded up as high as 450. And down as low as about 390, 395. So there's been a pretty significant range in the stock. But a bunch of that sell-off came on the sort of stated weakness, not the actual performance and numbers themselves.
This seems like an old, bit heavy, doughy, old company, but they are on the cutting edge. They just cut a deal with SpaceX to put autonomous driving that's already in their tractors, but linked data and with other tractors. It is incredible, the innovation and how they're using full self-driving, autonomous driving, satellite to improve the overall performance of these machines. It's actually quite incredible.
It's one of the best use cases for driving automation.
100%.
Right, so-
No traffic out there in the field.
Maybe next time when Elon shoots the rocket off, he'll put a John Deere tractor in the front seat instead of a Tesla.
Have the guys in there wearing hats.
It's a grid.
It's a
right?
good idea.
Driving in
Yeah.
downtown San Francisco where they're testing these cars, and it's like there's a lot of variables. This is
Right.
you have a plot of land.
That's a real good idea.
You know exactly the size and shape of the plot of land. It's the same every year, right? Depending on the crop, and it's pretty easy. So I think
And you can
it's
plow and harvest 24 hours a day.
That's right. You can be around the clock. So the use case for automation and self-driving, and then the other piece that's really interesting, the downtime and the cost of downtime here is of the highest in the world, right? So having smart components that are notifying owners of maintenance requirements in addition to the
Repair
self-driving
services
features,
it helps, yes.
it helps with uptime as well. So they seem obvious now in terms of the automation here, but those are really cutting edge things that Deere is definitely a leader in.
And all these awesome things, and we love it with the cameras on the combines.
Good
and
spot,
all
too.
The things they're doing, and like I said, trading data back and forth and repair diagnostics. All these things that linking to Starlink and linking to a satellite. Who'd have thought? But that said, money in the farmers' pockets are still important. And if you want to look at maybe why Deere stock, that their earnings beats are massive, if you look at the last 3 quarters, it's still down because bean prices are down, corn prices are down, the overall commodities that they service are down. Nick, you have a trade for us in Deere and Company. What are you looking at here?
Yeah, so we're right about at that 200-day moving average. So I took a bit of a longer-term view and wanted to utilize the fact that the implied volatility is like in the 70th percentile in the front. So pretty high elevated vol going into the earnings. The stock is depressed to your point. Yeah, I think that is largely grain related, as you mentioned and as you know. But the guidance was fairly weak, like I said. So I think if they do anything to up that, that was sort of the logic behind taking a bit of a bullish stance.
200-day where,
I went
buddy?
up to the June monthly option, so it's 128 days out. So you're talking summer months, and bought one of the 410 calls, and then sold against that, expiring this week on the 16th. So in 2 days, that elevated volatility in the earnings week, the 400 call. So there's a $10
short diagonal on this one.
here.
Yes.
So when you look at the risk graph of this, the risk is to the upside because you have the $10 short vertical, plus you're paying about $11.50 for this trade, but there's 128 days in that back month option. So the reason the risk graph looks the way it does is because there's so much time on the back month, right? Now the volatility is very elevated in this front week. You're actually talking another earnings cycle and a half out for that back month. So it's very unaffected by this earnings cycle as well. So we wouldn't expect that back month option to move a whole ton Vega-wise on these earnings.
No,
so
right.
it would
That's a
retain
good
that a
point.
bit more. In the front month, you would expect, even if there is a move to the upside, would decay rather quickly because it's in such a high volatility percentile.
When you go out 128 days, Nick, on this trade, which you did, you're making a longer term bet.
Right.
That's going to cost you money.
Yep.
That's the negative part of this. But the good news is the theta is very low
Yep.
on a June option, right? It's almost going to be nil.
Yep.
So the theta on your short term, that relationship is a big one. It's over $100 a day.
So this isn't
you're
like
making in theta.
That's right. This isn't like the sort of stock replacement strategy
Yes.
that we talk about where you're buying an in the money call. I looked
This
at
is a
that.
vertical
The options are very
put.
expensive that far out. I'm like, well, if you're expecting a move to the upside, this is still a low probability trade, right? Because you need that move to happen. It's a lower probability trade than some others. But what you're basically doing is taking the expected move of this 2-day option into account. I don't want to get to above sort of 400. You can go above 400 and still be fine, but you have to manage this, right? If we sort of hang out right here, if there's a lower than expected move or we move to the downside and that option
Okay,
expires,
SPX,
you
is that
paid for
resistance?
a couple dollars worth of that long-term option. And you have obviously plenty of time to roll and adjust, but you're long
To
an
break
out-of-the-money
or
call,
to do something.
almost to 130 days out.
Yeah, the good news is And
could get out of here.
Some of the misconceptions about this trade is you want it to go to 400 and don't go any higher. Well, that's not true.
But if we break out, man,
go to 410. You'd prefer it probably didn't go to 420.
That'd be like 75 cents a contract.
Within between 400 and 410, you're fine. You're going to be profitable on this trade. In the short term, then you may have to make some type of an adjustment. What you don't want is that massive move to 430, 440, 450.
You don't want to go through your sort of back month.
Break it.
Exactly
You're not going
right,
to use
because you do have a short.
I mean, it's a hard resistance.
In that calendar that creates the short diagonal spread. So interesting the way this works out. But
that's pretty good.
If it doesn't go, remember, if it moves up towards 410, you've got a nice little problem on your hands, right? You've got profits to deal with to make adjustments to this trade. But Nick, this is full disclosure, it's a unique kind of trade because it's a long term.
This one's down $5.
It's a short drag.
John Deere.
So it's taking more advantage, if you will, of that higher front month volatility, front day volatility.
Past couple of minutes. Let's see here.
But you do have that short component. So it's like, how bullish are you? If you're extremely bullish on this stock, this isn't a strategy you would consider because there is that short component. What you're really looking for here is an underperformance of, like, if you just break it into its components, like, conversation, what do you want? You want an underperformance of the volatility going into the earnings. It can be up, but you don't want it to be up dramatically.
Nope.
And then you want it to end up higher by midsummer, right? That's kind of the early summer. That's kind of the trade.
Good look at a different kind of trade than we normally talk about here because it's 128 days short diagonal. Like I said, you've got time to chip away at that net debit. Remember, you go out 128 days, it's going to cost you in the debit department. The good news is you've got 128 days divided by 7 to chip away at that net debit. And so that's an interesting way to get your mind around the debit you're paying on a spread like this. All right, let's take our second break of the show. Come back with Landon Swan from LikeFolio.com. He's going to talk about our feature stock of the day, and that is Crocs, those ugly shoes. Stay right here on the Schwab Network. Fast Market. We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your
65 on the SPX, baby.
Crafted just for traders. Also, you can trade brilliantly.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device, for free. Schwab Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime.
Technical analysis. SPX is about where I'm going to unload. That, and then we take off and we get another 100%. Take off and sell some here. Whoops, there's 7.5. Very good. Very good job. Could have got more. If it break out, we will. 49.85 in the expansion pattern. Get a knife and I'll buy the dip.
As well, and it shows up in it shows up in Google Trends data. It shows up in web data. All of these things are kind of pointing in the same direction that Crocs is just not doing great, and you can see the discrepancy here between
little competition.
Crocs and Hey Dudes. It's a smaller brand, of course. Like I said, it's about a fourth of their revenue, but their growth over the last year is definitely worse. So Crocs is at -14 year over year. Hey Dude's at -20 year over year. And so it's, some analysts are asking, did Crocs kind of drop the ball on that acquisition, or did they just happen to buy Hey Dudes at the top? You can argue about that, but either way, the outcome is about the same. So we are a little bit concerned with this brand moving forward, with this company moving forward. It pains us somewhat to say so, because we've had some really big gains on Crocs over the years, but we always follow the data, and right now it's just leaning a little bit towards the negative side.
It's an easy balance sheet to figure out. They're supposed to make just over $10 billion. At $35 a pair, that's like 285 million pairs of shoes they have to sell. So it's a pretty straightforward business model. They don't do a lot of bespoke stuff.
A lot of shoes.
You had up there, like particularly Allbirds. You didn't talk Nike here. It's not the exact comparison, but they're doing a lot more bespoke, small releases, unique kind of collector's items type things. And I wonder, you don't see that from any of the brands kind of under this umbrella. What do you think? So to me, that's a driver of some of the interest in these names and the reoccurring buyers. What do you think is driving the sort of decline here in terms of client interest? Because it is a specific market. You kind of got like restaurants, and there's a specific use case. People wear them and we're really loyal to them, but there's not very much unique about a lot of them. And I wonder if that's something that's driving it, if you guys see that at all in the data.
Yeah, I think you've got the ugly and comfortable niche, right? That's kind of what Crocs hits, and I think that for a while it was novel, and I don't want to use the word fad because I think that it's definitely stronger than that. But I do think that it's definitely moved away from adults and it's more towards kids, and that's a smaller market, frankly. Even in just relationships that I've seen, Hey Dudes has also kind of gone away with adults, and you see them more with kids. And so it's just, I think that the perception of the product being ugly is just kind of faded away a little bit with adults. And I think that they're focusing on some of the kid stuff, like you guys showed there, all the, I forget what they're called, nibbits or something like that. I'm sure my kids are going to get mad at me for butchering that, but the little things that you plug in, that's great. I mean, you got to hit your core market, but I think that they need to do a better job with just broader appeal. And I think that's one thing that Uggs has done with Deckers Outdoors. They've done a fantastic job of that. They're kind of making a comeback. In fact, if you rewind like folio data 5, 6, 7 years, you'd see us saying the exact opposite. Uggs are out, Crocs are in, but now it's flipped, and that's really interesting because, like I said, the stock has done really well over the last little bit. They in January they had an upward revision where they're saying that Crocs are going to be up about 10% on a year-over-year basis. Hey Dude's down almost 20%. So it's good with the revenue side of things on the revision, but last quarter they got just hammered. So they were coming from a lower bar. I think the stock was down 9% after that report. So I think a lot of the bad news is priced in. I think a lot of the good news is priced in. But I would issue some caution here if you're thinking about investing in a
Meta bounced back up.
A lot of the ones that we profiled on those charts are better investments in my opinion than Crocs here.
I think you put your finger on one of the big issues here.
Oh, we did.
And that is the demographic that seems to be drifting lower and lower and lower. That said, there's a lot of healthy things about this company. They're buying back stock. They're reducing debt. They're buying back, how about this? They've got $900 million left on a stock repurchase program. That's 14% of the shares they're buying. A massive amount of this company. So they're doing all the things that a healthy company does, Landon, but your data certainly points to a different idea.
Yeah, it's just, you want to see a lot of growth. And I think that you can be healthy without a lot of growth. And I think that's kind of where we're at is like, okay, this is a solid company, but the ratios or the growth numbers that we've seen in the past and, like the summer of 17 or 18, those were some of the better times for Crocs as far as the growth goes. And now we're starting to see very stagnant growth. In fact, negative growth as far as consumer interest and demand. So I think that both things can be true at the same time. They can be healthy, but it can be a little bit less appealing if you're thinking about, what's the PE ratio, what's the growth going to look like over the next 2-3 years. And right now, everything that we've got is just a little bit on this company, right? We're not saying smash the sell button, but if you've got fresh money looking to invest in shoes, there's a lot of better places, I think.
Landon Swan, we appreciate you coming on as always. And by the way, the perception of ugliness is not perception, Landon. They are hideous. But my kids own several pairs, so who am I to talk about taste? Landon Swan, thanks for coming on as always. Good to see you, buddy.
Thank you.
All right, Nick, let's get to a trade on Crocs. Now, here's the stock's trading about $106 and some change. Yep. The expected move about $9.45. Yep. So the paper money trade that we looked at here is, and this is more of a discussion, it's more of a lesson than anything else. Yep. If you line up the expected move with the trade you're going to do, the trade would be the 1 week, February 23rd to February 16th,
SMCI has pulled back.
We've seen throughout this earnings season is beats or misses and outsized moves bigger than the expected move. The 115 call calendar is trading 40 cents right now. I think if I update it, it's trading about 45, 47 cents.
Very good.
If you were to move to the 120 call calendar, there's the move on the 115 call calendar. If you were to move to the 120 call calendar, that's trading about 38 to 40 cents. So the lesson is strike selection, Nick. Your thoughts on how to choose the right price. It gives you the expected move, but that's not the answer to the question. That's more of the question, Nick.
Yeah, we can tie this back to our last trade too. You have to look at the expected move. You also have to look at the max loss in that trade. For example, the trade we talked about prior on Deere had a short calendar component and a cost to that trade. Mm-hmm. So your strike width plus what you're taking in, what you're spending, so your loss is bigger than the width of your strike.
Yeah, Deere's the $11 you spent and the $10 on the
So it's a huge maximum loss. Right. Here, right, it's completely what you're spending on the trade.
This is a 1 week calendar. The risk is the debit on the trade.
The risk is truly confined to the debit on the trade, but the expected move doesn't tell you that whole piece of it because the volatility component of that matters a lot, right? So when you get that, assuming we get that decay in the front month, and it's weird because the decay almost always happens. We can't say always. It always happens, but other things kick in after that decay, right? So if you get a huge move, right, the actual intrinsic value of that option works against you, right? So you got to be careful in selecting because we do get an outside move, which we've seen to your point, more of on both sides of the market. Companies doing really, really well, top and bottom line, have exceeded that move to the upside a lot this earnings season.
Strike selection is so critical.
We haven't had as many beats, but when they beat, there's a pretty decent move to the upside.
But the beat's on the downside. Shopify.
Yeah,
right?
yeah.
The expected move in Shopify was to the 185 strike. The stock went to 178.
Exactly.
So I mean, there's so many positive things with a calendar spread, right? What it does, it's positive theta. You're using the divergence and the implied volatility to cheapen the net debit. But you got to get the strike close to right.
You got to get it closer. If you blow, like we were talking on the last thing, if you blow through it, so you're typically better off going a little bit further out, even though you're going to get less of a credit. So the trade-off when you go further away from the money and use that expected move, to call it to your advantage, go further.
Yeah.
When you sell that option, yes, the vol is elevated, but it's further away from the money. You're going to get less for that, so you're offsetting the cost of the long backdated option by less because you've gone further out.
Yeah, you always got to understand the fact that when you're doing a calendar spread, right? It could be, you could have the right direction, but if it moves past your strike far enough, your profits are going to go up and they're going to start coming back down, much like that profit graph. We've seen it. We saw it in Shopify. We saw it a couple quarters ago when Nvidia had their big move. Right, you get the expected move, and then you get the actual move, and that's where really the risky part of the calendar spread. Now, the good news is, all you have at risk is what you paid for it, right? There is some exercise and assignment risk if you go in the money, but that's something that the risk, as long as you close the trade, is the debit paid on that trade.
I'm always a big fan of when you're setting these up. Look at it as a package.
Yes.
On the Analyze tab, and we always show the complete package on the screen. And then also set up the two trades individually, so you can click on and off. And you set it up as a whatever it is, a calendar, a vertical, diagonal. You can't separate it out and select the individual strikes. If you set up the calendar as the individual strikes, you'll see the much more obvious graph, and when you see that, you can see this is what I want to happen in the short term. This is what I want to happen in the long term.
I'm liking this app a lot.
When you see that peak in the trail off, the Analyze tab is assuming pegging that strike, and then it expires worthless. Like looking at it individually helps you really visualize and understand where you want it to go and when.
I love the discussion on the nuances of the calendar spread. It's always something we look at and talk about on this show. All right, let's take our final break of the show. Coming up next, we're going to talk to Ben Lichtenstein with the market update. We're going to talk to George Tillis talking about Cisco Systems, also coming out with earnings. Nick will stick around for one more segment. Take our final break. See you in 2 minutes, everybody.
Number. It wasn't something that changed the trajectory longer term, but we got so used to downside surprises on inflation, and everybody, I think, decided to just check that box off. And, inflation's taken care of. We were worried about growth. Now growth seems okay. And so I think it was about the bias. It was almost, this is going around yesterday too, almost
SPY's at 200.
Right? If you thought there was the possibility
SPY's
of
at the 200.
Surprise, there would be more people who were thinking you had that.
On the 1 minute, SPY.
In a completely out of whack number, market response, because we were so wound tight at a record high and everything else.
That's the thing. The market rubber band was stretched pretty wide, especially in some places in NVIDIA, ARM, and things where we could certainly look at that and understand it. I'll see you on closing go. Mike, thank you. Mike Santoli, our senior markets commentator. How about Cisco? Higher ahead of earnings in overtime. We have plenty of ownership on the desk, too, which is why we'll give you the setup next.
Jets also having a good day. Almost hit the 200 yesterday on the 1 out, 30-minute.
The fourth largest build that we've seen all year, with the EIA coming in today and reporting an inventory build of 12 million barrels. The API also reporting a large one yesterday on the close of 8.5. So even more so interesting to see crude again charging higher, but I think that does explain some of the weakness we've seen as of recent. Now gasoline, we saw a couple draws here. Gasoline's actually back to the 200-day moving average now, so we've seen gasoline inching up. It was at the end of 2023, we were trading 196. Now we're currently trading 240. So again, kind of feeding into some of those inflationary pressures we're seeing. Energy's definitely at the core of that conversation.
/CL.
So lots to keep an eye on here, Kevin. Market's on the move here as we head into this third trading day of the week.
Thanks for coming on, Ben. Ben Lichtenstein, host of the Future Show every morning on the Schwab Network. Make sure you check him out. 8 o'clock Eastern Time. Now, let's bring in live from Salt Lake City, Utah, Mr. George Tillis. He's going to talk about our final trade of the day, and that is Cisco System. George, this is a legacy, old school tech name that, you know, that has struggled lately, even though they seem to be putting up pretty good numbers, George.
Yeah, that's the thing. I mean, first off, it is a legacy value name in the technology space, and effectively, you know, you're right. If you look at, you know, what's going on from a sales standpoint, the company is expected to report an actual decline for the quarter at around 12.7 billion, down about 6.6% compared to 13.6 last year, and even earnings per share are expected to be down about 4 cents compared to 88 cents last year. So they're expecting about a 4.5% decline in earnings. But I think what's happening here, Kevin, is more of a normalization of Cisco's business. I think last year there was a big boom in network gear demand associated with artificial intelligence. You can actually see the infrastructure stocks. Now I'm going to throw in Aristanet, which is one of the mainstay competitors of Cisco Systems. That company is really a growth stock versus a value stock, which has grown about 9 times the earnings growth versus Cisco. And if you look at Aristanet, it actually has performed about 10 times in terms of performance than Cisco Systems in the past year or so. But I think if you look at the server network markets, the data center markets, the artificial intelligence demands, there was huge demand last year. But I think what's happening with Cisco is looking at the forward guidance, they're not expected to grow very much going forward. So if you look at the last 4 quarters, in terms of earnings estimates, it's about $2.62, and they're only expected to grow those earnings by about 4% for the next 4 quarters. So I think what we're seeing is essentially normalization of the estimates for Cisco, as well as the fact that the company is actually making a pretty big acquisition. It hasn't come to fruition yet because it's seeking a regulatory approval for Splunk, which adds to, of course, the hardware component of Cisco's business. They have been adding software-defined networking, while at the same time they've been deploying cybersecurity, and that's where Splunk actually brings more value to the business in the long run.
Yeah, Splunk is a big acquisition for them. And you're right, George, they put up good numbers, but they guided lower, and I think that's what hit the price. George, tell us, we got to let you go. We're running a little short of time. Thanks for coming on, as always, George. Appreciate it. All right, Nick, trading something like Cisco is tricky, right? Because it's not an incredibly volatile name. And last quarter, they did guide for some softer numbers, and they hit the stock based on that. Now the stock has recovered slightly, but the question is, they have a healthy balance sheet, they have healthy free cash flow, they have a lot of solid, but their guidance is very important. So the trade that we looked at for this was something where a range-bound strategy on the downside, taking advantage. And here's what it is. We went to just this week, a pure earnings play, and sold the 48 straddle. Now, stock's trading just under $50, and the expected move is a little over 260. So selling the 48 straddle is a healthy but muted downside move. Then, what we did against it, we bought the 51 call and the 45 put. So we did the iron butterfly, targeting that 48 strike. So what we're hoping for here is a drift down towards the 48 strike. The credit on this is $2.10 is where we took the credit. So the risk on this is $90. It's the difference between the $3 strike on $3 spread on either side and the credit that you take in. Nick, your thoughts? We got about 2 minutes on a short iron butterfly.
Well, you don't need that much time to explain this graph, unlike the other ones,
Thank
right?
you.
It's much more defined because
Yes.
there's just the vertical component. There's not the time component. So very short dated. The credit is the potential that you're fighting to keep on this.
Right.
The risk is what you're not taking in with the difference in the width of the strikes. We always say this, but you look at that graph. I love the Analyze tab. I'm kind of talking a lot about that. That peak is very, very unlikely to be realized. Even if you peg it, you have to manage this at expiration. You
Sure.
don't want to go into it with potential to be a sign.
Yeah, that peak is not tomorrow. That's Friday's close.
That's Friday's close. So
Right.
even if you get that move tomorrow and you're right there, you still have to manage this. You have to know your expiration risk. You're likely to be assigned on one side or the other. You've made this directional in the way you've constructed the trade, right? So you've said, I'm going to take $1.50 basically off of the stock price based on what you said. I was looking, I was surprised there was 24 EPS revisions lower this quarter.
Exactly.
So I think you start to play the fundamentals into this, and it informs how you set up these theoretical trades, because you're saying the fundamentals are all sort of stacked against it. If they surprise to the upside, it's still defined risk. And you do have some room. You don't just have to pin 49. You can get down to 48. You can get down to sort of 47 and still be fine. So if they have a little bit of an outsized move to the downside, you're still
And why
okay.
did you pick 40? Why did I pick 48 on this paper money trade? Look at the chart.
Yeah.
It firmed up on the last move right around 48. It's since moved off there. That's why we brought in some technical analysis to look at where the stock had gotten some support before. It was right around the $48.
Just $2 on the expected move. Just over $2 on the expected move. So you're slightly inside of that, but if it overperforms that vol by a little bit, you're still okay on this trade.
Yeah, this is a trade that takes in the premium first, and your goal on this trade is to buy it back for as little as possible. But Nick mentioned something very critical. Because you're short the straddle, one of those sides is going to be in the money. You are going to have to manage this trade before the end of the day on Friday. All right, that's our show for today. I want to thank Nick Theodorakis for spending the last hour with us. For all of us here at the Schwab Network, have a great day and a great afternoon. Jenny Horn and Alex Coffey coming up next.
Goodbye. J.P. Morgan been going sideways. Oh, JetBlue. After yesterday's deal, JBLU. You know what I'm talking about? That's what I thought. You don't know. Little Carl Icahn deal. Whoa. Definitely hit my resistance. The fear and greed index zone moves to greed zone. I'd like to know where we've been. I think that they're wrong. A little pop on Netflix. To a double top. Option. Whoa, what's going on? Oh, that was deer. And the vertical put.
Stocks. Coinbase has earnings tomorrow after the closing bell. Bitcoin futures are up about 4.7% here in real time. And then last but not least, for under 30 today, we will look at Topgolf Callaway, also seeing a nice lift on the back of its earnings. And everything is moving to the upside, Alex, where all my price activity is moving in as we speak, because we're just seeing momentum here continue to move to the upside.
Yeah, typo resulted in billions of dollars of movement and lift after hours. Look, I'm of the opinion it's inexcusable. I mean, you check the list multiple times like Santa Claus, make sure it's right. How do you make that mistake? I mean, that's a conversation for later on, possibly off air. I just don't understand that, but certainly some wild post-market activity and lifts. I'm excited for the FOMO conversation. Is it the stock that needed some upside, and it's finally getting a little bit of love here today? The trade's near 15. Let's do up or down vote, though, not endorsements, not recommendations. All earnings previews all over the board and types of companies. Let's start with Twilio.
Yeah, absolutely no theme except for the fact that all these companies to kick off the show do have earnings. So Twilio is one that is up about 14% year over year, but it's looked somewhat disappointing this year. It's down about 7% since the start of 2024. We did get a pretty mixed picture from an analyst at HSBC last night, downgrading shares to reduce from hold. Price target ever so slightly cut to $61 a share from $62.
TWLO downgraded.
Downside from where we're currently trading. But they do believe that overall that this name is trading at a large premium to similar low-growth companies in the sector on non-GAAP valuation metrics. They do believe that investors will be increasingly inclined to treat the company's share-based compensation and reoccurring one-off costs as a regular expense, given the company's low growth profile. However, they did actually say that they're facing now competition in its efforts to expand its data and application segments, which has not yet brought its sufficient scale and success. So perhaps actually some room run for shares in that regard as far as growth. But overall, this company has had several rounds of layoffs. In December of 2023, they announced a 5% workforce reduction. That follows layoffs we saw back in September and February. But actually, over the last several months, we've seen some significant upgrades to its overall earnings estimates for this current reporting period. Actually, 10 upward revisions to its earnings and 9 upward revisions to its revenue estimates. So, Street is getting more favorable on this name, despite the fact that shares have gone down, Alex.
Yeah, well said. And it's a name that going down doesn't tell the full story, as it's just been decimated over the last few years. This is another one of those kind of casualties of that post-COVID run-up, where the love that it got just far exceeds any love it's getting now. But it has had an undoubtedly impressive rally alongside the market going back to the end of October, early November of last year. The stock not quite doubling, but it's in that kind of stratosphere here where it's moved up tremendously on a percentage basis. We'll see if it can continue that momentum post-earnings. Next one on here has been a longtime favorite of the guys over at Likefolio, and that is Crocs. A company that seemingly has been able to reinvent itself despite the irony, or maybe because of the irony associated with this product.
You know, I have my own personal feelings about the Crocs shoes, and I do feel like I see them more and more among people, like, not children, people our age. So that's concerning. But as far as their quarterly report goes, that's out tomorrow morning. Analysts are expecting the earnings to drop around 10.5%. Revenue expected to climb about 1.5%. That's modest growth for Crocs, because we're used to seeing pretty substantial growth from this company, as it's been somewhat, I mean, over the past several years, this was at one point a really strong player. It's since somewhat fallen out of favor. But I was looking at overall the breakdown of this company, because when you break it down by geographies, we are seeing Middle East, Europe expected to rise, their sales about 2%. North America is expected to climb about 5.5%. Asia Pacific improvement of 26% year over year. So I was like, where's this revenue miss coming from? However, Crocs brand is expected to increase 9% as far as its sales, but Hey Dude is expected to drop almost 20% from last year. So that has been a pain point, as that Hey Dude acquisition was at one point a massive discussion of strength among the analysts. That has since not been so much the case, as we are expecting at least some operating margins to improve this quarter, but Hey Dude seems to be just overall dampening sentiment on their growth.
Yeah, and it's reflected in the wholesale expectations as well, as sort of those in-store purchases are expected to be a little bit weaker, but their DTC, direct-to-consumer channel, is expected to be strong and in the direction that trends are going. Not to say that that's good for this quarter or bad for this quarter, but that general trend of moving more direct-to-consumer, having that brand awareness where you're thinking, hey, I want to buy Crocs, I'm not going to go to the mall, I'm going to go to crocs.com or whatever the website is for their brand. That's far better margin-wise for the company in the long term. So it is a trend they want to see, but they'd like to see all of their business doing well, including Hey Dude.
Yeah, and that's a good point as well. And they have like these great celebrity endorsements. Like Justin Bieber is one that I'm aware of, but that hasn't seemed like it's really caught a lot of the attention of analysts or even investors or even consumers, because I think the target demographic, and I'm definitely not buying Hey Dude or Crocs shoes anytime soon. But next name today here is Shake Shack, another name that was at one point one of these really strong points of strength in its respective industry. I mean, overall in the consumer discretionary restaurant space, it still does look strong, about 35% up over the last 12 months, but it's fallen about 6% from its highs, and it's also off of its all-time highs by about 45% here. But estimated earnings are expected to break even. That would be an improvement from the losses per share reported a year ago. Revenue is expected to come in around $280 million. That would be about 17% year-over-year growth. We are expecting some tailwinds to be the fact that same-store sales are expected to grow. Store openings and overall digitalization is expected to be a bright spot. They've really been trying to improve their kiosk experience through greater omni-channel adoption, which is expected to, or the hope is that it results then in these higher average checks overall. However, higher costs are going to be, I'm sure, mentioned on this earnings call, as we've heard that from the major even staples players like Coca-Cola mentioned that on their earnings call. But premium ingredients have witnessed a significant increase in a very short period. So for that reason, I mean, paper costs, labor and labor-related expenses, as well as overall operating expenses, expected to dampen their overall growth.
Yeah, this is a company that I kind of consider elevated fast food. Fast casual. It's not as quick as maybe going through the McDonald's drive-thru, but it's elevated not only in maybe quality and perception, but in price tag as well. You go in there, good luck spending under maybe 25, 30 bucks just for yourself. And I'm not the biggest eater, but I can tell you what, that'll take some money out of your wallet if you go to Shake Shack. Maybe it's worth it too. It's pretty good stuff, but. From a standpoint of growth, you talked about same-store sales growth, expected low single digits, but revenue expected in kind of the near 20% range. I think it was like 17%, upwards of 18%, depending on what company you're looking at their estimates. How does that happen? Well, they're opening new stores. It's still a growing company as well, on margin expansion as well, so maybe we'll see an increase on the earnings front too. So excitement when it comes to Shake Shack, but not necessarily today, as the stock is modestly under pressure into this report.
It's down about 0.7%. Yeah, good point. And I have to say that I completely agree. This is not cheap fast food by any means, but I'm more of a hometown favorite. I like Portillo's, which is I think like the equal to Shake Shack here, and I'm of course Chicago bias. But the last name today here is Penn Entertainment. We haven't looked at this name in quite some time, and I think that there's a pretty good reason. It's down 30% year over year. It just has fallen out of favor with, like the FanDuels, the DraftKings, the monster names in this space. What has happened to Penn Entertainment? But we do have earnings tomorrow morning. We are expecting to see a revenue decline of about 2.5%, which would be a further deceleration from the 0.8% year over year that it lost in the same period last year. So continuing to lose on its top line. Adjusted loss is expected to come in around 46 cents per share. But so far, actually, what we've heard from others in the space, being MGM and Boyd Gaming, they have exceeded top-line forecasts and seen some pretty nice year-over-year growth. But MGM was met with some pressure following its earnings, whereas Boyd Gaming actually saw a nice lift on the day after it reported. So that really is a mixed picture when looking at the gaming space. And all these companies, frankly, operate very differently. I think it's kind of difficult to compare at this point. But overall, when you look at the overall gaming segment space, you've seen the stocks on average rise about 3% over the last month. Penn has been an outlier. It's declined almost 2% in that same time frame. So that's also not exactly what you want to see. However, we do have DraftKings, who reports tomorrow after the closing bell. So that will be another one we will be very closely keeping an eye on.
DKNG. Yeah, there's a lot going on in this space. There are certainly some differences between these companies, sort of your legacy players, of which Penn is largely in that camp, maybe smaller than your MGMs, your Caesars, etc., not in the same regions either. They're almost hospitality companies as much as they're becoming online players. The DraftKings of the world, FanDuel, parent Flutter, those are like really focused on this online gaming world, which is where all the kind of the rage is in the moment when it comes to investment. That's the growth driver in this space. So what did Penn do? Well, it partnered with Barstool, several years ago. That got all of this excitement. It ran up a lot, but it broke off that partnership. Barstool now, with a very engaged fan base, whether or not you like the company or not, or the personalities there, the fans of their content are engaged. They buy T-shirts. They go on these sites. They support the brand. They're now partnered with DraftKings. So not only did they lose like an important partnership, they actually lost it now to a competitor directly, and they partnered with ESPN. Now ESPN's a bigger brand, but is it as engaged of a brand in terms of the following? I'm not so sure.
Yeah, and I would say the benefit of Barstool was always that they brought in this major audience at relatively low marketing costs, because they're all over social media. I can't even call them influencers, but they somewhat are. But they have a massive, massive, massive following, and it's been actually kind of interesting to see now founder of Barstool, Dave Portnoy, since he broke off, he's been tweeting nothing else but stocks. He's like the stock man now that he has no Penn ties.
Yeah, and it's not even that. I'm not getting to it. No one's denying that ESPN, maybe audience-wise, is bigger than Barstool. I don't think that's the case, but everyone might watch ESPN that's a sports fan, but not everyone is like a rabid ESPN fan.
Right.
And that rabid nature of the Barstool fan base is what was monetizable. The fact that, you might have 5, 6, 7 out of 10 of those in the audience wanting to support the brand with their dollars. You're not getting anywhere near that with ESPN.
Yeah, that's a really good point, too. I mean, that is a brand, love them or hate them, they have a very strong, very loyal overall base that follows them very closely. So I think that's been a hit, but we'll be obviously following that name when it reports tomorrow morning. We will also be looking more at Shake Shack coming up next. We'll be diving into some example trades as well as some technicals to keep on your radar. Next Gen Investing will be right back.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location, moving funds between.
How important is that to the business going forward? And have you seen any of that momentum continue that you saw in the fourth quarter? Is it only based on prices? And if that's the case, is that sustainable going forward?
Yeah, I mean, we typically what we've seen, and just to level set, in Q4, total quarterly revenue was a little bit over 470 million. Of that, 43 million was crypto revenue.
Yeah.
So it's important, and we're a major player in the crypto market, but we're also a diversified business. We've added all sorts of other revenue streams, from assets-based revenue, subscription revenue with Robinhood Gold, and all of the other assets that we trade. So certainly it's important, but it's still sub 10% of the overall revenue mix. And I think what we focus on is there's periods of price appreciation in crypto, bull runs and kind of winters. And in the bull runs, you tend to see a lot of retail engagement and excitement, and volumes can tend to increase quite dramatically. But in other periods, we've continued to invest. We're continuing to add functionality. We're expanding in the EU as well. And there, we've been tracking our market share. And if our market share continues to increase during the winters, then I think that positions the company very well to capture the lion's share of the activity during the bull runs.
You sound a lot more aggressive on the analyst call, I have to say, in terms of going after Fidelity, going after Schwab. You've now got $100 billion in assets, but I was looking, Schwab's at 8.5 trillion, Fidelity 12.6 trillion. They don't seem to really be shaking in their boots in terms of Robinhood coming for their client base. Should they be worried at all? And when will Robinhood get to that level, get to the $1 trillion in assets? What are you doing to make that happen?
Well, I would say that at first, nobody was really concerned when Robinhood came out and offered commission-free trades and no account minimums. They would say, oh, you know, we don't want those accounts anyway, and our premium customers actually don't mind paying those commissions. And then you saw very quickly that narrative shifted, and you know, the industry was forced to adopt our business model largely forced to adopt the user interface. You know, there's a reason why every brokerage app that's relevant starts looking more and more like Robinhood, right? So I think it's certainly the incentives are for them to kind of ignore us taking assets, but I think if we keep plugging away and continue to take share, they'll have to respond somehow.
What's to keep them from responding in the way that you guys have offered incentives to take market share and to offer, you know, 1% matching and things like that? Couldn't they do the same thing? You kicked off the brokerage price war.
Yeah.
What if they adapt and try to steal some market share back?
I think they probably will try limited things, but offering 1% matches or 3% matches when you have 8.5 trillion in assets can get quite expensive, no? So, you know, it puts a lot of pressure on the financials. So it's a little bit of, it's a little bit of the innovator's dilemma there.
We'll see. And actually, last question. The last time we spoke, you had not seen Dumb Money. Have you seen the movie yet?
I watched some clips of it, yeah.
What do you think?
I think that the story of the real story of Robin Hood, the sort of Pulitzer Prize winning, Oscar winning narrative has yet to be told. So, yeah, hopefully someone will figure out how to tell the true story, and maybe the book and the movie will do a little bit better in the marketplace.
Well, Steve, Vlad, it's great to see you in person. Thank you so much for being here. And Brian, we'll send it back over to you.
Kate, have you seen the movie? Have you seen the movie, Kate? Because I have not.
I hate to say it, I actually haven't seen it, and I think
Well,
myself
apparently
and a couple of
I'm in
our
it.
colleagues have a cameo, but it's on my list.
Apparently I'm in it, or my voice is in it, and so people keep pinging me. They're like, I just watched Dumb Money.
You're in it, I know, exactly.
Well, I think my voice is in it, which
Babe
joins.
was in it. Sarah mentioned this morning that he should have won an Oscar, and you know I'm with her. So.
Yeah, I want a slice of that. All right,
You were
Vlad.
snubbed. Favor was snubbed.
Well, it's now almost 5 more minutes, and the Fat Cats will be back. So, see how my trading changes. I made a little pullback here on the SPX. Broke support. Not 100% bullish either. The SPX is at the 63 and the 21 right now on the 1 minute. JetBlue and Apple, Boeing at 202. Boeing took another pullback. Day 1 hour. I have to put it on watch. Coca-Cola and Goldman Sachs. No more ceasefire. Oh boy. Yeah, I figured that probably wouldn't last long.
worth. But at the same time, this is not going to be a moment in time where everything blows up. It's just going to be kind of dull pain that continues in the system.
And while your next guest agrees, times are tough for the industry. It's something that he has experienced before, and he thinks relief will come, not from the banks, but from the private credit industry. Joining us now for more is billionaire real estate developer Don Peebles, chairman and CEO of the Peebles Corporation.
Yeah, I know Peebles.
Don, this sort of rolling real estate apocalypse has not happened. It has not come upon us yet en masse. Certainly some buildings. You and I have talked about this a lot. Right now, can you figure out the value of a building? I read an article this morning that one of the problems is that nobody actually seems to know what a lot of these buildings should be worth.
Well, I mean, I just heard Richard's comments, and Richard's a good friend. I saw him last week, and he's certainly very pessimistic about the market. I'm pessimistic about office buildings as well, but I don't think that the reason we're not seeing activity is because people don't understand value. I think we've got a good handle on the value of many of these buildings. If you operate from the perspective that office occupancy has changed forever until something else shocks the system, you know, probably decades from now, we're going to have a hybrid workforce. And so that has had a major impact on office buildings. But this is different, by the way, than, say, the early 90s, because the banks don't have over leverage. They are 60% of the values of those assets when they made the loan. So they can take a 40% hit in value and not be hurt. It's the equity that's wiped out, and it's the mezz lenders that are wiped out. And the banks just don't want to deal with all of these headaches. They were hoping things would change. They're not. So I think we'll begin to see more asset sales happening mid-year into the third quarter and fourth quarter, where we'll see a lot of activity, I think, in terms of commercial office buildings.
I heard a crazy story from a good friend of mine, somebody you probably know, but I won't say his name on the air. We could talk offline. And he told me a story which I thought was insane, but I can't prove it. You probably can, which is he was telling me the story about in New York City, a building, and let's say it was bought for $700 a square foot. Okay, it's somewhere around there. And it's in distress, and they just sold the building for like $350 a square foot. So the building was sold. The guy that bought it lost basically half his value. But in the real estate transaction, New York City valued the building at $703 a square foot, even after the sale at half its value, because they have to pretend this is not happening for tax reasons, for tax revenue reasons. Is that possible?
Yes.
Yes, it is. In fact, I started in the real estate business as an appraiser and a consultant, and I built and owned the largest property assessment appeals business in Washington, D.C., and we prospered in the early 90s because the government was refusing to recognize that the massive decline in commercial real estate that took place. And so what's going to happen is the governments are going to force property owners to sue them and appeal their assessments and sue them to get their values lowered. And that's because they cannot afford the massive revenue loss. D.C. alone is going to be down $400 million in property tax revenues this year alone.
But that's insane. I mean, I want our audience to understand what we just said and you just confirmed, right? Let's say they have a house that's valued at $500,000. Subprime hits, they sell the house at $250,000 because they can't afford the $500,000. They need to dump out of it. And whatever town or state they live in values the house at above $500,000, completely ignoring the reality of the situation because they're desperate for tax money. I get why they're doing it. It's wrong, but I understand it, Don. But is that kind of behavior going to dissuade sales? Because future buyers are like, I can't be on the hook for those taxes when I'm underpaying for a building.
No, I don't think it will, because what happens, it'll affect residential property owners. So DC, for example, has about 170,000 parcels that they assess annually. A small fraction, about 4,500 to 5,000 appealed when we were in that business. Mainly commercial property owners. Commercial property owners will use the system, they'll hire lawyers and they'll work the system and get reductions. It's the residential homeowners and small property owners, small commercial property owners who can't avail themselves of the appeal and litigation process to get their properties down. And so these governments will take a view of let's let everybody fight for their reductions and we're going to hold values. And New York, DC, and others are going to have to do that, or they're going to almost be insolvent.
Wow, I mean, that to me is one of the most interesting stories, and it just goes to show you how needy DC and New York City are for money. Not the case with Miami, though, is it, Don? I mean, every time I go to Miami, it's like warmer, and there's a new building popping up, or my buddy Tillman's opening a new restaurant, whatever it is. The growth of Miami is just gobsmacking.
Yes, it is. In fact, I'm in Miami right now, but when we came down to Miami in 1997 and started developing the Royal Palm Hotel, it was early in South Beach's history, but what we saw then was a city being built. And we're seeing a global city continuing to be built. It would be like going to New York City in the early 1900s and watching that city build and being a part of it. So Miami has a tremendous run ahead of it. It's going to catch its breath, though, by the way. Things are going to slow down a little bit. But Miami's got a great runway ahead of it. South Florida does. Yeah. I mean, Steve Ross is building office buildings in West Palm. Great market there, too.
But it will slow, to your point. I mean, nothing goes up forever, or does it?
No, Miami will slow. We're seeing it now on the residential side. Miami's slowing down in terms of volume, and prices are pulling back a bit. The COVID euphoria is over now. And now we're seeing a more stable and level environment, which is going to be good because in order to get more businesses down here, things have to stabilize a bit.
Don, I appreciate it. I don't know if you can see me. I can see you. But I got to say, you have fantastic taste in ties. Go back and watch the segment, and you'll understand what I'm getting at. I think we have the exact same.
Thank you. I praise my wife.
I think we have the exact same tie on, although yours is probably much nicer than mine. Don Peebles, thank you very much. Appreciate it. All right. The 13 Fs are trickling out. If you don't know what that is, it's basically the hedge funds come out every quarter and release their holdings. That's a much better way to say 13F. Leslie Picker has Tiger Global's latest filing. Leslie, we also call it whale watching.
I don't know if we dubbed it whale watching first. I don't know where that came from, but no, you're exactly right. These are some of the largest managers. Equity, long holdings, there's some options in there as well, backdated to the end of the year. These are fourth quarter filings.
Oh, there we go.
Came out
SPX.
A short while ago. Interesting takeaways in this one. They're reducing exposure to some Chinese names. For example, they sold out of a position of Alibaba. That stake was worth about $128 million at year end. They also pared back JD.com by 11%, holding about $250 million in JD at the end of 4Q, and sold out of a small stake in Kanzun. Also, Tiger Global did reduce some exposure to big tech names like Alphabet, Meta, and Microsoft, as well as NVIDIA. Could be a little bit of profit taking there, but Tiger did increase its stake in Amazon by 24%, and it upped its stake in Taiwan Semi by 48%. Also worth noting, a sizable slash in Uber and Workday, each of those pared back by 41% and 30% respectively. And worth noting, Brian, this was kind of a comeback year, 2023 for Tiger Global. Their firm was up about 29% in 2023. So kind of interesting to follow these moves and see what led to that performance. Back over to you.
Certainly is. Leslie Picker, thank you very much. I know that we're going to see you a bit later on because apparently I've got to read a poem for so-called activist investor. Okay, this
for
is
an
not.
Activist.
I'm going to say this is. Usually I just ignore the prompter and say what I want, but I've got to read this because it's a poem on like the TV news anchor of Yates. Roses are red, violets are blue. Do blocked deals attract you?
Yes.
Again, folks, just reading here. It's, all right. Leslie Picker knows the answer to that. She's going to join us to explain. Meantime, a lot of buzz around Disney lately after their announcements about Taylor Swift, Epic Games, the Fantastic
The answer is yes.
But Nelson Peltz called it their spaghetti against the wall plan, telling CNBC that Disney's management might be a day late and a dollar short.
It's not that this company sells at a multiple of their pronouncements, a very high multiple. They made these announcements like this management team just came into office about a week and a half ago. They have been here for 20 years. All of a sudden, they've awakened and they want to start making all these announcements.
the iron butterfly, the opposite of the short. It needs a move, and it needs a big move to happen during out the duration of this outside the width of that debit. So basically, there's a $5 wide range between 13 and 18, Jenny, where this is going to lose money. It needs to go outside of that.
The
range.
lift.
It needs to either sell off below 13 or needs to rally above 18 by March.
More
22nd,
SPX,
or this
boom,
is a
boom.
Trade, but it is risk defined to the debit spent of 250. And you really only lose that full amount if it's exactly at your strike. So there's also a scenario where you lose money on this trade, but it would be less than that max possible loss as long as it isn't exactly at your strike, pinning it, which is the worst case scenario. But looking for volatility to continue in a name that's delivered that over the years.
And right now, I mean, we jumped as high as $16.77 earlier in the session, but we've been stuck at, like $13 for quite some time, better part of like the last month. So reasonable to think we could see things unravel, or of course, maybe this name just takes off, but we're still nowhere near where it did go public. It was, this name is, when you zoom out and you look at, actually, it takes you a minute because you have to look at the longer term time frame, but we did see shares touch $88 on its first day of trading. We've been nowhere close ever since. So very different story than when closely comparing it to, say, Uber, which is actually our next discussion. So here to tell us now more on everything going on with Uber, which has its own set of news today, I'd like to welcome in Renita Young, Senior Markets Correspondent here for the network. So Uber is a completely different company at this point, Renita. I even have a difficult time comparing the two, but the one thing they have in common today is that Uber's also seeing a pretty nice day, not to the extent Lyft is, but this name's also been a more consistent player in the ride-hailing space.
For sure, it has. One of the first, I'll say. And when it comes to app-based ride-share services, that's really true. But look, this stock is up at a fresh all-time high today, and it's off of the approval of its very first share buyback program. It'll be worth about $7 billion worth of stock. And the CFO calls that really a vote of confidence in the company's strong financial position. And it's because of the past year, Uber started to have profitability finally in 2023. They've seen strong demand when it comes to the rideshare business and more recovery when it comes to the food delivery business as well. Now, it's a milestone after years of burning through cash, and Uber has not necessarily been an investor favorite because it had consistently been unprofitable. But now Uber is up pretty substantially over the past 12 months, more than 115%. And during that time, not only did it report its first annual operating profit, but it joined
Uber.
the S&P 500, which is a significant milestone as well. Now, the company will begin the stock buybacks as it looks to take part. This looks like it'll take part of Uber's comeback story, and it could play a pretty important role in reducing the dilution caused by stock-based compensation. Now, Uber's stock-based compensation expenses rose to about $1.94 billion last year from $1.79 billion in 2022, so this could help fix that just a little bit differently.
Yeah, and I would say all things considered, Uber is, just off of its earnings, it continues to surprise to the upside. It's been frankly amazing to see a company where we were longing for this profitability now be so reliable in that sense. So stark difference to Lyft in that regard, but hey, both names are higher today, so we will take it in the overall gig economy ride-hailing space. We will leave it there. Great breakdown as always. Renita Young, Senior Markets Correspondent here for the network. Now coming up next, it's time to talk another area of strength in the markets today that is actually not Uber or Lyft related. That is Bitcoin, which Bitcoin futures up about 4.5% here. We're also seeing names like Coinbase surging up almost 14% on the session ahead of its quarterly figures. Kevin Green will have more on what's driving this upside coming up next.
SPY just hit resistance. 497.07. SPY just hit my resistance. Well, you did. What you got there? Spy. Yep. Pretty much right on.
Day basis, and I think some of these other complementary businesses are something that they're probably going to double down on in the coming years because of the structural changes we are seeing in the crypto space.
Actually, like everything that you just said, I would hope that that would continue to shape this company. We'd see a more mature Coinbase. But I mean, right now the volatility is absolutely amazing. I mean, we're up 170% on a year-over-year basis, then up 243% off of our lows, while still being off of just 52-week highs by about 15%. So this name moves, Kevin. And so not to be like the total naysayer, but is there any concern about the various SEC and some of the murmurs of overall just the lawsuits that this company is facing? Because that is not exactly what you want when you're trying to build a reputable brand right now.
That's actually a good question, Jenny. That might already be priced into the stock for the most part. And when you usually have these legal items, you know, it can take months, if not years, for them to be resolved. So sometimes investors actually kind of lose focus on those particular items and focus on the here and now when it comes to their business. But that is going to be a risk. I think also another risk is if you see this decentralization of trading when it comes to Coinbase, if they do see flows starting to be reduced here because there's other products out there that investors can actually utilize and manage crypto portfolios. So I think that's going to be something in the front of investors' minds. But going back to the fact that they could now be focusing on the custodial business and their compliance business, something that's a little bit less cyclical in this business, but still something that's structurally needed, I think over the long term is probably going to be the direction that they're going to have to go in order for them to be a little bit more sustainable when it comes to their business, as once again, we have a lot of the competitors coming up into the space trying to take market share from the trading aspect.
Kev, kind of final thoughts and more broadly talking about digital assets and Bitcoin more as a tradable asset. Notably yesterday, we saw a pretty big spike in volatility. I've long kind of stated that until I see otherwise, I see crypto and Bitcoin as sort of a short volatility instrument in terms of seeking risk-taking and looking for that volatility when times are quiet. Bitcoin weathered yesterday pretty well. Now, one day doesn't change everything, but is that a sign of maturation that Bitcoin's starting to kind of have a brain of its own, if you will?
Yeah, I would say from the sources that I have, it's more institutional flows right now that's really providing a lot of the stability. Up to even $10 billion a day could be actually demanded by these institutions for certain positions, Alex. So I think that's another reason why we're seeing this move to the upside, and they're kind of fading against some of the equity volatility that we've seen here in the near term. And if we do see that demand from a nominal standpoint, those miners are also going to need to do as much work as possible. And if those prices go up, we kind of have this domino effect taking place. So I would say after this week, I would say let's make that judgment. But this week, we also have VIX expiration, we have monthly expiration. There's a lot that's happening in the equity option space that's also causing a little bit of this volatility right now.
Okay, I think a really good point also is there's a lot of factors that do tend to play into this name's price, whether it's to the upside or downside, but markets at this point pricing in a $17 move in either direction. So I'm sure based on this company's history, it will be a volatile event as it usually is, but we will leave it there. Really great insight as always. Kevin Green, Senior Markets Correspondent for the network. Now coming up next, last but not least, it's time for Under 30. We're talking Topgolf today, which is up 7% on the back of strong fourth quarter numbers and some strong holiday figures that boosted their overall earnings. We'll discuss that more with George Tillis coming up next.
I was born on the south side of Chicago.
Oh,
It's
yeah.
a long road, but now...
Well, another hour and 15 minutes. 2 hours. SPOT. Broke past the 200 also.
sports apparel, but it's not just Callaway, golf equipment and accessories. It's Topgolf as well, which has been really the story behind this particular name, especially as the number of new outfits or Topgolf locations continues to increase to over 80 locations. But if you look at the earnings, this is a little interesting because the estimates were actually expected to be a loss of 34 cents adjusted compared to 27 cents last year for the same quarter, but they beat the estimates. They did lose 30 cents a share on an adjusted basis, which was down again about 10% compared to last year, but sales were actually higher by 5.4%. They did beat the estimates at 897 million versus 867. But again, you have to consider the quality of those revenues, which include, of course, the new store openings or new location openings for their Topgolf segment of their business, which, if you look at their sales in that division of their business, that exceeded close to 8.8%. So it gives you an idea that, yes, they did expand the number of stores. That increased, of course, top-line sales close to, the 10% or double-digit mark. But at the same time, one of the things I think is going on with this particular company is they're really expanding the business at the expense of, quarter-to-quarter shareholder value. And that's not necessarily a bad thing. What they're taking, I think, is a little bit longer-term look on their business. And they have been expanding quite aggressively outside, of course, the traditional Callaway Golf brand products and accessories.
So George, that's what I find so fascinating about this company. Is it's almost just become the Topgolf story, right? Even though there's another huge aspect to its growth or lack thereof, maybe. So outside of Topgolf, how healthy is this company still looking? Because I understand the enthusiasm and all of the excitement, especially as we see this shift into services and experiences from goods and what have you. But what does the rest of its company look like?
Well, I mean, that's the thing. You could obviously make the case that, obviously they were two different companies beforehand, but Callaway started buying the Topgolf, locations. So they're trying to blend, experiences alongside equipment. And you could also make the case that they're marketing their products within those locations as well. And so that's the marketing shift that they're moving into. I think if you look at the company's total organic business, which includes now Topgolf as well as their hardware, accessories, and apparel sales, they're going to be generating, at least on a forward basis, estimated about 6%, with earnings growth of about 7%. But I think what's going on really is the number of new locations in the expansion. They seem to be on an acquisition spree right now. They're buying smaller locations that are local to specific regions of the countries that are of various names that are competitors of Topgolf. So they're making slow and steady acquisitions. So what's happening is that expenses effectively are higher versus revenue. Now, just to give you some context here, if you look at sales for the full last 4 quarters or full fiscal year, they were higher by 9%. But at the same time, their net income was down 38%. So that tells me that they're basically sending a signal that they're expending quite a bit of money. Now, they're still profitable, but the profit growth essentially just isn't there, and that's a function of spending. So I think that's why the stock's been under pressure, particularly in the last couple of years. But it's starting to look interesting here. So maybe if they slow down their expansion, and this could be a quarter or two, that could certainly manifest in a better earnings profile and make shore up the stock price going forward. Mm-hmm. There's also seasonality to consider as well. We're moving closer to spring, and that seems to be a time when, of course, the aspects of golf become in high demand. So what I'm doing is I'm just looking at, from a level standpoint around the 1490 area. So if it breaks above that on a 2 consecutive weekly close, that might demonstrate a trend reversal in its name.
Well said, George Tillis. A company very vertically integrated at the end market, from clubs to golf bags to apparel and experience, now looking to grow the game of which they sell the products for. So it's fascinating in terms of what they're trying to do. Execution is ultimately going to be what matters in the end. Thanks to George Tillis, as always. And thanks to you, the viewer, for tuning in every single day here on Next Gen Investing. Coming up next is the watch list with Nicole Petalides.
I remember when I first.
She remembers.
SchwabNetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network. Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome to the watch list. I'm Nicole Petalides. It's 2 p.m. Eastern Time, live from the New York Stock Exchange. Happy Valentine's Day. Glad you're able to be with us after a big sell-off yesterday where the Dow was down over 500 points. We're seeing some up arrows, slight up arrows today. Here's what's coming up on today's show. The market's bouncing back from that sell-off. That was all about the CPI and rates, and we'll talk more about that. And we'll dive into that rebound. Or somewhat of a rebound. Energy on the rise, we're watching some of those things, consumer spending, markets, well, those that suffer, and we'll analyze what is going on right now with oil at 77.06. Our panel ready to take a look at Lyft and Uber. These companies are striking as we speak, the airports. And so we will look at that group. And of course, here's a look at the markets. Yesterday, as we noted, we had all 11 sectors with down arrows. Today, a different story. Industrials are higher. We're also seeing communication services gaining, real estate with an up arrow. Right now, energy is to the downside, and so are consumer staples. But you're seeing a majority of stocks higher. S&P 49.77. NASDAQ gaining more than 0.5%. The Dow is up 29 points, and the Russell, the best of the bunch, up 2%. Here's a look at oil and gold. Both are pulling back. Oil at 77.08, and gold at 2003, down over $3. The VIX is at 1476. That's pulling back as well, while the 10-year bond 425 is where we sit there. Bitcoin 51,785. Let's talk about the markets. Kevin Hinks is with me, senior equities contributor, to take a look after that big sell-off yesterday, right? The biggest sell-off of the year, for at least for the Dow, and 90% down day because pretty much every sector was lower. Today, a little bit of green. How do you interpret all of this?
Hello, Nicole. Yeah, I think the next 2 hours are very important. I treat this like the market is taking a standing 8 count. Sure, it's up, but it didn't like what happened yesterday, and it needs to stay up today to stop some of the rhetoric coming from yesterday. And what's working against it? 2-year yields, 4.5%. A U.S. dollar approaching 105. A euro approaching 107. Overall yields approaching higher levels. So, you know, the even crude oil traded $78 and change today before selling off on inventory news. So some of the inflation narrative that is affecting this market, well, we need to get through today and really make it through the next couple days, because yesterday was a big surprise for this market and kind of a wake-up call that inflation is still around, Nicole.
Understood. All right. And then there's Kraft Heinz, which is down about 5% today. Higher prices is one thing that people are talking about. What say you about Kraft Heinz today?
Kraft Heinz came out with earnings this morning, 78 cents versus 77 expected, on revenues of $6.86 billion versus $6.97. That's a miss on the revenue side. The 2024 guidance, operating income up 2 to 4%, adjusted gross profit margins between 25 and 75 basis points, pretty wide range there. Adjusted earnings per share, $3.01 versus $3.03 estimates. So a little bit light on revenue, a little bit light on adjusted earnings per share for 2024.
KHC.
So a bit of weakness here, and as you know, where the market is right now, if you miss or show any signs of weakness, you get punished. That's happening today in Kraft Heinz.
Yeah, understood. Kevin, I had a great conversation with 2 analysts earlier today, Aaron Lash and Rob Moscow. And Rob had a $37 target, but Aaron Lash over at Morningstar actually had a $53 target. So she saw upside potential. She also liked, just so people know, Campbell Soup, Mondelez. He liked Smuckers in that group. So a little staples there for you. Thank you, Kevin Hinks. Good to see you. Now let's take a look at the bigger picture. Andrew Rosen's with us, president of Diversified. Thank you for being here. So how are you
had a pullback.
CPI numbers? Because we had at least one Fed speaker today saying, look, the Fed's looking at PCE 2%. The CPI sort of could be a one-off.
Yeah, thanks for having me, Nicole. I don't dissimilarly disagree, to be honest. I think that PCE is always the Fed and even our firm's preferred gauge of inflation. Anything can happen 1 month. I think that the big story here is we pretty much assume that March rates would stay unchanged. We're not going to lower them or cut rates. There's about a 65% chance when polling economists that in the May meeting they would lower. I think what you're seeing now is the Fed's not going to jump to lower rates. We know they want to get down to 2%. We're probably looking at a June meeting at the earliest to start cutting rates. But is this a macro issue? I don't see it that way.
I see. Okay, so we're at a bit of pause. It's interesting. July has come down. June has come down to a likelihood of a cut at 80%. July, 94%. These were both hovering around 99%. You think we'll get a cut even by July? Pretty sure about that, or not necessarily?
Yeah, I think that's smart money. I think by June is probably still likely, but I think by July, barring some unforeseen data or news or who knows what, I would anticipate that by July we've held rates this high long enough. It'll play through its market. You'll start to, in the economy, you'll start to see
big knife
and autos start to come down quite a bit. From
PX.
where they've been inflation-wise, which has been kind of run away for the past couple of years.
Let me see here.
Yeah, understood. When we think about
How
what's going on
about
with jobs and the consumer. That's such a big
the
part of our
4980s?
economy. How do you feel about that part of it?
It's hard not to be excited. I mean, we just had astounding job numbers, almost double what economists and everyone was anticipating. It's probably the biggest headwind you have from lowering interest rates, ironically, right? Because you figure if we're fully employed and people and wage inflation is still there and we have a strong economy, people aren't rushing to lay off and they're not rushing to stop spending. I mean, consumer spending makes up 70% of our GDP. So it's exciting news. This may be one of the instances where good news may be not the best news for markets, but I think if you look long term, which we are long term investors, I think everyone should be, that's really in the markets, it's got to be encouraging.
Look, we're likely setting up at least for higher for longer, right? I mean,
Okay,
we saw 4.3%
RSI.
on the 10-year. What's your advice to investors now?
Don't overreact. Is always stay diversified. Be a little tactical.
We got shoulder line, shoulder
sort of
line.
micro side of things. I mean,
Could get down here.
Look, I'm a firm believer. If you are investing for the long term and
So we
you
might as well go
are
for the third.
you have a well-defined
49, 64, 23.
policy statement, you'll get through any time quite unscathed. It's those that overreact.
I have to be quiet. Put you on hold for a second. I'll be watching it right in here. $49.80. $190. Oh, 180. Back to 185. Oh boy. Jimmy don't like. That's kind of a hammer. Tweezer bottom for the last 4 minutes. Oh. Oh. What happened there? You see something like that happen? On a spike, and get out of it if you can. I thought I was seeing things. $245. Damn. This is when I go chicken. 270. Okay, there it is. A little bit more. Out. Bingo. What? Up. Oh no, look at it now. Not good. Whoa. No problem. Problem. Oh, there we go. $3.
Yeah, it's a very psychological level, 50,000, as was 45 and 40. There are a lot of technical traders in Bitcoin at the moment, and they sort of plug into their models these kind of numbers. And I think what's really driven it up past 50,000 is, it sounds kind of stupid, but more buying than selling. And to put some substance to those words, I think it's a lot of ETFs.
$2.95.
They're really becoming very successful
$3.
in terms of inflows. The iShares ETF now has picked past the $5 billion mark. And if we look at the total inflows of the newly issued ETFs, they're at $10.6 billion in just over a month. So really quite significant. Net off the outflows from Grayscale, and we're still at $4 billion worth of inflows. That, to put that in perspective, when iShares launched their gold fund, they had $125 million
Bitcoin
inflows in the first month. So this is really quite substantial inflows.
Oh.
Yeah, I mean, it really is. So I guess people are willing to take on risk because there's still risk involved with these ETFs, right?
Yeah, they track the Bitcoin price one for one. They're highly volatile. Bitcoin is volatile, more volatile to perhaps other investment assets you're used to. It trades at around 40% annualized vol, so that's more than roughly double the Nasdaq at the moment. But in terms of investing in Bitcoin, it's perhaps one of the safer ways to invest because you have institutional grade custody rather than perhaps custodying on your own on a ledger device, for instance.
Do we find that, I guess it's a digital currency, it's decentralized, it has a lot of anonymity to it. I know the ETFs are correlated to some of these big institutions, but do you still feel like there could be concerns if someone did it a different way, if they could maybe get scammed or something like that? Because that was something that has happened in the past.
I mean, I think it's quite the contrary, actually, in terms of anonymity. The FBI had the largest ever financial haul of $3.6 billion, and it happened to be in Bitcoin, and it happened to be a crime that happened over 7 years ago when an exchange was hacked. The thing about Bitcoin is it is a ledger, and a ledger of transactions that is permanent. So if you committed a crime in Bitcoin even years ago, there's a permanent public record of that. To the detriment of many people, and in fact Hamas tried to use it as Bitcoin funding and advised over a year ago now to not use it for the very fact that it is this public ledger. So actually being anonymous is quite a difficult thing, and as a criminal I would advise people not to use it for that reason.
Yeah, look, I'm happy to hear it because, we always heard that it was good for money laundering and human trafficking and scams and things like that. So I tend to agree with you in that the more we have Bitcoin, the longer we have Bitcoin, the more we see Bitcoin, the more we get approval into these ETFs, then people trust it more. When we think about other ways to have exposure to digital assets, you have Ethereum, you can buy stocks that have some sort of Bitcoin along with them. I mean, there's many ways to do this, right? What has your research been pointing out that has been popular of late or of interest?
Yeah, actually, Bitcoin primarily, partly because it has that stamp of approval from the SEC now, and that was a big worry amongst investors. Around 60% in our survey said a government ban or regulation was a big concern for them, and now that issue is resolved. They're trying to many portfolio managers are dealing with a problem of very high correlation between equities and bonds.
Sorry, sir. SPX Boeing. Really looking good here. Going through my watch list. The ones that catch my eye is Boeing and Apple and Goldman Sachs. Pins on here, and KO just had earnings. So number one, it's in the red, would be probably Apple. Put that on the 20-day. Definitely can drop a little bit more. Descending pattern on Boeing, so a little up and then another pullback. Excuse me. FedEx. Another drop on FedEx in the past couple of days. That'd be kind of interesting to watch. JP Morgan up 59 cents. Still going sideways. Closing in on the 200. Resistance to break. I've got 177. Something a little above it. And then we go, ooh, Chipotle. Chipotle came back and kissed the 63 EMA on the 1 hour time frame. /ES. Traded the SPX today. My own demise and my own surprise. Right now it's at 360. See? Didn't look too good this morning. Now look at it. Whoa.
Continue. Let's dive deeper into
430 now. The 49.80s. There you go again.
Schwab Bank Investor Checking, the checking account built for
gosh,
investors.
please.
Named highest in
Don't make me.
plus cap.
Nope.
I waited all day for you, Larry. I've waited all day for you. As my first cat.
Today's commercial is brought to you by Don't Let 'Em Get Away. Larry.
I waited all day for you, Larry. I've waited all day for you.
Larry.
As my first cat.
Oh.
Like this forever. It would be okay if we saw a little bit of a pullback. I don't suspect it may
Who is this guy?
tomorrow or anything like that. But I do think that, in the first quarter here, it would be a pretty good thing for the markets to pull back, maybe 5% or something like that. I don't see a pullback here. We all know rates are going to be coming down. The earnings look very good for a lot of these companies. And, right now, the AI space obviously is taking off.
540.
I thought we were going to see a pretty big move, and we did see it, a little bit bigger than what I actually thought right away. But a lot of these stocks are doing very, very well.
Yes, they are.
And, I'd like to see the market,
Doing very well.
mega cap here. I'd like it to spread out a little bit more in the market.
Oh,
but
no.
I suspect that's going to happen.
It's going to do it
I think
again.
we're in a pretty good place right now.
Yeah, I do want to talk about growth and value versus value, or growth to moving to value. But first, just quickly, when we look historically, when you have an election year, particularly
The guy talking on Schwab.
likely to see up arrows, right? I mean, how are you feeling about some of those historical stats?
Right. I mean, historically, the market should be up, anywhere between
I'm not sure.
11.5% and 12.5%. When we see an incumbent, in a re-election like we're having, and these are the numbers since like 1952. So usually they try to implement measures that will support the labor market and the economy. And I think right now we're kind of seeing that. We're seeing, a lot of nice things play out right now in the market, kind of coming together right now. But, the market's going up pretty fast right here. The last quarter was very good at the end of last year, and we're starting to see a really strong market this year. And at some point, we'll probably see a little bit of a break here.
Yeah. So as we maybe transition from growth stocks to value stocks, that's something that you expect could happen. You have a couple of stock picks for us. Tell me about Disney and IBM. First off, Disney.
Yeah, I mean, I've been kind of pounding the table on Disney for a while. It's up 20% already this year. Their earnings look like they came out really good, and I would suspect that there's a lot more value in the company right now, and that Disney could be a big mover this year, in my opinion.
I see. I mean, did you like what you heard from the earnings and the ideas and the ESPN tie-up and the dividend? And Nelson Peltz is still out there pressing, but you feel like it's on the right track? Where do you think Disney could be headed?
Yeah, I mean,
today.
Yeah, I think Disney's on the right track right now. You got possibly a $3 billion buyback. A lot of the streaming news is pretty good. It looks like they're looking to create some value here in the company, and I think this stock, it's up big already this year, but I wouldn't be surprised if we see Disney somewhere around 125 maybe within the next 6 months.
That would be good for folks. And so then we turn our attention to IBM, which you actually say could be a tie-in to the AI space as well for IBM. It's at 182 and change today. Your thoughts about where IBM is headed and why?
Well, you know, IBM has struggled for a long time, and they've really underperformed. And right now, it looks like you know, they just may be in the right space right now. And you see the stock basically hitting a 10-year high right now. And it looks like there is some growth there in the AI space. And, you know, I think IBM could be something that moves quite a bit higher here this year. It's made a move, but I think that, you know, it really could do well, especially with the value that they have right now in their company. And I think right now they're going to start to produce some numbers, and I think the stock is going to look good probably over the next 6 months.
All right. Thank you so much, James Butterfield. And no, that's not right. Andrew Aarons of Synergy Advisory.
Damn, looks good right now, brother.
Thank you so much, Andrew. It's great to see you. I love when you're on the show. I know you've been bullish. You've been making a lot of great calls here. And today we keep our eyes on Disney and IBM. And Andrew, I'm glad you were here. Thank you so much, Andrew Aarons, Synergy Advisory. Thank you. Coming up, we're looking at gasoline prices on
There
the
goes the
rise.
SPX,
So
530
what do we
again.
need to know when it comes to that? And Lyft, of course, had a printing error, a typo, one extra zero. We need to talk about that. And a strike.
This is where I make
that's
my
underway
mistakes.
for some of these ride-sharing companies. Much more to discuss here on the watch list.
In at 185, out at 280. We went to 540. Jam out. Yeah. Okay. Nice. Take me to the porta potty. That'll be nice. Oh yeah. Take it. 540. Ooh. Okay. Heart attack.
oil is the star. That's up about 2% right now. I'm going to turn my attention straight over to Ben Lichtenstein because, as I said, there were two sectors lower, and that would be energy and also consumer staples. Everything else higher. Good to see you. 90 minutes left in the trading day, Ben. Your thoughts?
Yeah, you also said the Russell was the star. It certainly has been, that's for sure, Nicole. Up over 2% right now as we speak. And all four of the major indices have a level-headed approach.
Okay.
That's stronger than expected, hotter than expected CPI
Oh, my.
we saw yesterday. That sent the S&P
You know, this
down to
really...
49.20.
Oh.
The SPX back up to 49.91 today. So basically 70 points off those lows. Take a look at the futures here, though, because as you look at the move lower from the all-time highs that we saw, if you remember, it was just earlier this week on Monday, we were posting new all-time highs all the way down to 49.36, and so you can see about 60 points off that low as well. The futures actually briefly got above 5,000 again today, but yeah, small caps definitely standing out here, up 2.25%. Taking a look at where we are in reaction to this number.
Okay.
You see a bit of a sell-off again, but this
Highway
is a
robbery.
well-defined trend to the upside here, Nicole. So again, even the NASDAQ here today enjoying some gains, up about 0.6%. We saw it up to 17,847. We're off that high right now, 17,700. But S&P still holding above the 50, still holding above the 200-day moving average. I think here, Nicole, a pretty good reflection of, again, this trend here. I did want to point to some comments from Chicago Fed President Goolsbee, who talked about how, well, he was commenting on that number yesterday. He said, let's not get amped up on 1 month of CPI that was higher than expected to be. He said, if you see inflation go up a little bit, doesn't mean that we're not going to hit the target of 2%. He said we can still be on our path, even if we see some increases and some ups and downs. Let's not get too flipped out. And it looks like the market took that message to heart here today, Nicole.
Yeah, I'm glad you brought up that quote. I was hearing
Yeah, that's a good idea.
this morning. And it made me feel like, all right, maybe the CPI was a one-off and we'll have to wait because they really look at the data, and that was 1 month. What about crude oil? We're going to be talking about gasoline prices and such in a moment. What are you watching when oil is at 76.59 today?
Yeah, well, excuse me, crude has come off quite a bit. It's been a volatile session here over the last couple days here. Crude inching its way back up to near $79. Today it's come off significantly. We're about $2 off that high that we saw again from 76.77 to 76.56. EIA, I think, was the cause here, Nicole. A large build, up 12 million barrels reported. Now, we did see a small draw on the gasoline, and that's also been a focal point, right? Because prices have been on the rise at the pump here. So not something we want to see, kind of tying back into that consumer price data here. But we've got crude oil right now. Let's just take another look here at the chart. I've got not only selling that we saw today from 78 down to 76, but here you can see how that's kind of reversing a bit of a trend that we've seen off the lows just about a week or two ago around 71. We traded all the way up to, again, 78, 79. But look at this. Here you can see that longer-term trend off the highs from last fall, up around 95, down to, again, well, currently holding below that $80 level, down to 65 and range-bound. I want to just show you one last chart where we are relative to the, here we are, the 50, the 200-day moving average as well, so still holding above those. But yeah, I think that draw on inventory sent crude lower today, fourth largest in a year, Nicole. I'm sorry, the build, I meant to say, not the draw, the build.
Right, thank you for that. Ben Lichtenstein, great to see you. So as we watch gasoline prices on the rise this month, summer driving season's not too far away. Let's talk about some of these energy-related moves. David Holt is with us, President, Consumer Energy Alliance. Thank you for being with us. So just give us some perspective. Where is gasoline now? Where was it? Why do consumers need to pay attention to this?
You know, great lead into this. You know, gasoline prices are up this year so far, 13, 15 cents. And that's largely driven by crude oil. Crude oil has been ticking up. We saw today a little bit of a drawdown, a little bit of a downward path because of these inventory announcements. But ultimately, we're looking at kind of longer term as we head into the summer, crude kind of tickling back up, gasoline prices going back up a little bit, diesel prices going back up. And of course, when you have diesel prices go up, commodity prices generally go up because everything is delivered by a diesel truck. So our analysis tends to forecast, because of kind of a tight regulatory environment here in the United States and elsewhere. The LNG restrictions that were recently announced is another thing that adds another layer of uncertainty to overall energy markets around the world, and certainly here in the United States. So our analysis shows that more than likely we're going to see prices continuing to just tick up a little bit, not huge like we have had in the past, but probably higher prices as we head into the summer.
Yeah, look, in 2022, I mean, you know, towards the end, there, I am looking at a gasoline chart over time. Interestingly enough, in 2020, I mean, it was down below $2. Nobody was driving. But it went up to $5, right? Pretty much close to $5.
Yep.
So where do we stand on this big swing? I mean, do you think we could see $4?
You know, we could. It's going to depend on kind of global demand. I think we've seen consumers largely driving the U.S. economy. If consumers tend to pull back a little bit, and we have other signs of kind of maybe recessionary pressures,
AVGO has a flag.
The economy contracting, and therefore gasoline demand
AVGO
down a little bit. I think by and large, most folks are not really seeing that trend going to continue. So the upward pressure on the price of a gallon of gasoline, price of a gallon of diesel, and of course what OPEC may or may not do. Are they going to draw down? Are they going to restrict some of their production and distribution around the world? That will also have a big impact on not only U.S. energy prices, gasoline prices, but global prices.
Yeah, well, we heard from OPEC at least partly this weekend talking about energy demand and seeing that that would likely increase. In fact, I was looking at a chart that went back, and it was energy consumption, the gallons that people consumed. And basically, it was a chart that went back, I think, to the 1950s, 45, 50s. And it was a chart that just sort of kept going higher and higher, had a little blip during 2020, right? Everybody was at home. But other than that, still back on the way up. So, I mean, likely to see consumption will continue, right?
I agree. Demand goes up. Demand for all energy resources, you know, power generation, gasoline, diesel, it all continues to go up. So finding new resources, finding more oil, delivering that oil into gasoline and diesel is a key part of this. And again, we've talked about this before, but the regulatory environment here in the United States is not real conducive to long-term production, development, exploration of oil and natural gas. The Gulf of Mexico has largely been shut down. Public lands for oil and natural gas development largely shut down. Pipelines to deliver oil, gasoline, and diesel largely restricted, protests prevented from being built. And now we're seeing LNG restrictions, which LNG helped create kind of more market certainty. And the U.S. was the leading LNG exporter in the world, and now it's kind of another issue that's a little bit uncertain. So finding ways to create more regulatory states is really the key.
Yeah.
When you talk about LNG exports and that being having some restrictions,
Spit it out.
is that likely to change at any point, or does that seem pretty much
Uncertain.
the way it's
You know,
be?
the administration, I think, responded to a few days of protests about LNG and made this new restriction. It has been met with bipartisan opposition. So Republicans and Democrats, in large part, have agreed that restricting LNG, particularly with all the money that's being invested in LNG export opportunities, our ability to help our friends in Europe and other parts of the nation, other parts of the world, when there's a conflict like we saw in 21 with Russia and what they were doing using their natural gas as a political weapon for Europe. And we were able to come in and export LNG to our European allies and friends and act as a good hedge against that kind of the aggression that we saw from Vladimir Putin. So this restriction on LNG throws kind of another monkey wrench into the whole equation. And ultimately what we need here is kind of this regulatory environment that provides certainty, that provides long-term investment opportunities, that we recognize that even though we're building out wind and solar, we need more natural gas and oil to continue to power our economy. And as you mentioned, gasoline demand keeps going up.
Right, and look, there's still, while there's a push for EVs and some of these alternative methods of energy that are a little more friendly To your point, I think that gasoline is still a big deal, and coal and making this happen. And at home, you know, I was hearing some stats that here in the USA we were producing the most ever, but at the same time I hear about the constrictions here in the US. I mean, there was no doubt, it was really clear as we were changing administrations that there would be somewhat of a slowdown or things like that. The strategic petroleum reserves, we had a drawdown on that. We certainly haven't replenished that. We're also changing contracts. We go from the winter oil to the, you know, there are different prices on those. We have home heating, and the truth is that it hits consumers. And it's a good way to tax consumers, but it really hits consumers where it hurts, right? When you have inflationary
You're
numbers
exactly
and
right.
oil going up.
Yeah, if your state policies or national policies are intentionally designed to raise energy prices, consumers are the ones that are hurt the most, and then those folks that are in fixed incomes and living at the poverty, at or near the poverty level, are the ones hurt the most in all this. They can least afford to pay more for gasoline, to pay more for commodity prices that are delivered by diesel truck, to pay more for electricity. So we are seeing, particularly in certain parts of the country, the Northeast, the far West Coast, other places, electricity prices in particular have gone up considerably. California, we're seeing usually they're 50% higher than the national average for their gasoline and diesel prices. So we need to balance this, continue to meet our environmental goals, but understand that we've got to deliver affordable and reliable energy at the same time. And the affordable and reliable part of the equation is really what's at risk.
Yeah. David Holt, great to chat with you, President, Consumer Energy Alliance. Thank you very much. Good to see you.
Thank you.
Still ahead, our discussion on ride sharing. You have Lyft, who came out with the numbers and had to do an adjustment because one was a typo. You have Uber with some big news as well and jumping, and a strike that it was underway from 11 a.m. to, I believe it was 1 p.m. Eastern time at the airports. Much more. We'll be right back.
Smack.
At major airports, 10 U.S. airports today during this lunchtime period, Valentine's Day, because, you know, obviously they will discuss what goes on here. Anthony Bartolacci is with us, Chief Strategy Officer, Sensor Tower. Sandra Cho, founder and president, Point Wealth Capital Management. The strikes have been underway. I believe they were from 11 a.m. to 1 p.m. Eastern time, or maybe 2 p.m. Eastern time. Likely finished at this point, but making the point, right? Lyft actually sort of gave some concessions. I'll start with you, Sandra. Your thoughts?
So, I mean, we've seen strikes before, especially last year, and I think this is, part of it. You see inflationary pressures, and Main Street is feeling it right now.
For the supply of drivers for Lyft, and actually more strength in the Lyft driver app than for some of its peer ride-sharing names like Uber and DoorDash. So, just setting the stage for what's going on today, users are still going into the Lyft ecosystem wanting to be a driver.
Right, understood. I'm glad you mentioned DoorDash. We had that on the banner there. I mean, they also have striking drivers today. We've seen the Uber stock soaring. Lyft also is at some new highs, not the highest ever, but new highs. Sandra, where do you think these stocks are headed as you see both of these names? Do you like one better than the other?
So Uber is 10 times larger than Lyft, and they have additional revenue source with Uber Eats and then the recent acquisition. I think that Uber looks like they are poised well, especially let's talk about AI and their investment in AI. Lyft
whereas Uber is in the mid-teens. So Uber is very much more global. We have a really cool stat at Sensor Tower called Audience Insights, which actually shows sort of the competitive dynamic in the US between those two providers. And of the Uber app users, only 1/3 of them also use Lyft, which is kind of showing Lyft's complementary status to Uber. And doing the inverse of that, starting with Lyft users, we see about 2/3 of them also as Uber users. So I think Uber is better situated, but we are seeing some good trends for Lyft, which maybe just shows some strength in the overall category.
Yeah, and the first ever buyback announced for up to $7 billion for Uber, and that also helped to give it this lift today of 12.7%. Lyft is gaining 33%. Thank you both for being with me. Truly appreciate it. Anthony Bartolacci, Chief Strategy Officer at Sensor Tower, and Sandra Cho of Point Wealth Capital Management. Good to see you both. That's going to do it for me here on the watch list. I'm Nicole Petalides. I'll see you later. Keep it right here. Market on Close with Oliver Rennick. Thanks.
Very nice. We have 3 minutes to power hour.
Here for the #1 hit maker.
Thanks for swinging.
Please, no commercials. So we more or less stayed in the channel today. If you talk about pre-market and after hours. So it was pretty good. Double bottom right here. And now we're at the shoulder line of resistance. Not too bad. SPX called down here. Boom. Nice little run. Very good.
Weekdays.
I'm Oliver Rennick, watching the Schwab Network. Hour left in the day. We're making back some lost ground. Russell 2000 is leading a bounce back session. Everything right now basically looks the opposite of yesterday, but to a smaller degree. So definitely an impact that was made after inflation was hot yesterday, but today we're seeing the market resilient, dip buying happening. Russell up about 45 points, and the S&P's up more than 0.5%. NASDAQ good. Other than Apple, all of your big mega caps are higher. So there's definitely a little pushback to some of the bearish tone yesterday. Of course, the trend still favors the bulls. We shouldn't be surprised. But the bounce here definitely leaves it still as a two-way trade this week. We'll see how the next couple days go, who's going to take this week. So far, it's a bit of a battle. You got tech acting very strong. Yesterday, really not even a problem. The tech trade, especially the mega caps, did very well in yesterday's down market. They were down, but not that much. Today, they were strong from the start. But really, if you're watching overnight, you can start to get some of the hints that we were going to be risk on today if you're watching Bitcoin. BTC also started firming up yesterday afternoon, starting to see a little outperformance in the short term, Bitcoin versus stocks. and now we're back to a fresh new local high in BTC. So it's risk on across the board. The dollar down 2 definitely was an early sign as well. Greenback very reliable in its tell and its generally inverse relationship with the Russell in particular. As the dollar ties in with rates, those two linked. We see rates going down, yields going down, dollar down today, giving back some of yesterday's macro shakeup around CPI. If you look at the last 3 months though, the big point yesterday in that move was that it created and confirmed trend for our key macro assets in the 10-year yield, the dollar, the 2-year yield as well, defined by higher highs and higher lows. 3 seems like a good number to have your standard for trend, and so that's what we have now, a trend in the dollar in the 10-year that basically starts at the calendar for 2024. This is a 3-month chart. It gets you some of the downside coming into this year, and then the flip for the dollar and yields. Now that both are rising and trending, it puts in a good bit of conflict in this market with the Fed and its expectations, though some of that was eased today by Chicago's Austin Goolsbee in commentary. I found a bit odd, saying that they are planning to cut based on confidence that they're on the way to the 2% target, but that prints above the target and prints in the wrong direction wouldn't break their confidence. So it sounds like, in his mind, they're just cutting no matter what. So that, I think, eased the market a little bit here. We saw a bid into bonds, dollar slips a little bit, and you've got this big risk-on move. A few charts to look at here as momentum trades kick back into gear and investors buy dips in what's been working. First, the Bitcoin chart is entering back into overbought territory, which is generally a good thing for Bitcoin. That's how it works. Momentum asset, the purest of them, when it breaks out and momentum gets hot, generally you see follow through. You don't really see Bitcoin just peak into overbought and then stop. That's kind of how the asset works. People usually pile in. If you look at the momentum ETF, MTUM, or the SMH or high beta, let's look at chips as another example. You get a pretty clear picture of dip buying. The chip sector, which has been the backbone of the tech rally, bounces right back. And you can see that generally over the past couple months, it has remained overbought for much of that period as well. The SMH keeps rallying, getting overbought, and anytime there's a little bit of a break, investors storm right back in and push it back. So things here are pretty reliable. I got Jenny Horn and Kevin Hanks with me here in studio. Today was an earnings day too that kind of stole some of the action. The macro kind of died down today, Kev. I think maybe Goolsbee's comments kind of helped soften it a little bit.
What he should have said was, speaking of reliable. Jenny
Oh,
Horn and
right,
Kevin
yeah.
Hanks.
No
Come on.
kidding.
Of course.
Now,
Jeez, sorry.
here's
Take
the
it
thing.
easy on me. It's Valentine's Day.
I don't believe that Austin Goolsbee really has the ability to be hawkish.
I'm starting to think he doesn't either.
I think he's extremely dovish, because the way he twisted that into a dovish approach is a little bit difficult. Now, what's going on in the market today? I think this market is the equivalent of a standing 8 count, right? It got punched in the nose yesterday. It's trying to decide if it's upright or still in trouble.
Okay.
And so I think the close today and the close, the data we're going to get Thursday and Friday are vital to just hanging in there. Obviously, next week's going to go into NVIDIA talk. It's going to suck up all the oxygen in the market.
Exactly.
But we got to get through 2 more. I'll call it 1. I don't think PPI is as important as some people do. But retail sales, they're expecting a big drop in retail sales. We'll see if that happens.
Okay, that'll be a fun one. So we've got a couple, we got PPI and we've got a couple more prints this week to make things interesting. I like it. Standing 8 count. So yesterday was not a knockout.
No, but it
hurt.
It got hurt.
Kind of wobbling.
Exactly.
Speaking of bouncing back, kind of the most fun story of the day is Lyft.
Where we started.
Yeah, right where we began, because the shares are still up. And I think that's an important message because the market's really determined to reward companies that make key improvements. We've seen that all earnings season. We punish the ones that don't. And even for Lyft, with all that big debacle, we still gave them a big leash.
I know we don't have to go through like the margin guide that we don't have to go through that again. I think this is like my 19th time discussing that. But like you said, as far as its earnings growth, it was phenomenal. I mean, we saw active riders come in 10% higher, 26% higher the number of rides. Gross bookings for the year increased 14%, while for the quarter rose 17%. And they highlighted the fact that actually a huge part of that was this 35% lift at stadiums and various large arenas, which was a huge benefit to them for the quarter. So, I mean, there was definitely a ton to be excited about, especially now when you guide for gross bookings for the first quarter, ahead of what the street had been expecting. I mean, this was a really solid report. If we saw selling today, then I would be, maybe just there'd be like disarray regarding the CFO, but this was objectively as strong of a report that we've heard from Lyft. However, there is this ongoing strike right now, which earlier today was being called for between like 11 and 1. I'm not sure if that was Eastern or Central, but it is ongoing right now. And what's sort of
50,
amazing about the strikes when you're in a gig economy
70.
is I was checking the fares. In Chicago, they're not surging.
Okay.
But Boston is one where we're seeing these strikes. Fares are up like 10 times. So the only companies that benefit right now are Uber and Lyft from the strikes.
Yeah, fascinating.
It's amazing how that works.
Uber's having a great day too. What's up with that? Like how, I thought the whole story for Lyft's terrible price performance last year was it was market absorption by Uber, but Uber's kind of like got its own thing going on now.
Uber totally has its own thing going on. It's amazing. I mean, Uber's market cap right now
Very
is 26 times that of Lyft, just to make an illustration of how much bigger Uber has become. But no longer are we talking about the Uber that's burning cash and that's unprofitable. I mean, the path to profitability was all we talked about for years.
That's right.
Now we have this first ever share buyback plan. I mean, we have the fact that this company is now consistently profitable. It's in the S&P 500, and it's now going to be repurchasing up to $7 billion worth of stock. So that does compare to its market cap right now, around $160 billion. That's actually only about $20 billion away from Intel. So I mean, like, this is really a power play now in terms of not only just, I'd say, like the ride-hailing space, but as far as data. I mean, Uber collects a ton of your data, as well as then consumer discretionary. It's also like basically a grocery delivery at this point. But I think that this is showing something of a completely different Uber, and it's reflective of some of these really strong earnings we've gotten from Uber.
Yeah, good analysis. Example of this earnings season that has been about maturation of many of our growth companies to the point about its profitability translating now into shareholder-friendly activity. Almost a 5% buyback of your market cap is not bad. It kind of makes me think of the way Meta paid out a dividend for the first time. Uber doing this as well. I mean, we are like, this is a great coming of age of like this generation's tech leaders that we're all about growth now, Kevin, saying we're going to pay you off in a different way.
I'm not comfortable in the role of a skeptic, but you realize in the last 12 quarters, you expand your Thinkorswim platform to 3 years. They've been profitable 6 of the 12.
Yep.
Now, 3 of the last 4, they've got a great trend going, but buying back stock, 6 of the last 12 quarters has been unprofitable. It seems like they're getting a little ahead of themselves here, but as long as they have the money and think that's the best use of capital, we have to trust them to do the right thing. But boy, that seems a little quick.
Well, we're basically assuming that the new standard is going to hold, right? That we are done with the past of declines, that this is once you cross that bridge, you don't go back.
I mean, I applaud them. They made it through the pandemic and still stayed in business.
Yeah.
That was impressive to begin with, but boy, it seems like an early in their overall lifespan of this company to be buying back stock.
Yeah, that's why that's why I think the market is they're trusting them and saying, "Wow, big message." I mean, there's a lot of signaling power when companies do this. That was one of my takeaways from Meta as well. By the way, speaking of Meta, did you guys see the Zuckerberg video that he uploaded talking about the Apple Vision Pro? Guy's not messing around right now.
And Apple's down %.
Yeah, wow,
it's
you're right.
Kind of interesting.
Mark Zuckerberg will compete. Remember that. Remember, Instagram is basically, in a broad sense, a copy of Snap that they adapted.
And did better.
Their stories,
Exactly. They did it better, but I mean, Mark Zuckerberg is not afraid to attack a competitor in
Well,
many ways.
That's what I was about to say also, literally. So
Literally.
he scared Elon out of the cage
No,
match.
we need that cage match to still occur. I'm disappointed it never happened.
I know. I don't think Tim Cook's going to carry the mantle. It doesn't seem like really his vibe.
I don't think so.
Okay. All right. Thanks, Kevin Hanks, Jenny Horn. Reliable team here in the afternoon. Joining us, Danny Kirsch is head of options at Piper Sandler. He's also always got some good trades up his sleeve. What's up, Danny? We're bouncing back today. What do you think of these last 48 hours?
Yeah, it's interesting. We're getting this bounce, but we're a little skeptical. I'd say inflation expectations have increased. If you look at like 1 year CPI, 1 year inflation swaps, they're ticking higher. They're back over 2%. These Goolsby comments are very odd. I know Waller's speaking tomorrow and Bostic, so we'll see what they say. It just seems like they're so, they're kind of telling you, I guess, we're very ready to cut no matter what happens, which I guess that's what the market's reading into. I think that was the most important thing that happened today was the comments from Goolsby and then Yellen also saying that, you can't get too caught up in one CPI print. That doesn't really matter.
Sure.
I don't know. The service component was annualizing. I think it was like 12%. It seems like not a great number. Inflation swaps are sniffing this out. They're going up today. From our seat, this seems like, maybe a dead cat bounce. I know yesterday, part of the reason I think we even rallied into the close, we had that like 65 dip rally from like 3 to 4 p.m. Eastern. I think that was just people monetizing VIX February calls because there's just a ton of open interest, specifically on the 17 line, and that seemed to push the market higher. I'm a little surprised we're rallying so much today. But it's like the same story, right? Semis are just catching a massive bid, ton of call buying there. And, for now, market wants to be long. We'll see, though, with these retail sales, if they come in hot, it's going to be just very difficult for the Fed to continue to sort of say, like, we're just to let you know, we're always ready to cut. We're very ready to cut if inflation is going to start ticking back up again. And, they could have pointed to disinflation on the good side. If that part of the story now gets, pushed out, that's a real problem. And, God forbid we actually look at maybe hikes in the future. I know that is sacrilegious to even say.
Yeah, I mean, it seemed to me yesterday the big takeaway was that the conversation about, when is maybe one that should be a little closer to if, where you start by pushing back the cuts, but then eventually you push them back so far and it kind of becomes a question of, all right, maybe do we need to cut? And then the extreme, the sacrilege, to your point, would be, oh goodness, do we have to hike again? I agree with you, the Goolsby comments. I mean, it's hard to figure out how they can say they're data dependent and then say also what he said, which was like the exact opposite of data dependency. Not to get, to be that guy, but we've heard some commentary that one of the folks running for president wouldn't keep Powell. Is there a possibility that anybody in his circle might be kind of jostling to appeal to a potential role in the future? I hate being that guy.
I didn't think about that. It could be the case. I know that a very popular trade for a Trump presidency has been a curve steepener, basically playing for the 2-year to rally and the long end to sell off in the event that he puts in a dovish Fed, and he said that he'll push Powell out, and he'll probably push someone in who will want to cut rates to zero, but then the long end would tend to go. So I know that's a very popular trade, and even today we're seeing a little bit of steepening, actually, unwinding yesterday's flattening. That could potentially be it. I know I looked today, and Biden's odds of getting the Democratic nominee are down to like 73%, which was, that's been good. That's been coming down, I guess, after last week. It's pretty shocking that the market might be this far ahead of it. At Piper, we would say it's very likely Biden will run, assuming he's healthy enough to continue on. There's just not a lot of time to find a replacement. And, it seems to me to be a little bit early to start pricing in a different Fed chair, assuming Trump wins. There's just a lot of variables. It's 9 months away. I do think this is almost just buy the dip. We monetized our puts yesterday. Data was fine. And then you had someone, you basically had this guy come out and say, nothing mattered that came out yesterday, which is it's just crazy to me. And did you see Bitcoin today? I know you love looking at Bitcoin. It's up another 4%.
Ripping.
I think everything is telling you, okay, the Fed's not going to cut. All right, we're gonna test them now. Now, I think that's a good gauge of expectations on if the Fed is going to do enough to push down inflation. The fact that real rates are rallying, Bitcoin's rallying, crowded shorts are rallying. I think ARK's up another 4%. I think it's already rallied everything back today. You mentioned Russell. all of these things are saying like, is the Fed about to make a policy mistake? And if so, then honestly, you want to be long, right? If they're going to be too dovish when all this is going on, then you probably want to be long near term before they're, with the longer term pain of, well, we're going to have to change course and maybe we'll be forced to hike.
Okay, good job bringing it back to the market here. Sorry for taking us off on that tangent. Just kind of thinking about it. You've got a couple things you're looking at here market-wise. Since you mentioned BTC, I know you were looking at some of the coin options for Coinbase. What do you think is a trade that makes sense there?
Yeah, so in Coin, in NVIDIA, and a lot of these semi names are just crazy call buying like every single day. I think in Coin, it's a fairly popular short. It's just taken off, and you see today it's rallying again. It's an easy short to model, but it's been on fire, and there's been a lot of call buying. Some of that could be hedging shorts, some of that could just be playing the momentum trade. It's odd that you'd want to, I know this is traded like a Bitcoin proxy, which is pretty odd because now you could buy the ETF. Regardless, the trades that we're looking at are selling like 1 month, 25, 30, 40, 50% out of the money calls to buy closer to the money puts. So typically you'd expect a call to trade cheap to puts, right? You pay up for insurance. In names like NVIDIA and Coinbase and these stocks that have just been rallying on high call volume, that's not the case. Calls are much richer than an equal out of the money put. So we like setting up collars. In a name like Coin, you could sell, like a March 200 strike call, which is roughly 25% out of the money, to buy a 150 strike put, which is closer to 10, 15% out of the money for even money. So it's like those kind of trades where if you are long these stocks, the option market is telling you calls are, and don't get me wrong, calls have been the right trade. A lot of own calls, like these things have been going up. What we're saying is, if you're long and you've done really well, and some of these might be a little over their skis, take advantage of the fact that skew is absolutely insane, meaning calls are very, very rich relative to puts, to set up collars. We're not saying to sell your stock, but you can get another 30, 40% of upside and have most of your downside hedged. And we saw yesterday how quickly these things can turn on just a little bit. This was a hot inflation print. Who knows, right? NVIDIA reports next week. That seems to be like the most important event for the market all earnings season. And we'll see if those earnings at all disappoint. The stock certainly has some room to run lower. I think it's up, 30% year to date?
Yeah.
After being up 180 or 200% last year. So, we think it makes sense to lock in gains, still give yourself some upside, but why not take advantage of the fact that these calls are so rich relative to puts?
Got it. Okay, so the market's just so skewed in its optimism that you don't have to be like a super bear to want to try and stab at some of these things. And as you mentioned, you can do it, while you're owning shares too. So, okay, I like that approach. Looking at the broad market, S&P. What do you look at here? We've got a chart that shows where I guess kind of the pin is. As people have put it before, the kind of gamma pin.
Mm-hmm. So Friday's S&P expiry. Yesterday was obviously VIX, or this morning was VIX expiry. Into S&P expiry on Friday, and I think this also could be one of the reasons we're getting this sort of bump. We've seen like 5,000. That's where a lot of the option open interest is, and our expectation is that dealers are long gamma, so dealers are selling when we go above 5,000 and buying when we go below 5,000, so it's acting like a pin. And you're kind of seeing it today. I think we're right at like 49.95, somewhere in that vicinity after yesterday's sell-off, and then we kind of rallying back to 5,000. Keep an eye on what happens on Friday. So Friday, a lot of these options go away. That's the main expiry is Friday morning, and we'll see if the market tends to open up. And so near term, perhaps I think we'll probably just sit around 5,000. I don't think we're going very far, and we'll see Friday the PPI if that comes in light, that comes in a little hot. That's when we can start seeing break away from this level. Maybe we get the market to sort of pull one direction or the other. We'd lean a little bearish here, just on really on these inflation swaps ticking back up, and we'll see what these Fed speakers say Thursday. But it does seem like a little bit of froth. All the call volume, even broadly speaking, S&P skew. Calls are very, very rich relative to puts. This isn't like the meme craziness,
right?
But it is kind of the call craziness. Okay. Yeah, I mean it is pretty noticeable how expensive calls are relative to puts. And even yesterday, it's like we're selling off or something. You didn't really see much of a bid into volatility until we got down to 2%, and then obviously market took off and rallied into the close. And since then, VIX is back down below 15. Everything's sort of normalized. I think after Friday, after that 5,000 pin and market opens up a little bit, there's not so much concentration of options around one place. Maybe we get a little more consistent volatility, God willing.
Okay. Thank you very much, Danny Kirsch, for the details, the analysis, and the trade, too. Always a good
Thanks
comment.
for having me. I really appreciate it.
Yeah, great stuff, Danny Kirsch, head of options, Piper Sandler. When we come back, let's get into a sector that seems to always get left behind. When markets are rallying, they lag and they only sell off. Yesterday, they outperformed a bit, but still were down. It's the staples.
My dad was a hard worker. He used to do side jobs, installing windows, charging.
I remember his dad. One day he was up there nailing in a window and he was using a nail gun and he stuck his hand up towards the base of the window frame and bam, shot a nail right through his hand. He kept working the rest of the day. I've never seen anybody like it. SPX keeps it moving. $9.10 a contract. What's he doing taking that trade this morning for? God, is he nuts? Just for that, I go into the microwave. It's the same trade I took down here. If I'd have kept that, it would have been nothing like this one here. Because I'd been too far out of the money. So I kept saying, I'm too far out of the money. I got to get out of this. $185 to $940. Booyah. Oh my. What? What's going on here? What is that? Wow. That's crazy. Oh my. 1160. This is not for real. Oh my. It is for real. This is nuts. Oh my. The SPX 4980s now are at 1340. I'll take that. 1370. So if it had my original 5, that'd have been at least $5,500. Yep. Oh my, there they go. 1380. Let's make it 1500. You can do it. Oh gosh, there they go. There it is. 15. What just happened? Oh gosh. Take a deep breath. As Elvis would say, I got lucky. Talk trader to you. Could be like this every day. Yeah, kid. Little SPX pullback. We have 26 more minutes to close. Man, this market's lovely. So far, the dips have been very beautiful. Oh, I was doing something. Okay.
$690, so we need a bigger than expected move just to break even on this one here. So really an interesting trade here, pure earnings play, kind of a moonshot here because we would need the price to break above those 52-week highs by a couple bucks just to break even here on this.
Wow, geez, all right, so someone's thinking Yeti's gonna go ballistic.
Yeah, exactly. So it seems to be the thinking here. So the sizzle on this one really stood out to me too. Sizzle is 10, so 10 times the 5-day
I like Yeti.
of options volume here. About 50,000 options traded, was like 82% calls, partially due to this very large trade here, which was about 29% or so of the total market. So a pretty sizable proportion of the market was made up just by this trade.
So the short-term liftoff in options bullishness even surpasses what we saw in lift after their 30% move. So options market going crazy in Yeti right now ahead of tomorrow's report. Wow, nice, good eyes. Okay, seems to be a lot of confidence. Okay, last one, Generac. What do you got here, Rick? How come it's on your radar? GNRC.
Well, this was another interesting one, I thought. Remember that old trading adage I said, buy expensive options, sell cheap options? This person is taking the total opposite tactic here. minus 1,000, January 17th, 135 strike calls at a 1680 credit. So a very handsome premium received for selling these options here, which matches up with the long-term time horizon. It's got 338 days to expiration here. So this is a long-term play. And, you know, short options, short call options, most likely a covered call, probably a covered call that's on an existing stock position here because it's $1.6 million worth of credit received, and you wouldn't want to have this big position here without the accompanying stock position that would protect you. You know, because a naked short call can have unlimited losses because the stock can go up to infinity. So really interesting play here. The expected move is about $45 here by the time this option series would expire. So certainly a situation where price could get above that break even of 150, 180. That's about 23% to the upside here. So a lot can happen in a year. The sizzle on this one is the lowest of the ones we're looking at today, 2.5 or so. So about 15,000 options traded, even split between calls and puts. This trade was about 7% of the total market. So really nothing crazy in terms of that proportion, but still an interesting trade here.
Yeah, definitely. Because we had a lot of volatility in stock today after its earnings. What time did this trade go on?
I would have to check that. Okay. I don't remember off the top of my head.
But it's today, since the open. Right, okay. So I guess they got spooked by the earnings and the dip overnight, or this morning rather. All right, so someone kind of feeling maybe hedged their position in a big way. Thanks, Rick. Good eyes. All right, we'll watch Yeti on earnings tomorrow for sure. All call buying happening there. When we come back, we're going to talk some more earnings, except this time a decliner, Upstart, down. Almost 20% on the session. We'll give you the details next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums.
Very interesting. Textbook trading right here. Nice little hammer.
12%. The 1 year Bitcoin up 113, gas one
Yeah.
down 55%. So it started off as a joke in the office. Hey, can natural gas go negative just like crude oil futures could? And it's the reality that there was no place to store that crude oil. That's why it went negative. So if you wanted to sell it, you had to pay someone else to store it. So fundamentally on the natural gas side, we've got a mild winter. The concerns about supply have evaporated. The current inventories are 7.8% above the 1 year average, 10.65 above the 5 year average. So if you're a producer, you need to hedge that forward production. Now here's where things get a little bit interesting. If you Google negative natural gas prices, it's already happened in 2020 and in 2022. West Texas natural gas prices went to negative $2. So producers had to take some supply off their hands. And where the negative play comes in is that the regulators limit the amount of natural gas that producers can burn. It's known as flaring because it releases carbon dioxide. And guess what's getting canceled this year? Liquid natural gas. The environmentalists are after the Biden administration, and they've got to get this environment buttoned down to secure those votes. So natural gas stockpiles are going to continue to build higher.
Interesting. So it seems like you think this thing might be literally heading to zero.
I'm telling you, it's a joke. You had the options guy just on Rick a second ago. I mean, I'm surprised he's not talking about May $1 puts in natural gas. They cost $200. I mean, you get two of them, you double your money on one, sell one, you got a free lotto ticket. Not a recommendation. I'm just throwing it out there as a fact.
And one of the biggest reversals of sentiment over like a 2-year period, possibly ever in natty gas, when there was panic in late 22, early 23, that like Europe wouldn't even be able to heat itself. Natty gas was going to be so scarce. I mean, what a fade that was. Incredible stuff. All right, so at least if it gets cold, we're prepped. We can heat our homes for cheap. Seems like maybe the only thing that can save natty gas right now is like a day after tomorrow winter storm. Give me your Bitcoin thoughts as we're ramping up here. How high can we go?
I'll give it to you. BlackRock Bitcoin ETF, they have over 100,000 Bitcoin under management. Investors keep accumulating the spot Bitcoin ETF. Daily inflows broke another record, 631 million, and it's only been trading for 22 days. Now, here's where things get interesting. Rewind back to November 18, 2004, GLD was launched, the gold ETF. It surpassed $1 billion in assets within 3 trading days. We went from $400 on gold to $1,900 in a decade. Who knows?
They're
Bitcoin
getting
might
excited.
get $100,000 this year and $1 million in a decade. Just throwing it out there.
All right. Well, you're not the first. So we've heard I think you can find about any price level prediction for Bitcoin out there. So you're not alone.
You got to get to 53,000, then 54, then 55. So just keep throwing those price predictions out.
Okay, love it. All right. Thanks, Bill. Appreciate the thoughts. Chief Market Strategist, Blue Line Futures. Good eyes on the natty gas trade, too. Pretty amazing, I think. It's just a total free fall. All right, speaking of free falls, Upstart got whacked on earnings.
IBIT,
story for us from the news
number one in volume.
All right, how bad were these numbers?
Falling to a 3-month low, that's how bad. And right now,
Honey, we can't hear you.
they came in line with estimates, earnings, or revenue actually beat expectations. But can you hear me now, guys?
We might have to fix that. Yeah, we got a little echo. I can hear you from the distance, but.
You don't get it. Plug it in.
All right. Well, we're gonna check back. Upstart's getting hammered. So clearly an exception to the rule of the frothy consumer plays that have been doing so well. We got a big picture panel with the Schwab team coming up next. 10 minutes until the bell. How far can stocks run? Russell's trying to make up more ground on yesterday's sell-off as we speak, and we're rampant. So anything's possible here. We'll be right back.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call it
History in the making. Can I work for Schwab? I know I can do it. welcome. Eight more minutes.
Most interesting about this whole situation, this post-earnings situation, is how analysts are responding, because they're largely on the sidelines.
Upstart down today. That ain't looking too good. What happened to your sound, baby? Upstart. Hmm. 3-year. Oh yeah. Don't get it. Hmm. Calls really went to town. More platform sticking, it looks like. It's twice this week. Definitely down.